Good morning, everyone. Good morning, everyone. Once again, welcome to our May Finance Advisory Council and Purchasing Advisory Council meeting. As you could see, we do have a very packed agenda. I'm happy that you all were able to join us today. There's been obviously unfortunate events, not only in Uvalde, but Region 1 school districts have also been impacted based on the news, what we see, threats made against the school districts and what have you. So we don't have the participation today that we were expecting to have. We had over 80 people signed up as of yesterday. So as a one-time courtesy or exception, we're gonna provide a Zoom link. We're getting a lot of phone calls requesting to have access. A lot of school districts are having graduation today. So they've been asked by their superintendent or administration to stay behind. So I do apologize for you because I didn't offer this benefit before, but all of this is happening this morning. My secretary just told me about that. So we're gonna get started. Once again, thank you. Please sign in so that we can have a record that you did come to the meeting. There's also, when you sign in, you do get your ticket for lunch. We're gonna have hamburguesas mexicanas with ham and avocado and the whole shebang. And I guess that because there's a few of us, some of us may have 2 burgers. That's the perk, that's the plus. The first, we had to do some switching around on the agenda based on our presenters' availability. Some of them are flying in. So we just wanted to make sure we would accommodate for that. Also, we're gonna be sending out a survey for all of our Finance Advisory Council group for some of the, for your feedback, first of all. What can we do to improve and what kind of topics would you like us to present? We're here to serve you, so your feedback is critical, and we would hope that everyone would participate so we can start drafting agendas for next school year. Okay, so we're gonna get started. I can see that David Marks is already connected. He's from TEA. And it's been, I've been begging David to present on GASB 87. There's been some changes on TEA staffing, and so he's doing this presentation for us. And I say begging because he's been very busy, and so we haven't, it was, the times that we meet were not, in the past didn't work with his schedule, but I'm happy, and we welcome you to Region 1, sir. So the floor is yours, Mr. Marks.
Thank you. Thank you for having me. I kind of want to echo what you were just saying because you know, it's a tragedy that what happened in Uvalde and also in Central Texas. We're also hearing about some of those threats, and so you know, our thoughts and prayers go out to all of those families that are experiencing difficulty and loss. The other thing I wanted to note is just for the slight appreciation that you know, most folks don't want to hear about GASB, and I know when someone says GASB, I'm kind of like, oh no, not GASB. Even though I know I need to hear it, it's important to hear, but on a day like this, in a time like this, I'm thankful that I get this opportunity to be able to, one, talk about and to learn about GASB. All right, I'm going to share my screen now. Let's see if we can get it going. And There we go. Oh, good. I like this. So on my screen that I'm looking at right now, I can see a big screen up there, and I can see my slides, and so I can see what you guys are looking at. This is a much better view than the one you previously had when it was just my face up there. So I'm glad that I can see that. All right, so GASB 87 implementation. Hopefully, every one of you have already heard about GASB 87. And how it's going to impact leases. So today I'll present to you what the agency has been presenting about GASB 87 and then answer any questions. I only have these slides prepared. However, if we end up needing some more time to fill, I did a presentation last week at the Texas Society CPA School District Auditing Conference. I can bring those slides up pretty quick and kind of give you all the high points of some of those things that I talked about there. So what is GASB 87? Everything you knew about leases, operating versus capital, throw out the window. You no longer need it. So I'm guessing that kids that are in college that are learning about leases are not learning about operating leases and aren't calling them capital leases. The intent of GASB 87 was to enhance the accounting and financial reporting for leases, meaning that they wanted to be able to show what is considered leases as they're more of a financing opportunity or financing product. And you can see in that last bullet point, it kind of talks about that. That's the finances of the right to use of the lease asset. And you'll hear this term over and over and over, right to use, right to use. Basically, what GASB 87 has done, it has said there really are no longer operating leases. Almost all leases will be a capital lease or the right to use lease, which basically means you'll add on the value of the asset, you'll add on the entire liability, and then you'll depreciate the asset, amortize that liability over the life of the lease. That is it in a nutshell. Too bad it's not as simple as that sounds, but that's basically what GASB 87 has done. And then a lease is defined as a contract that conveys control of the right to use another entity's non-financial asset. So if you think of your copiers, how you were using the copiers in the past, you didn't really identify those as a capital lease. Those were an operating lease, so you just book the expense as you use the copier lease. And then the examples of a non-financial asset would be buildings, land, vehicles, and equipment. So you guys are familiar with that. The effective date of GASB 87, the original effective date was December 15th, 2019. And then the pandemic hit. And so GASB, thankfully, while we were trying to figure out how in the world we're going to educate students, GASB postponed the implementation of this particular one by 18 months. And so now, yeah, it's coming due. So it's time for us to analyze our leases and think about what we need to do to be able to get these on the books and work with our auditors to start accounting for these new kinds of leases. Regulatory guidance for other industries. The only one that really is applicable is the bottom bullet, which applies to charter schools because charters follow FASB. They also had to recognize their capital leases and their operating leases in a similar manner. So just from a kind of a baseline understanding, we provided some questions, and you'll kind of see these sprinkled throughout just to kind of help hammer home what essentially what we're trying to say and some of those key points that we want you to understand. So in the first one, and all of these questions come from guidance that GASB has provided. And so that's where we pull these from. So these aren't questions that I've gotten or someone on my team has received. These are questions that GASB has provided and are in the GASB documentation. So a government obtains the right to use land, which has a market rent of $100,000 per year for $1 per year. Should the government apply the requirements in statement 87 to that transaction? No, the definition of a lease should be applied only to exchange or exchange-like transactions. So that first part is saying if it's worth $100,000, you're only paying $1. That's not really an exchange or exchange-like transaction because they're not really equal. And then they go on to say the government's right to use land for $1 does not meet the description of an exchange or exchange-like transaction because essentially there's not an equal value. All right. So here's what you guys need to really start working on. You need to identify, let me walk my chair, sorry. You need to identify the leases. So all of your leases, working with your purchasing department, maybe one of your other departments have leases that they control that do not reside in the finance department. So you need to work on getting your hands on all of those leases and gathering the other facts. So this first slide kind of talks about, well, where do you begin? So if you think about some of those types of examples that you may have, as I mentioned, copier machines, equipment used in print services. If you rent any furniture, computers are a big thing now. Although I guess I would somewhat expect that more of those are being bought, especially over the last few years because of some of the ESSER funds that you received, I believe allowed for purchasing computers instead of leasing them. Vehicles may be one that you're utilizing in your district, and then land buildings and space for buildings and grounds. So those are just some examples. You may have other things, and so if you do, then you need to think about what types of things that you are leasing so that you can get your hands on those and see if GASB 87 is going to make you record the full transaction. So here's what you need to know. If you get if you do get your hands on all of your leases, or once you do, what's the asset? Building, copiers, equipment, you have it. Are you the lessee or the lessor? And then the name, the start date of the lease, the non-cancelable lease term, and I'll talk more about that non-cancelable versus cancelable a little later, but it is a crucial point in what we do with GASB 87. How often is the payment made? The beginning or the end of the month? Are you purchasing the asset? And then the discount rate. My guess is most of you are thinking discount rate. I don't know that I see any leases that ever include some kind of discount rate, implicit interest rate. So we'll talk about what you need to do to be able to get this discount rate if your lease doesn't have it. If your lease has it, then great. You're one step ahead of some other folks. If it doesn't, then we'll talk about that. And then calculating the lease term. So the lease term is identified as the period during which a lease has a non-cancelable right to use an underlying asset plus the following periods if applicable. So your base term of your lease, you first look at, does the lease have an option to extend? And that's extend by one of the parties. So if you're the lessee and you have the option to extend without the other side saying yes or no, then you include that. Does the lease or the lessor have an option to terminate the lease, but if choosing not to? So think about that as you're reasonably certain you're not going to terminate the lease. And what does reasonably certain mean? GASB gave a poor definition of it. We kind of have that. We kind of retract that same more than probable. So if you know that you're going to extend this lease for another year, or another 2 years, or whatever the terms are, then you're reasonably certain. If you're on the fence, or you've already had instructions from your board or your superintendent, or the purchasing side that says we are considering maybe that we're not going to keep this lease, and we want you to start looking around for other opportunities, then that you may be less than reasonably certain. But what I will encourage you, because I think your auditors are going to ask for how you determined at what point you stopped including in the life of the lease. You need to be able to document to them, this is why we're no longer reasonably certain. So keep that documentation if you are having to, or you are instructed to start shopping around for some other opportunities. And then all of those things would equal the lease term. Okay, so knowledge check again. The government enters into a lease with a 6-month non-cancelable period and an option to extend for another 12 months after the non-cancelable period. The government is not reasonably certain that it will exercise the option to extend, and therefore assesses their lease term as 6 months. Is this arrangement a short-term lease under GASB 87? No, because paragraph 16 of statement 87 states that a short-term lease has a maximum possible term under lease contract of 12 months or less, including any options to extend regardless of their probability of being exercised. Therefore, the lease should report a lease liability and a lease asset. However, the lease term would only be 6 months. So why isn't this a short-term lease? Because of this option to extend for another 12 months, that would make it an 18-month lease. Therefore, in this case, even though they're not reasonably certain that they're going to do it, because there's a 12-month option for a 12-month period, they are considered that they're going to, that they would have to analyze and think that the asset is going to last longer than the 12 months. Therefore, when they do their calculation, though, they're only going to include the calculation as if it was a 6-month lease. And so this is one of those things where I think a lot of people have struggled to figure out what exactly the lease term is. And hopefully as we go through these slides, we'll continue to kind of push on that and help clarify some of those things. Other considerations, modifications after the initial measurement date or the inception date will require a recalculation of your journal entries that could impact both the balance sheet and the statement of revenues and expenditures. And then if you have some of these other types of changes to your lease, so lease modifications, terminations, subleases, GASB 87 does provide you some guidance for those as well. Lessee accounting. A lessee should recognize a lease liability and a right to use lease asset at the commencement of the lease term, unless the lease is a short-term lease or it transfers ownership of their underlying asset. So this is the first that I've mentioned about transfers ownership of the underlying asset. Go back to your old lease accounting. At the end of the lease, for capital lease, you would look to see if it's has a bargain purchase buyout or transfers ownership. So that's similar to this. But what GASB is basically saying, you don't have to, if the transfers ownership, you don't have to worry about it being a lease or not. You're getting the ownership, therefore it's basically you're purchasing the asset. And that's the way that GASB has looked at that now. Lessor accounting, the lessor should recognize a lease receivable and a deferred inflow of resources at the commencement of the lease term, with certain exceptions for leases of assets held as investments, short-term regulated leases. Once again, you see that short-term lease or transfers of ownership under the line of the underlying asset. So GASB did provide a short-term lease exemption. Last week, I was listening to one of the presenters, Blake Rogers. He he frequently presents on all things GASB. At one time, he was a GASB fellow and helped produce some of these GASBs that we've been so blessed with over the last 5 or 6 years. And so he jokingly highlighted that for most folks now in their purchasing departments, they're going to be encouraging only short-term leases and trying to structure their leases where they all qualify as short-term, because that's the lease accounting that we're all used to and takes the least amount of work from an accounting perspective. I don't know from the purchasing side if it takes the least amount of work, but from the accounting side, if you have a short-term lease and that's all that it is, then it's business as usual. So as you're thinking about that and getting new leases or contracting for new leases, that might be something that you keep your eye out for. So GASB specifically exempts those short-term leases from the provisions of the standard, has a maximum possible term under the contract, including options to extend of 12 months or less as determined at the beginning of the lease. Options to terminate the lease are excluded, should be accounted for as expense for the lessee upon payment and revenues for the lessor upon receipt of the payment, similar to how the operating leases are. And the bottom bullet point down there, no impact on your government-wide statements. Because it's a short-term lease, you just record the expense and you just go on down the road just as you have done with your other operating leases. All right, contracts that transfer ownership. So they transfer ownership of their underlying asset to the lessee by the end of the contract and does not contain termination options, but that may contain a fiscal funding or cancellation clause that is not reasonably certain of being exercised. Once again, you see that reasonably certain of being exercised. And then if it meets these two criteria, then it should be reported as a financed purchase of the asset. And so then it's just basically you treat it like you received a loan for that asset, and once you pay off the loan, then you receive the asset. Categories of leases. So when you're looking at your leases, trying to put these in stacks or in buckets will help you as you process them and what and group them together so that you'll know what you need to, how you need to account for them. So short-term leases, inflows and outflows, cash and expense. The lessor retains ownership of the asset. If a lease has a 12-month or less period, but has an option to extend over 12 months, it must be classified as a right to use leased asset. So once again, if it's over that 12-month period, if it's under that 12-month period, and you're not gonna and there's no options to extend it, then you'll have a short-term lease. Right to use lease assets, those are your long-term ones that we'll spend more time about. You can see that first bullet, you are going to have to include it on your balance sheet. So your A1 government-wide. And then there's also a net present value of the lease payments, and I'll show you an example of what that looks like. And we provided that calculation and formula and how to use Excel to be able to calculate that. And then the finance purchase, that's the one that we've kind of touched on as well, where basically the assets transferring to you at the end of the lease, that's just going to be a financed purchase. All right, GASB 87 does not apply to leases of intangible assets, biological assets, inventory, contracts that meet the definition of a service concession arrangement, leases in which the underlying asset is financed with outstanding conduit debt, supply contracts such as power purchase agreements. And then some of those things can be found in the appendix of the presentation. I will note that there is a new GASB. I don't talk about it in here. FASRAG is out for public comment right now. So any of you who are interested in commenting on FASRAG, it's out for public comment, but I did, and the reason why I bring that up is I received a public comment already from one of the auditors that talks about GASB 96, which is for your software leases that you'll have. So if you have some software applications where you're leasing those, GASB 96 has contemplated those. The good news is it's the same type of accounting as what GASB 87 is. So you won't have to learn the accounting for that, but you will have to analyze all of those contracts to make a determination of how they need to be classified. And that's for your software applications. And that's GASB 96 if you're taking notes. This just kind of talks about the update for FASRAG. It is being updated to reflect our GASB 87 guidance. We made a change where everywhere a capital lease was identified. So in the object codes, you'll see that we crossed it out and we changed that to a right to use leased asset, and it gets into a long title. So it's right to use lease asset principal, right to use lease asset interest, and you'll see that as we move through here as well. And then it's got to go through, it does take a while for FASRAG to get adopted because it has to go through the State Board of Education. But not only that, it also goes through the commissioner rule process. State Board of Education, though, is a little longer because we can only take it to them and talk to them about it during their meetings. And it takes 3 meetings to be able to go through that process. I know I've shared with you before, but just in case there's some new folks in the audience, from a process standpoint, the State Board of Education, the first meeting that we have with them is to tell them that we are planning on updating this rule and updating the FASRAG. Here's some of the changes that we think we may be making. And so that's the first rule or first meeting with them. And then they come back in 3 months. We tell them that we are proposing, and in the proposal stage, which is where we're at right now, we provide all of the documents in the changes that we've made, and then we tell them again the summary of those, and then that gives them the opportunity to reach out to their constituents to see if there's anything that they need to be aware of or need to be changed. And then after that meeting, then that's when it goes out to the register for public comment. Then, and this is what will happen for this edition where we're at, the state board comes back in about 3 weeks. And so we'll take it to them and tell them this is our second reading final adoption, meaning that we receive comments. Here's some of the changes we made, and now it's going to go back. We're adopting it as rule. It goes back to the Texas Register, sits out there for a few weeks, and then it becomes rule, and that's the process. So we're close, but not quite to the finish line yet for our adoption of the FASRAG. All right, back to the leases. That was your brain break for just a second. I probably should have told you to stand up and stretch while I talked about that part of it. Short-term lease. So this is according to Blake, this is what you're aiming for now if you don't want to have the additional accounting work that comes with the longer leases. So a short-term lease is defined as a lease that at the commencement of the lease term has a maximum possible term under the lease contract of 12 months or less, including any options to extend regardless of their probability of being exercised. So if you think back on that question that I had towards the beginning, it was a 6-month lease, and then it had a additional 12-month option period that turned it into having to be recorded as the long-term lease. And so any options to extend beyond that 12 months get you into a potentially more accounting work. Then the lessees and lessor should recognize the short-term lease payments as outflows. And so we've talked about that. That's the short. So if you get a short-term lease, 12 months or less, you would just record it as you've recorded most of your other leases. You would still use that object code. I look at these real quick. There we go. Sorry, the Zoom link keeps, or the Zoom keeps popping up over my titles. So you can see how we've also made a change to the operating leases. We just calling them short-term to change with the GASB definition. And so this is how we repurpose this object code. That's also how we're repurposing the other codes. And so this hopefully will simplify things a bit for you, just because you're already familiar with using those object codes. And then we give you types of things that you might rent or lease. And then here's an example of the accounting for the lease. So you signed your 6-month lease for furniture. You're going to return it at the end of the 6-month period. And then you can just see you debit the expense, and then you would credit the cash, just how you're used to. And then if you're the lessor and you have rent and short-term lease revenue, so you can see once again, we've added that short-term definition in there. And then this is where you would record the revenue for those. All right, another knowledge check. A district enters into a lease with 6-month non-cancelable period and option to extend for another 12 months after the non-cancelable period. The district is not reasonably certain that it will exercise the option to extend and therefore assesses the lease terms as 6 months. Is this agreement a short-term lease? No. And then just what I explained to you, has a maximum possible term under the lease contract of 12 months or less, including any options. So you get to record that liability in a lease asset. So just what I mentioned earlier, kind of skip through that slide. All right, now we're getting into the real meat of GASB 87 and the change that the bigger change that they've made. So GASB 87 implementation date for existing right to use lease asset or long-term leases. The initial recognition will include a restatement of the beginning balances in the year of implementation. So your entries are going to be required to calculate lease liabilities and assets as of the first day of the fiscal year, beginning with 2021 or 21-22. You'll need to examine the existing capital and operating leases. So this is what I mentioned. You need to begin gathering those and putting those in your different buckets as you look at those leases and determine which bucket they belong in. And then also if you have rental agreements with other entities, so if you're leasing your facilities out to churches or childcare providers or after school care, you need to look at those as well and make a determination how those need to be accounted for on your books. So this is just kind of an example of what it would look like. So you have a 5-year lease. The inception date so the lease date is 1/1/2019. It does not have a transfer of ownership. So under pre-GASB, even though you have a 5-year lease, it was still classified as an operating lease because there was not a transfer of ownership. You would recognize the lease just as you always have. So 1/1/2019 through 6/30/2021. Then you would recognize the lease expense for those years on statement of revenues and expenditures. Okay, so now we're to the point of GASB 87 is effective. It's the effective date would be 21 through July, your typical beginning of the year start dates, depending on what your fiscal year is. Then you'd capitalize the lease at the remaining present value. That second bullet's important. I've gotten this question a couple of times just recently. folks are as they're, I guess they're starting to work through this, and they wanted to know if they needed to go back and capitalize the lease all the way from the beginning of when the lease was signed. So in this case, it would be 2019, or if it just starts in the effective year, the implementation year for GASB 87. So you can see that second bullet point highlights that you just capitalize the lease at the remaining present value. So whatever amount is left on that lease. Districts will have to have annual entries to both the balance sheet and the statement of revenues and interest. And that's just saying you found a lease that falls under GASB 87, you will have to make those journal entries, and then you'll continue them through the remaining part of that lease term. Long-term leases, a lessee should recognize a lease liability and a lease asset at the commencement of the lease term. And then, of course, it gives you the two that we've already talked about over and over of if it doesn't fall into the long-term lease, then it'd be one of those. And then the second bullet point, you're starting to hear it pick up more. The lease liability should be measured at the present value of payments expected to be made during the lease term, less any lease incentives. The lease asset should be measured at the amount of the initial measurement of the lease liability, plus any payments made to the lessor at or before the commencement of the lease term and certain direct costs. So that bottom one is saying this is how much you need to record the asset on your books for. It's at the initial measurement of the lease liability. So if we went back to this slide, this slide, you would only include the asset amount that falls under the middle arrow and going forward. And that's how you would classify that asset. Ooh. All right, let's see here. My wheel is turning too fast. There we go. A lessee should reduce the lease liability for principal as payments are made and recognize an outflow of resources. For example, the expense for interest on the liability. A lessee should amortize the lease asset in a systematic and rational manner over the shorter of the lease term or the useful life of the underlying asset. So there you have an option of either using the lease term or the useful life of the asset to be able to amortize that value. And then as almost all GASBs that require adjustments on the financial statements will require some notes disclosures as well. All right, here, interest rate. This is somewhat of a new idea. I don't know that a lot of the lease contracts that you sign have interest rates, but this is something that is required for GASB 87 because we're having to calculate a net present value for that asset. And so with that, that includes, there's an implicit interest rate that is there to get to the value of the asset that you pay over the life of the lease. So the first bullet point, the future lease payment should be discounted using that interest rate that the lessor charges the lessee if you have one. And if it's stated in there, that's the one that you would use. Then that second bullet point down there talks about if the interest rate cannot be readily determined, then you could use your borrowing rate or an estimate of the interest rate that would be charged for borrowing, or some other interest rate that your district is using for other types of financing activities. So here's the present value calculation. It's if you've done it in Excel, you know sometimes it can be a little tricky because defining some of these items and the way that Excel defines them is a little bit awkward. And so what we've tried to do is give you an example of the calculation. So then you could use, you could go in Excel, use the function that we're saying, and just enter the information in. And so that way, that hopefully it'll simplify that for you. So in Excel, you would use the present value function. And then as you're using the wizard for it, will ask you for you to fill in this type of information. So it would be the rate. The rate is 3% per year. Wow, if you can find a borrowing rate at 3% per year, right now you're doing pretty good. I think those borrowing rates have gone way up as the feds have started to raise them. And then the NPER is the number of periods. So think about it's on a monthly basis. So that's going to be 60 months. Then your payment is $1,000. And so you can see that we provided in the notes that you have to add the negative because it's an outflow. It's a monthly payment. Then for the future value is 0. So we're saying that the lessor would get the ownership of the asset. So therefore there's no value. And then it's type 1 because the payment is made at the beginning of the period. And so after you input those numbers, you get a present value of $55,791. So your lease would say $1,000 a month for 5 years. That would make your lease $60,000, but it has to be discounted because there's an implicit interest rate, and that's what we've done here. So the present value of your asset right now is $55,791. So now what we've done is just provided you that amortization table. And so you can see how we have it set up. The principal, the term, the annual rate of 3%, and then it can show you, the payments, and then the monthly rate and the lease payment up at the top. And then the table just provides you the balance. Most of you are used to this, and more of the buildings or your bigger capital projects as they're being discounted or depreciated over a number of years. So you can see your lease payment, your interest. So this is how much interest you're paying. And then the principal amount would be that amount, your principal minus interest, and then the ending balance. And then that would carry on for 16 months. One benefit of having this amortization schedule is you will have to show in your note disclosures what it looks like for the first 5 years, annually for the first 5 years, and then after that every 5 years, similar to already what your debt disclosures look like. And then we provided the formula for you so you could build the amortization table yourself. Originally, Sarah Kahn, who was in my division, she was a manager. She replaced Al McKenzie. Most of you probably know Al McKenzie when he was director of state funding, and then he became the director of fiscal forecasting and analysis. So he retired back in November, and she went over there and took over his position. But she created this table, and then her and I talked, and so we decided that also providing you a table like this that shows the formulas to build this table, we thought would be useful for you guys. And so that's there if you're not using some software to be able to do this, get this information for you. So some districts may just determine that they don't have enough leases to justify the cost for some software to track the leases for them. So they're going to do it in Excel. And so we've provided these formulas for you so that you can use these to create your Excel spreadsheets. Let's see, the annual cash basis right to use leased asset calculation. You can just see the interest plus principal. And so this is just the table in a summarized form. And then we get into the accounting. So that was the calculation of how you come up with the information that you're going to enter into your accounting system. So to get it on the books, the asset and the long-term, because it is long-term debt, because it's going all the way out 5 years. And so to record the asset, I will highlight that we're using an asset fund. So you think about those, the government-wide side, some of you may utilize these types of funds where you track your capital assets and your long-term debt. And so we have elected to use these funds to be able to account for these on the government-wide side. So you record the total amount of the asset that you calculated, which is the 55,791. And then of course, since you're adding it onto the books initially, you're going to end up hitting the net investments and capital assets account. So that's a net asset account. And so you can see that it's hitting that. And then on the long-term side, you can see that in the from the debt side. So once again, I will highlight for you, we're using a long-term debt fund, but you would record a debit with that same amount to your net investment capital assets, plus this the same amount as a lease payable. And then the financial statements prepared using the current financial resource method. So now we're switching over to the governmental funds. You'll record the capital expenditure. You can see that it's recorded in, we're using Fund 199, capital outlay, and then also your capital expenditures. And then something somewhat new for you guys, the proceeds from the right to use leased asset for the 57,791. And then there's two paragraphs we highlighted as you're working through this. If a lease is expected to be paid from general government resources, the lease should be accounted for and reported on a basis consistent with governmental fund accounting principles. And this is where that 7913 object code comes in. The expenditure, so we recorded that in the 66, and other financing source should be reported in period the lease is initially recognized. So you're recording it in that first year that you're recognizing the lease. Then your subsequent governmental fund lease payments should be accounted for consistent with principles for debt service payments on long-term debt. So that bottom line down there, let's see, did I talk about it on the next one? No, I'm going to mention it here and I'll probably mention it again in a minute. That bottom line down here, the principles of debt for debt service payments and long-term debt, that has been a key piece that at the agency we've struggled with. Because if you think about what's happening with these leases now, you're having to put them in function 71. Most times federal funds and your PIC codes don't allow for debt service payments to be coded there. So at the agency, I've gone round and round with myself, and then I've talked to school districts and auditors about what's the best solution for this. At one point, I thought the best solution was I was going to create a different type of debt service function. So it'd be, let's say, function 75. It doesn't exist. That's not my plan now, but I'm just sharing with y'all my thoughts of what how I processed it. My current process, just waiting to make sure that it's going to work, is to allow and I need to work with PEEMS to allow for a rule that says function 71 used with certain object codes can be included with your federal funds or included with, let's say, PIC 23, which is special ed. That seems to be the one that most people have questions about. So I'm trying to work with PEEMS. How do we write a rule that will allow for those specific codings to work with fund code 2XX, so 2 is your federal, and then PIC code, and then I would have to give them all the different PIC codes. That's what I'm trying to work on now. That's the way that I've changed it, because if I don't, this especially if you're using copier leases in PIC 23, this will have an impact on MOE for you. So you need to be aware of that. That if we can't figure out a way to do that, it will have an impact on your MOE, and it may cause some more calculations that you'll have to work with James Conley and his team on. And so I am trying to work with James to make sure that we're in alignment. And then the other piece I would just say is that GASB has provided, I'm sorry, into CFR, they have provided for if GASB or GAAP accounting GASB is requiring certain things, then it would be allowable there. And so they have said that your monthly payment would be allowable in a federal fund. So that was a lot to work through. Apologize for that. I don't have that on a slide anywhere, so I needed to highlight that for you, and I can re-highlight it again in a minute if folks missed it or need to hear it again. So if we go and think back about that 7913 proceeds from the right to use lease asset. So this is the title of that object code now. It's used to classify the amounts paid net of initial or down payments on contracts for right to use lease assets. This code represents the remaining balance to be paid at the time the right to use lease asset is entered into. So that's at the inception. That goes back to if you're having to implement GASB 87 in the middle of a lease contract, it's just from the date that GASB 87 becomes effective going forward. So you don't add on the previous year's values. You only use it with the governmental funds. And this just telling you, think about modified accrual versus accrual. And then the prior slides do not apply to proprietary funds. Other financing sources and uses is the governmental fund operating statement. Let's see. Inflows of current financial resources from other funds, such as interfund transfers received from other funds, are reported as other financing sources rather than revenue. This is just talking about the use of using that other financing source in use. Okay, so this is a copy of the journal entry that you would make that you're typically used to, kind of. So you can see that now, instead of having just an operating expense or a short-term lease expense, one line, there's two object codes. Like I said, you can see that we have chosen to, instead of create new object codes for these assets specifically, we've chosen to just redefine the capital ones and repurpose them for the right to use asset lease interest and then right to use lease asset principal. So you can see that they were coded to a function 71, which is what GASB is telling us that we have to do, as I mentioned earlier. And then, and so this was the cash payment that they made. So historically, as a lease journal entry, you would just include the lease payment of 12,000 and then the cash payment of 12,000. Now, because we have to have that implicit interest, you have to include the interest and then call it principal because that's what it's being treated as. And then you can see down there at the bottom where we've highlighted for you, this is the way that PEMS allows for things currently. What I'm working through right now with them and with James and the federal side is trying to write a rule that is going to allow for PEMS function 71 to be used with 6522 and 6512 to be coded to fund 2XX, your federal funds. Or if it has 199, then you could see we would add in or tell you to include the PIC number in there so that it can be included with your special ed, for instance, if you were using those copier machines in special ed. but you would only record the the monthly amounts that you're paying. Let's see. And then to record the interest payable. So if you're having to make a journal entry to accrue some interest payable, then we provided you the journal entry of what that looks like. And then we got this $113 amount from that amortization schedule that I showed you in Excel of if you build it yourself. Shorter of lease term or useful life of the underlying asset. So the lessee should amortize the right to use lease asset in a systematic, rational manner over the shorter of the lease term or the useful life of the underlying asset. So here's the example again. The 5-year lease net present value was $55,791. So you would do a straight line amount. So you would just divide the asset by the number of years, number of months typically, and then you would just show the credit for that. This is what that's essentially providing right there. You can see the 11,158, the debit of 11,158. Here's the journal entry that you would make in your capital asset fund. And then for the liability side, you would adjust the right to use lease asset payable in the general long-term debt fund by the annual principal amount paid. So if you go back to that table where we calculated the principal and interest, you just would record the debt, the lease payable, I'm sorry, reducing it, and then putting in the other side would be the net investment in capital assets. And then of course, all of you are familiar with GASB 34. So there is some government-wide journal entries you'll have to make in order to make your financial statements and add it onto the government-wide side. It also requires notes to the financial statements. So you'll have to disclose a general description of your leasing arrangements. So the basis, terms, conditions on the variable rates not included in the measurement of the lease, the existence of the terms, conditions of residual value guarantees, the total amount of the lease assets, and the accumulated amortization disclosed separately from the capital asset. So if you think about the capital asset schedule, you'll now have another one just specifically for your leased assets. And then you'll have those by major classes of underlying assets disclosed separately from the capital assets. The amount of outflows recognized in the reporting period for the variable payments, and then the amount of outflows of resources recognized. So if we think really far back when GASB created inflows and outflows, they must have already been planning these types of things, because to me, it seems like every new GASB that comes out after that is always touching a outflow and inflow of resources. And then you'll also include the principal and interest requirements to maturity presented separately for the lease liability for each of the 5 subsequent fiscal years. And then you get into that 5-year increment thereafter. I mentioned that earlier. And then the commitments under leases before the commencement of the lease term, the components of any loss associated with an impairment. So if you've lost some lease equipment from something, then you would disclose that impairment. And then we go into the final one. So that was the long-term right to use leased asset. Currently, my hunch is that's where most of your assets will live. You may have some that qualify as short-term. And then this final piece are just more of a straightforward, you're essentially buying the asset. It's called a lease. The GASB says it's not really a lease. This is just, you're purchasing the asset. So the finance purchase, if it transfers ownership, of the underlying asset to the lease by the end of the contract, and it does not contain termination options, then it's going to be a finance purchase. And that's it. Look at that. Here we go on knowledge check now. That was a short section there because, like I said, GASB looks at that as you're basically, you borrowed money to buy an asset, and that's the way that they look at that. A district enters into a 12-month non-cancelable lease in which the lessee has options to renew for 12 months at a time, up to 49 times. Is this agreement a short-term lease under statement 87? No, according to that same paragraph of 87, which is paragraph 16, the maximum possible term of short-term lease is required to be 12 months or less, including any options to extend. The presence of a lessee renewal option, regardless of the probability being exercised, means this lease does not meet the definition of a short-term lease. Another knowledge check. A vendor installs equipment in a government's building to increase energy efficiency. The government will own the equipment at the end of the agreement, and the contract does not contain a termination option for financial reporting purposes should this transaction be reported as a lease or a finance transaction. So just like the one slide said, at the end, the government owns the asset and it does not have any termination options. Therefore, we know that this answer is it is a financed purchase, and that's how you would account for it. Let's see. I have a couple of minutes left. Is there any question? Oh, let's see what the chat says. Oh, all right. Hopefully everybody could hear me. These were early on, the two about the sound being messed up. I didn't see anything else that said they couldn't. So any questions? And then I will highlight as people are thinking about those. I did provide an appendix that I referenced. So it has some more details about GASB that we thought were important, just not something that we wanted to include in the talking portion of our presentation. And so you can just kind of see as I'm going through here, the impact on your financial statement and how those, which statements those are impacting. And we just provided some more tables. I think I showed you those in the screen. This is the expenditure and the other financing source would be reported in the period the lease is initially recognized. So, and then if you're a lessor, we did try to provide you some accounting example as well. Hopefully this will be helpful. Yeah, so I'm not gonna, I mean, I can scroll through here. I wasn't planning on presenting on this portion of it, but it's there. I will, I did not send my slides ahead of time. They requested it. I didn't do it. And so I will, after the presentation, I'll send my slides over to you guys if that's helpful. Is there any questions in the room?
Not at this time. It's Friday morning, I think.
Yeah, and it's GASB, so people will marinate on it. And if you guys start getting questions, feel free to reach out, or as you're working through this, happy to discuss in more detail, or if there's a question that comes up, then let us know.
David, this is Romalda. So just an observation, because we do have federal programs and other non-general funds support some of the leases, I'm anticipating that districts may be submitting grant amendments to make sure that we can move funds from, I guess in this case, from 6,200s to 6,500s. And I guess you're the wrong person, but is the agency cognizant that it will be receiving an influx of amendments from all districts just to reflect this in the grant?
I don't know that they are. It's something that I can highlight with, well, Roger. So Roger Hingarani, who is my counterpoint when on the auditing side for federal funds, him and I and David McLaughlin and James Conley, we've had frequent conversations about this, but I don't know that our conversations have crossed over onto the grant administration side. Although they're both federal, or all three are federal program side, which obviously I'm not, but I don't know if their conversations have crossed over. So I'll send Matt Lashley a message letting him know that 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 there could be some grant amendments coming through to change over from a 62 to a 65, and they need to be aware of that. So that's a good highlight. Thank you for pointing that out.
Thank you. And I guess the last comment I'll make is from a PIMS perspective, I'm assuming that it will accept 211, 71, 6500s, and it will not cause it. Go ahead.
Oh, that's what I'm trying to work on right now.
Okay.
Is to have a rule that will allow for that, but it would have to be those specific object codes. So I work with PIMS, but I don't know all the ins and outs and the intricate details with PIMS. Generally, the way it works for the agency, I'll send them an email saying, hey, here's a new fund that we're creating. And then they'll enter it, and then they'll come back with questions to me about, can it do this or can it do that? Is it allowable for this? And so that's how me and PIMS work. And so that's one of the things that I'm working on with them, is trying to get that correct. But first, I need to make sure and verify that the federal program side is okay with me proceeding and going this route. Like I said, I've been working with them. I started another direction because I've really struggled with this. This is something that I've been concerned with since GASB 87 came out, is trying to find a way for you guys to still continue to keep those lease amounts in the federal programs or in that PIC 23 for MOE purposes. And so that's what I'm trying to get worked out at the agency. So yes, that is on my list, and that's exactly how you described it. That's exactly how I'm trying to allow for it to be processed now, since GASB has said it has to be within that debt service function.
Questions, anyone? There's no questions right now, sir.
Okay, thank you. I haven't been down there since this new conference room was built. It looks very nice.
You're gonna miss lunch.
I am gonna miss lunch. It sounded good. My stomach was growling when you were talking about what lunch was, and then you said you could have. There's enough for folks to have too, and I was like, oh, that would have been me for sure.
Yeah.
All right, maybe
like
next
avocado,
year.
yeah, you're missing out.
Yep.
Thank you so much, David.
Thank you.
We truly appreciate it. We
All right,
truly
y'all
appreciate all the support to Region 1.
Sure. Y'all have a good day.
Thank you.
Bye.
Thank you, sir. Moving on the agenda, our next presenters are Andre Ayala. He's the managing director with Hilltop Securities. And we also have Jorge Delgado, vice president with Hilltop Securities as well. And they're gonna be discussing school district financing alternatives and implications, best practices, and analysis. From a personal perspective, they were, I guess, the best team I could have asked for. They helped me with very high profile projects in my previous district, and I trusted them, and it ended up that the board and administration trusted them as well, because every time that we would work on a financing transaction, it was always in the best interest of the school district. And at the end, some of those savings went to our taxpayers. So without further ado, we have Andre Ayala and Jorge Delgado. Give me a quick minute. In the meantime, feel free to grab a taco or two. It's been a while. I'm good. You want to use this or you want to use the mic? Lori, Lori, can you help me, please? Wherever it's from. Lori, can we use both the mic and the lapel? Okay. In the meantime, the service center is utilizing the vendor Cameron Gooley. He's the gentleman that puts the GASB 68 template together. We're not advertising or anything, but I know that several districts have reached out. So we're currently working with him. He already analyzed some of the leases we have. And so we're working on that. So he's gonna be helping us on complying with GASB 87. There was also mentioned that there are some other providers. Once again, we're not endorsing anyone, but just to look at different options that you may have unless it's gonna be done in-house. You have someone that has time to work on all of those things.
Morning, everybody. My name is Andre Ayala with Hilltop Securities, Managing Director. Can you all hear me? No? How about this? Better? Okay. Well, good morning, everybody. Andre Ayala with Hilltop Securities. My financial advisor serving municipalities and school districts at Hilltop Securities. Thank you for joining us this morning. What we want to discuss with this forum this morning is alternatives to financing projects for school districts. So how would a school district finance a project? Whether it's cash or debt, go through that, and then implications of issuing bonds, municipal bonds for school districts in Texas, and what you need to be mindful of as you go through that process and once you issue the bonds. And then finally, just answer any questions you may have. We want this to be a little bit more interactive. So we'll go through our presentation within the next 20, 30 minutes, and then give the audience an opportunity to ask any questions that come up as we have this discussion. I'm going to turn over to my partner, Jorge Delgado, who's going to go through the first part of the presentation, and I'll go through the second part, and then we'll entertain questions from the audience. Thank you.
Good morning, ladies and gentlemen. Jorge Delgado, Hilltop Securities. Thanks for having us and for making the time to listen to what we have to say today. Like Andres said, we've got a couple different topics that we want to talk to you about. I'm going to get into the different types of debt that are available for a school district. We think this is important to highlight because there's a common type of debt, and then there's other tools that a district has that are not as known. They're lesser known, not specific to the area, but around the state. So we wanted to share that information with you. Should you, as finance officers and directors of your organizations, stumble upon a situation where these may make sense, it's a good idea to understand what these items do. Of course, first alternative to issuing debt is if you have cash. Cash is something to consider when you have a project in front of you. Of course, you want to keep in mind that what's the cost of the project? Is that going to deplete my cash reserves? Do I have a formal or informal fund policy of my cash reserves? Again, do we want to take up all our cash to do something? And is this a credit implication on my credit rating? If the decision is to not use cash, then we start thinking down a debt route, or we're going to issue debt for whatever project we have in front of us. So the next slide, is the most common type of debt, and I'm pretty sure everyone here is familiar with it, is your typical school bond, your unlimited tax bond, which is the legal term for it. That's the one that's the most commonly used, the most efficient type of issuing debt. This is the one that's voted by the citizens or of the school district, let's say the board wants to move forward with a school facility, you put it out to the voters in a proposition, they okay it, then the school district has the opportunity to issue these bonds. Why is it the most efficient? Number one, it can be put on the debt service side of the school district. It is not subject to any type of rollback restrictions, and we'll get to that in a bit. The debt service tax is a portion of your tax that is more fluid, more flexible for a district. Why is it the most flexible type of debt? Is because you can fund all sorts of different projects: school buildings, facilities, renovations, equipment, personal property, screens, school buses, things of that nature. And it's the cheapest cost of debt for a school district because the state of Texas gives you a permanent school fund guarantee, which means you sell that debt with a AAA rating. So regardless of what the school district's rating is, you can go out and issue those bonds with a AAA rating, which makes you capture the lowest cost, the lowest interest rate at the time, right? Whatever interest rates are, you'll capture the lowest one at that time. Again, this is the most common one. I'm pretty sure you've all heard of this one. But the next ones we're going to get into are the more, I don't want to say obscure, or lesser known types of debt and tools available for a district. I'm going to get into three of those: limited maintenance tax notes, and then contractual obligations. The name, that's a short name for public property finance contractual obligations. And number three, time warrants. Big difference between those three compared to the one I just mentioned is that none of those can be on the debt service side. They can only be repaid for out of your maintenance and operations side. So if a school district wants to proceed, you have to keep in mind that on top of paying your M&O maintenance and operations expenses, you're going to have this type of debt on that side. This side of the tax rate is subject to our rollback restrictions that were implemented here a couple of years ago by the state. But again, it's a tool that you have to finance certain type of projects. Another key difference between the bonds, the typical school bond, is that there's no voter approval required for these. So it's just a matter of board action, entering into a debt contract and moving forward. So they can be done rather quickly, right? An election is time, it takes time and effort to get an election passed. This is something that is a lot quicker. Now, what can you do with a maintenance tax note? You can only use it for maintenance expenses, building renovations, existing building renovations, and equipment. So you can't build a new construction, you can't purchase property with it. You're only limited to a certain type of purpose on this tax note. What's it good for? Maybe you need to replace school buses, or you have a decaying roof in one of your facilities, and you don't want to go through, the board doesn't want to go through an election process for that. You can get through that type of project with the maintenance tax notes. And we've worked with some of those with districts around the Rio Grande Valley, and they've been effective at tackling those type of projects. Limitations: 20-year amortization, cannot extend over 20 years. There's a test to calculate how much capacity a specific district can issue in terms of par amount. Not going to get into those details. That's just something that you can get into the weeds of when you decide to go down that path. And these are not eligible for the AAA permanent school fund guarantee. So the state does not participate in these. And it's, if the district's rated, say, A with their credit rating, then you're going to get an interest rate of that type of credit rating. The next one is your contractual obligations. We call them PPFCOs. You see, it has a long name. What's the key difference between this and a tax note? These can only be used for equipment. You can't renovate buildings with these. You can't do maintenance expenses. You can purely do personal property and equipment, which is, again, screens, laptops, computers, whatever fleet needs to be replaced around the school, maybe a fire truck or a police vehicle and sanitation vehicle, things of that nature. Again, no voter approval is required. They're rather quickly to get done. Board action, they want to proceed. And it goes on the maintenance and operations side, just like the tax notes. Subject limited to 25-year term. This is longer, 25 maturity, but since you're only financing equipment, best practice is to keep it at the useful life of whatever you're funding, right? We're not going to fund a school bus or a computer over 25 years, because that's probably going to last 1 or 2 years. But they do have a 25-year limitation. Again, it's always good to talk to your legal counsel, to your financial advisor, to make sure that the purpose is what you wanted to, the useful life calculations make sense, and that's another tool at a school district disposal. Not eligible either for the AAA school fund guarantee. So based on what the school district's rating is, that's the type of interest rate you're going to get on that. Finally, time warrants. These are a little bit more flexible, with the exception that you're limited to $1 million amount at any time. So these can do renovations, equipment, and you can purchase property with it. But you can only get to $1 million at any time. So if the building's worth $1.5 million, then the difference has to be made up with cash or, and just the $1 million. You can do everything else that every other instrument can do. Renovations, roofs, equipment, limited to 15-year term, and the principal amount may not exceed 5% of your assessed valuation. Now that's a rather small test again, but I think the real test here is the $1 million cap. Not eligible for the AAA school fund guarantee, but they're rather quick to do. Board action is all that's needed, and these also go on your operations side. All of these items that I mentioned can be refinanced over time if interest rates make sense to generate some savings, which leads to the next slide, refunding bonds. As you know, there's the refunding bond. This is not funding any new projects. This is something a school district's going to do to save money. That's the number one thing a refunding bond would be issued for. Also, maybe for a strategic purpose, you have a new bond that was approved by your voters, but you need capacity to fit that new bond, and you have some outstanding debt that you could refinance and possibly restructure to fit the new debt. That's more strategic. Again, that's something you would discuss with your legal counsel and your financial advisor. But savings is the key item when you're doing a refunding bond. And a couple of things to note when you're thinking about refunding bonds and savings, do the next slide, please, is my refunding bond eligible for state aids? Is my school district eligible for state aid? So if I'm refunding some debt, it's important to note that if I have state aid, the savings is not going completely to the school district because the state share takes that savings towards the state, right? So if I have $1 million in savings, potential savings in this refunding, we have to understand that we're not going to get the full benefit of the $1 million. So how do we use this refunding to maximize the savings that go towards the local share, which is the district, right? Maybe we talk about structuring it differently with our financial advisor and our legal counsel, such that we're able to maximize that 45% of the local share. And I'm just throwing out a number in local share that we're going to be able to keep. Is it my tax rate that I have to think about? Is it my ADA calculation, things of that nature? So, you know, a refunding bond, when you have a proposition in front of you to refinance some debt, start thinking about, well, how much am I going to get to keep, and what am I going to do with that to really benefit the district the best way possible. I'll let Andre touch on average daily attendance and these numbers and these items, as he's the subject expert on these. But thank you, and ask us any questions at any time.
Thank you. As far as best practices and considerations when you're thinking about bonds, is what is my average daily attendance? So that is critical, especially for districts that receive state aid. So all things equal, if your average daily attendance is high, and let's say the wealth of the district, meaning the taxable assessed valuation per capita is low, the higher the state aid you get. Now, what happens if we're in a declining attendance scenario, tax-based scenario? Well, the state share drops. So as Jorge was indicating, when you're structuring refunding transactions and you're looking at refunding transactions or any transaction that the district's going to be paying for on an unlimited tax side, you have to be mindful that it's not a static figure. And you also have to be mindful that if your wealth increases, and your average daily attendance is going down, there's a possibility that whatever tax rate you initially envisioned was necessary to cash flow a bond may change because the state aid changes. Now, the opposite is true as well. Let's say that your average daily attendance is growing faster than the wealth per student, then there's a possibility that the tax rate that you budgeted initially is lower than what you envisioned initially. So those are things that we always tell our clients to be mindful of when you're working with a refunding transaction or any transaction for that matter that is on the tax side of the ledger. Now, I do want to touch base a little bit on the public facility corporation financings. Those are not very common, but they are alternatives to issuing bonds. So for example, let's say that a school district wants to finance an administration building. And you don't want to put it out to the voters because it may not be successful. Well, in this particular case, what we could say is, okay, we can form a public facility corporation that would own the building and lease it. Now, there is a lengthy process. There's a legal procedure that has to take place to make this happen, and we outline that in there. But understand that these bonds are not secured by a debt service property tax. You do have to be mindful of operating implications because these are lease payments that the school district would be making to the public facility corporation, and the public facility corporation would be taking those lease payments to pay the bondholders. That's how this would work out. Next one. Now, here's a brief outline of what the process would look like. These are not subject to voter approval, but they're subject to a notice. And they have other limitations that you need to be mindful of and get advice from your legal counsel as to how these work, because you have to publish a not to exceed amount. You have to put it in the public for a number of days. And then there's a lot more participants than in your traditional bond, because you do have now a corporation, you have the district, you have a trustee in the middle of it. It's just a more complex process. And again, the most important thing about these types of instruments is that while the debt is not a direct obligation of the school district, it is an obligation on the operating side because you will be making payments to this corporation, which ultimately is the one that is paying the bonds. Okay, now what kinds of bond sales do we have here? So most of y'all may be familiar with the second one, which is a negotiated bond sale process, where a school says, okay, I want to pick a bond underwriter up front, and we're going to negotiate a price with that bond underwriter, and the district relies on its financial advisor to make the right decision as far as pricing, structuring, timing, etc. The underwriter becomes the one that buys the bonds and markets those bonds to third parties. Now, there is also a process that is used, which is a competitive sale. What that does is that with your financial advisor, bond attorneys, and everyone else involved in the financing, you prepare an official statement, which is a bond offering document. You put it out in the services, and then you take bids. It's very simple. And whoever gives you the lowest bid wins. So in this case, there is no chosen bond underwriter up front. What you would do is that you would market your transaction, and then just let someone bid on it, and whoever gets the lowest interest rate option, that's the winner. And then the last one is typically used for the non-unlimited tax bonds that Jorge was discussing, so like time warrants, notes. That's where it's more common, but it can also be used for unlimited tax bonds. And what a private placement is a direct purchase of bonds from a sophisticated investor. 99% of the time is going to be a bank. So let's say that the school district wants to sell a time warrant for $1 million. Do you think that $1 million makes sense on a negotiated basis? Probably not. It's too small, and there's a lot of fixed costs that are going to eat into that $1 million. Would it make sense to do a competitive sale for $1 million? Maybe, but again, we have the same problem where you're going to have to spend a lot of fixed costs to make that financing happen. So that's where the private placement comes in handy, where you would say, okay, bank X or list of banks, I have this obligation that I want to offer to you. What are your terms, conditions, amortization, etc.? And then you can negotiate directly with them or set up some sort of competitive process with the assistance of a placement agent. So those are the three types of bond sales that we have here for school districts. And again, each case is different. For example, if you have a $100 million unlimited tax bond, does a private placement make sense? It's a tough one because will one bank get $100 million worth of bonds? Maybe, but it's probably not likely. In that case, you would probably be looking at negotiated or competitive sale. So again, you have these options. It is on a case-by-case basis based on what the district is trying to do. Now, who's involved in a bond transaction, debt obligation? So you have your financial advisor and bond counsel. Those are the ones that are probably the most common for you all, and the ones that you talk to on a regular basis. But you also have the underwriters or a placement agent. So what do these people do? The financial advisor, what they would do is that they would advise the district on setting out the terms, structure, timing of the debt obligation, and they have a fiduciary duty to the district. So they serve the interests of the district first and foremost. Then you do have your bond attorney. The bond attorney is going to give a legal opinion on the obligation and is also going to give a tax opinion. There are circumstances where your bonds may be taxable. Let's say that you're trying to finance a project that doesn't fit within the IRS tax exempt code. Then the bond counsel would analyze that and say, these bonds are taxable. Obviously, the interest rate would reflect that. And then your bond counsel will also guide you on preparation of documents, board meetings, bond orders, etc. The underwriter. So what does the underwriter do? The underwriter purchases the bonds. So let's say that a school wants to sell $50 million worth of bonds for school buildings, and you choose a negotiated process. You have agreed, that you're going to work with a bond underwriter, and you're going to sell $50 million to that bond underwriter, and there's a contract for that. And then that bond underwriter takes those $50 million worth of bonds and resells them to third parties. That's what they do. They make a market for the school district. A placement agent serves in a similar capacity, but they don't purchase the bonds. All they do is that they find a buyer. So this comes in when we have, for example, a private placement of a note. And it's a rather small note. You don't want to go through the financial market process, bond ratings, etc. Then you may engage a placement agent and say, hey, placement agent, why don't you find a buyer for this obligation, not just here locally in the Valley, but they can go through the state of Texas or nationally and make a market for your transaction, but they don't buy the bonds. They find a buyer for the bonds. That's the difference there. And then these firms would also have counsel. They want to be represented from a legal perspective. So if you have an underwriter, you'll have an underwriter's counsel. There's going to be looking at all the disclosures that are made to the investors and bond markets. Not very common, but the placement agents may have counsel as well. Now, your paying agent is the one that is going to bill you. You may be familiar, for those in the finance offices, your paying agent is the bank that sends you the bill and says, hey, you owe us this much money every February 15th, every August 15th. That's your paying agent. Sometimes that same firm may serve in an escrow agent capacity. So for example, let's say we have a refinancing transaction and you're refinancing bonds that you cannot take away from investors until 5 years from now. Well, what you would do is that you would issue a refinancing bond, take that pot of money, give it to an escrow agent, they would invest it, and that escrow agent would be making payments to the bondholders of those bonds that were retired. And then you have the rating agencies. Some of you may have worked with Standard & Poor's, Moody's, and Fitch. There are others, but those three are the most common. And then bond insurance. If you go out and issue a bond that doesn't qualify for the permanent school fund guarantee, then you may want to look at bond insurance. So for example, let's say that we have a limited tax note, and our bond rating is just a single A, and we want to enhance that credit rating. You could go to a bond insurance company, and they would enhance your rating to right now a AA rating. That's the highest bond insurance rating that we have. Now, why is that important? It is important because it lowers the cost of capital for the school district. Now, there's an analysis that has to be made, and you need to rely on your financial advisors to do this, to say, okay, does the cost of the bond insurance make sense based on the savings me as a school district is going to get for getting into that transaction? Not all the time, but sometimes the cost premium of the bond insurance doesn't make sense, and you just want to go without it. So that's important to note. And then when we have this public facility corporation bonds, you do have a trustee. because you want someone managing those funds externally. So not the school district. You want to have a trustee, and there's a document that outlines exactly how this process happens. So you may have those firms involved. And then compensation, as you all know, it's typically handled through the closing process of a bond transaction. Most of these participants don't get any fees up front. Now, this is, I want to spend a little bit more time here. So whenever there is a capital project, what we tell our clients is that we have, to cut it short and try to keep it as simple as we can, 7 phases of a financing. So the first thing we need to do is we have to develop a financing plan and analyze the cost. So this is critical, and this is going to be the basis for everything. This is something you may want to take to your boards before doing anything and just say, okay, here's what we want to do. Here's how we propose it's done. And never forget, what are the operating cost implications of doing what we're doing? So let's say that we're funding a building or a stadium or something, and we're saying, okay, that's going to cost me $20 million, and that's it. Well, not necessarily, because it's $20 million plus the cost of operating that facility, whatever that facility may be. So it is important to have a well-defined plan of finance. Again, rely on your staff, rely on your advisors. That's why you have them, so that you can have a very solid plan of finance that ultimately will also have to be presented to the bond rating agencies if you go down that route. Now, setting the financing terms, you have to analyze, do I want to go for a 30-year repayment period? Do I just want to go for 20 years? Do I want to keep it at 25? What does that do to my budget? The longer the term, the higher the interest rate. The shorter the term, the shorter the interest rate. So those are things that have to be discussed. And then you have to talk about, excuse me, what are the market conditions? So if we have a volatile market, then we may want to think about setting up a negotiated process. Now, why would we do that? Well, because in a volatile market, participants come in and out. And you may want to have a bond underwriting firm that is committed to assisting the district in making this financing happen in spite of how volatile the markets may be. Have a stable market, then competitive sales make sense if you choose to go that way. You don't have to do a competitive sale, but that starts making more sense because the market is rather stable. Now, interest rates move every day, but they move within a short range. In a volatile market, sometimes bond funds don't want to get a hold of bonds. There's just too much supply, not enough bond buyers. Many things could happen. So you have to analyze what is the market doing at the point in time when you're undertaking a transaction. Now you have to coordinate the service providers. Obviously, you have your financial advisors, bond attorneys, and then if you're doing a negotiated sale process, you're going to be working with a bond underwriter, and they're going to have their counsel, get European agents on board, start working with the rating agencies, and just coordinate the whole process to make it as smooth as possible. And then the preparation of documents. Traditionally, the financial advisor is the one that takes on that task with the assistance of the legal counsel. Sometimes in a complex transaction, the legal counsel could do that. So that's an important thing, and something that you as a staff need to be watching all the time to make sure that all the disclosures that are made in those documents are truthful and accurate. Because remember that the representations made in those documents are not the consultant's representations, they're the district's representation. So it's important that everyone takes a look at that to make sure that everything that is in there makes sense, it's truthful and accurate, because the bond investor that is going to look at this is going to rely on the information that is published in that bond offering document. And then as far as the post-transaction, well, we want to, I'm sorry, before we do that, we want to go through the rating process or credit enhancement process. So you may want to go to Standard & Poor's or Moody's or Fitch. You may want to get 1 rating, 2 ratings, 3 ratings. You need to have that discussion with your financial advisors. They will be able to tell you, okay, 1 rating makes sense, 2 ratings make sense, 3 ratings make sense, depending on the size of the transaction. Traditionally, when you have a smaller transaction, 1 rating is sufficient. If you have a bigger transaction and you want more investors to participate, then you may start looking at 2 or 3 ratings. Now, why would you do that? Well, because some of the bond funds require, just by their internal policies, to have more than 1 rating, and you want to have as big of a universe of investors as you can, to lower your interest cost. The goal here is to get the cheapest cost of capital possible. And then when the transaction takes place, your financial advisor would be coordinating that. Again, if you have a negotiated process, they will work with the bond underwriter to make that happen. On a competitive process, there is no bond underwriter that has been predetermined. So you rely on your financial advisor to do most of the heavy lifting, publish the documentation, set a time and date for the sale. You take bids, and the lowest provider wins. That's when the underwriter gets involved, because that's when they said, okay, we, underwriter XYZ, is going to purchase these bonds. Then the last thing is you want to maintain contact with your legal and financial advisors. If you have any questions, as you evaluate your state aid performance, budgets, annual tax rates, etc., you want to stay in touch with them to make sure that you're up to speed on all the aspects of financing. And then just be mindful that there's legislative changes every 2 years that may impact you. So just keep an eye on that to make sure that any changes that happen at a higher level, if they have an impact on your finances, so that you understand what that impact would be. And I'm going to stop right here, everybody. And we want to make this as interactive as possible. If you have any questions, comments, please feel free to ask your questions.
Questions? Oh, sorry. Any questions from the group? And Andre, can you talk to the team about usually when your bonds are going to be callable or are becoming callable here pretty soon? What is your recommendation to districts when they get so many, I guess, solicitations from entities, whether financial advisors or bond legal counsels, as far as we just want to propose, this possible refunding for your consideration and what have you. What are your recommendations to the districts when that happens? And especially when they tell you that this could be the potential savings. Can you, I guess, share with the group that what should we be looking at for true savings when they are sending those proposals?
Sure. So there are in general 2 types of refinancings. So bonds, when they are sold, or any debt obligation that a school district would sell, would have a term that says on such and such a date, the school district has the option, not the obligation, the option to prepay that debt in its entirety. So when you go to the financial markets on a negotiated competitive sale, traditionally you would have 8 to 10-year call dates. What are those? It is a call protection for the investors. So let's say that we sell bonds in 2022 and the bond investors want to have a 10-year call protection. What that means is that they want to protect their investment until 2032. And let's say that we move forward in time and it's now 2030. Can the district refinance those bonds? Yes, you can. But what you have to do is say, okay, what are the savings that I am getting right now if I do this transaction versus the savings that I would get if I do it in 2 years' time? Because if we do it in year number 8, we're doing it 2 years before those bonds can be taken away from the investors. So there is a cost, there is an inefficiency right there. So you have to just measure that and say, okay, well, does this make sense for my school district? Does it make sense to execute right now based on how the markets are moving? In a rising interest rate environment, for example, you will probably say, yes, it makes sense to do it in advance because I don't want to take the risk that 2 years from now, interest rates are higher and my savings will be lower. But at the same time, you want to ask your advisors to measure what that movement in interest rates could be. So for example, let's say that you're going to get $100,000 in savings in year number 8, and you could get $300,000 in savings in year 10. But we don't know what interest rates are going to be in year number 10. So you would have to ask your advisors to say, okay, advisors, why don't you tell me how much rates could go up in 2 years so that I can break even? That's an analysis that is important to have all the time you're thinking about refinancing debt prior to when you can take it away from the investors. Now, if you have a bond that you can take away from the investors at any time and you're getting savings, then that makes sense. Why not do it? Because if you wait, you're just taking interest rate risk that tomorrow your savings could be lower. Those two things are important. And then as Jorge was saying, when you are looking at, and this is very common in unlimited tax bonds for school districts that receive state aid. So you may have, let's say, a 60-40 share, so 60 local, 40 state on debt service payments, and you're getting a pitch that says, hey, school, you're gonna save $1 million. Well, really, is it $1 million or 600,000? It is 600,000 because the other 400,000 go to the state. And then of those 600,000, how do you want to optimize it so that you have the best positive impact for your taxpayers? There's many ways to structure them. Do you want to get savings next year or in year number 10? So you have to talk to your advisors to say, okay, what is the best structure based on my facts and circumstances, including state aid and whatnot. So Romalda, that's something that we would advise everyone to consider.
Great. Any questions from anyone else? What kind of support does Hilltop Securities provide to school districts if they want to get groups involved as part of the transaction? I guess, can you share some thoughts on that?
Repeat that, please.
What kind of support does Hilltop Securities offer to districts when they're going through a transaction? Do you get them involved in transactions? Can you share some of that?
Sure. And I want to just speak for us. I don't want to speak for everyone here that is always also in the business. But what we would do is we can serve in two capacities. So as I said, we can be the financial advisor, and you may have a financial advisor that you rely on, and you have to work with them to make sure that whatever transaction you're doing is in the best interest of the district. Now, the other thing that it's done is on the bond underwriting side. So what we can also do, and there's many firms that do this as well, is support school districts by purchasing the bonds. So not necessarily providing any financial advisory services, but saying, okay, we will be here to support you and take those bonds in whatever market conditions so that we can disseminate those to other investors. And why is that important? It is important because that means that you have funds for your project. Then there's many other services that different firms provide, and I'm sure you're familiar with them. There are ancillary services for related to debt, which is investment of proceeds or just monitoring tax compliance.
Anyone? Anyone, any questions? I guess everyone's still asleep.
Okay. One of the best transactions that I've ever participated in was for a school district down here in the Rio Grande Valley. And what we did, this was 8 years ago, if I'm not mistaken. What we did here was that we coordinated with the finance office and superintendent's office of the school district. And this is something y'all may want to replicate at some point. And we invited some of our high school students that were leaning towards a financial career, whether it was accounting, finance, economics, and they had good grades. So we invited them to participate in a bond pricing process. It took all morning. We cited them at 8 in the morning and said, okay, let's sit down and go through the financial markets discussion. And so they could take a look at what was happening live and sit down with the bond underwriters, the bond attorneys, the financial advisors, and just go through all of the bond pricing process. And then when we had some quiet time in the interim, so when bonds are being processed for orders from investors, then we would go through some of the items that we discussed here earlier, so they could get educated on how they could in the future serve their school district and understand it better as a future taxpayer as well. In the end, it was a successful refinancing transaction for the school district down here in the Rio Grande Valley. There were millions of dollars of savings, and we prepared these 10 students to make the presentation to the board. So they worked with us on putting together a PowerPoint, and then they stood up in front of the board at the meeting, and they made the presentation. And then as a token of their appreciation, we put together a bond that doesn't happen anymore because it's all electronic. But we made a printout of a municipal bond so that they could take it home and just have it as a token of their appreciation for the help that they provided to the transaction. Romuald, I don't know if you want to get more into that.
Unfortunately, the bond environment has become very difficult. I'm sure a lot of you received the notifications from Josh, so it seems that it becomes harder to get a bond passed. And it's becoming very challenging. So we're gonna, aside from them presenting, we're also gonna have a bond legal counsel present on some of the bonds. So what options do we have when the bonds do not pass? There's other options, but unfortunately, it's gonna take away resources from MNO or from your general fund to support some rehabilitation of other improvements that may be needed at your school district. And so it's very important that we are cognizant of what other options we may have so that we can continue providing the needs to the school district. And so I've several districts down here, North Hilltop Securities, they used to be First Southwest. I learned of that firm when I was in McAllen School District and Linda's office, particularly Linda Romero's office. And that's how I got to learn about them. And when I was in Mission, well, Connie was there at the time, and First Southwest back then was the vendor, was the financial advisor. So we continue using their services, and we went through a lot of very challenging transactions, including a public facilities corporation, which is a very complicated transaction to understand and to execute. And so that did not materialize because it's very strict on the funding. You cannot exceed it. And unfortunately, at the time, we exceeded the construction project by a couple of $1 million than what we had published. So when it comes to financing, I guess some districts have also gone through stadium scoreboard projects. So when those come into the picture, I also relied heavily on the financial advisor to look at options to see what was most effective, whether to actually do a lease purchase or to actually finance it internally with general fund. And so those are some of the things that sometimes vendors will tell you, well, we can finance it for the district and what have you. And my first response would be, no, we do have a financial advisor, and any financing needs for the district, we run it through them. And so in that respect, I guess whatever process you have in your district, and if it's working for you, continue doing what you're doing. But if you sometimes when it comes to borrowing, that would be one of the professionals that I would always reach out to, like, this is coming up, what are your thoughts on this? And that would start the discussion, of course. I don't know if you remember, many moons ago, we had a basketball meeting, and I think we had Frost at that time was the one presenting. And they were the ones sharing that they had worked for a school district, and they included the students in their transaction, actually. So I like the idea. I picked up that idea, and we ran with it. And I told back then the team, I said, how can we incorporate the students? So we did work closely with CNI for them to nominate from the different high schools, or dual enrollment students, the ones that were going to be graduating. And the students took so much pride in there. And it seems like we sometimes in the finance side, we don't contribute directly 100% to instruction. We do it on the back end indirectly. But it was such a nice experience to have the students actually witness the whole transaction, and at the end presenting that to the board. The board and the superintendent were very appreciative to see that the students were actually the ones, presenting and making all the presentations there. I wish they could present everything that we bring forward to them, right? But then we wouldn't be needed at the district. But I was there and so was the team for any clarifying questions from the board, but you just could see the faces of the students. They were proud that they were the ones presenting and they took pride and they owned that project when it was brought forward to the board. So just some food for thought as you plan your next refinancing or any other transaction that you may have. If we can include the students, why not? I think that we would be at the next level, you know, in our career there in the business office, finance office, or whatever role we play at the school district. So are there any questions with that? Another one, Connie. Another one that is very critical, you know how there's energy efficiency projects out there, and David Marks talked about that. When that came to my attention, I told them, I don't do financing with outside entities, I go through them. So they were critical in my previous role to help me assess, you know, is this a cost-effective project that we could finance? So had I not reached out to them, you know, we could have probably done some financing elsewhere and it would have cost the district a significant amount. So they were a great asset to help me analyze that project. Yes, ma'am.
Well, I think, you know, it's awesome that you included the students. I mean, I think that's really great. I think the majority of the time we do not. I went to a presentation when Edinburgh was trying to sell their bonds, and I would have much rather have heard from students versus a couple of administrators. And there were some board members in the audience, a couple of them. And sometimes it's even a divided board when it comes to bonds. But I would highly recommend for those of you that are going to try another bond issue or sell it, get the students involved with the students showing pictures of the campus or why they need the bonds and the dollars involved. And the students still at the high school, Rumalda, maybe even students at the elementary school, because of course our kids are sharp, maybe, you know, just recent graduates that knew that they sat in those crappy whatever buildings for, you know, 4 years or X number of years, right? I'm retired, so I can say a whole bunch more now. No, no, but I really loved it. I loved what you just, you know, shared with us that you did in Mission, and of course you two gentlemen. But, you know, students, the more we can get them involved, I think it's a lot easier for folks to say no to an adult versus a child, especially a child that, I mean, God, they're our future, right? And the old, I don't want to pay more taxes. Well, you know, if you bought property, then be prepared to pay taxes forever. You know, it's not going to, well, it hasn't killed any of us yet that I know of. I mean, offhand type of thing. So I just wanted to say, I love that idea. And I think, especially for bond issues, get more and more and more kids involved and the parents and so forth. Anyway, Lori, you better take this away because I just keep.
So just to finalize, they did go through an educational session. Andre went through what is a bond and what does it take. So he went through the good, the bad, and the ugly, como quien dice. So it was, at the end of the day, it was a great experience, and we were supposed to have some PR in there. It didn't happen, but it doesn't matter. We're not here for the show. We're here to make an impact on the students. And we could just see in their faces how proud they were when they were presenting before the board. They were prepped and what have you. And yes, I mean, who else better to represent the needs of the school district than having our own kiddos, you know, coming, you know, stepping forward and doing that presentation for the board. And so just food for thought, if that's something that would interest you, I can share some pointers, but for sure, this is our payback to our students more than anything. Okay, so I'm gonna zip it there because we have another presenter. Any questions, anyone from either Mr. Andre Ayala or Jorge Delgado? You just have to make sure that you trust your financial advisor to give you the best advice. I was very, very lucky and very blessed to have them by my side for the most part. Every single controversial item, like, hey, what are your thoughts on this? And we would rehash and back and forth and what have you. But you only know when, I guess you know when you need to reach out. Any questions, any final thoughts? Andre, Jorge?
Thank you all for having
Okay.
us. Appreciate your time.
Well, thank you, gentlemen. Just so you know, they came from Dallas. We don't need to go to New York to sell the bonds, right? Unless you have another budget out of pocket or something. But they're in the Dallas office, so everything for the most part takes place in there. Any questions? Okay, so then we're gonna move on to our next present. I know. We have a 10-minute break. Do you want to take a 10-minute break? Yes, no? Okay, wake up. Yes, okay. Quick 10-minute break while our next presenter is gonna be Humberto Ayala. He's bond legal counsel with Escamilla and Ponik. This is a firm from San Antonio area. So he will have some great news, I guess, awareness, because you may be personally liable. In this case, you're not protected. Okay, we'll be back shortly. Thank you.
Okay.
Okay, good morning. How are you guys? Guess I have instructions from Rumalda to get started here, so we'll get going. Thank you very much for having me. My name is Humberto Aguilera with the law firm of Escamilla and Panic. We are headquartered in San Antonio, have offices throughout Texas, an office in Mexico City and an office in Louisiana. But we mostly, my particular practice area is public finance, so bond counsel or underwriters counsel. My entire practice is devoted to that, so that's what I do 100% of the time. Today, I wanted to go over just focusing on bond elections and particularly some legislative updates. In the last couple of sessions, we've seen some pretty dramatic changes affecting bond elections. And also, when you sell the bonds, most of the bonds from a bond election, what we call general obligation bonds, are sold in the open market. If you do that, you will be subject to federal security laws. So I wanted to hit on some of the high notes on that as well. Please feel free at any time just to raise your hand with a question or a comment. I enjoy the live feedback, or a lot of these presentations, it seems the better ones have been when the audience is participating and asking questions. So happy to address your questions as they come up. No need to wait till the end or anything like that. So actually, before I start with the recent bills here, I wanted to fast forward to this slide. It's real blurry, my apologies, but this was taken from a live stream on Tuesday. The Texas Senate committee met, and one of the items that they were discussing was specifically about bond elections. And I know it's incredibly hard to read that, but the gist of it is that we have seen a substantial decline in the passage rate of bond elections since 2020. And in 2019, that's the 2 legislative sessions ago is when we started to see these dramatic changes. I'll say significant changes to the laws affecting bond elections. And I think that's part of the reason why the Senate Education Committee wanted to hear hear from experts about this topic. But this graph demonstrates that, previously bond passage rates were upwards of 80%. I've seen, one of the things is it's kind of challenging to really get a good number on bond election passage rates. There's really no uniform place. We're not required to send, notices of elections to the Secretary of State or anything like that. So I've actually seen passage rates being estimated upwards of 80%, 85%. And now I've seen a down low as 40% passage rate. This information that was presented to the Education Committee is showing a 50.7% passage rate. So whatever data you're using, I think the consensus is that we're seeing a decline in the bond passage rates. So going back here, I wanted to give you the legislative update. So what's happened in the last couple of years since 2020? In the 2 legislative sessions ago, SB 30 passed, and this was a pretty unanimously voted in the Senate 31-0, House 137-5, had 15 Senate authors, and it was a substantial change. It called for ballot language requirements in bond elections to list specific purposes in the bond election. So you probably recall your districts, many districts would utilize one bond proposition: construction, renovation, and equipping of school buildings, purchase of sites thereof. And it would be one proposition. Well, now we have to carve out particular categories of projects. Those categories are so you can still do a general school building proposition, right? But any of these next 6 categories must be carved out. The first is a construction, acquisition, or equipment of a stadium with a seating capacity of more than 1,000 spectators, a natatorium, regardless of size. And number 3, which has created probably the most confusion and the most questions, is a recreational facility needs to be carved out as a separate proposition. But if you notice the way that the law is written, and this is verbatim from the statute in the Education Code, Chapter 45, it says construction, acquisition, or equipment of another recreational facility other than a gym, playground, or play area. Well, in a way, that's really good news that a gym is carved out of the recreational facility category. But the way that this law was written, it suggests, and the Attorney General's office takes the position, that a gym, a playground, and a play area are indeed recreational facilities. But the law provides that we can have those particular recreational facilities still in a general school bond category, school building bond category. So that has led to the Attorney General's office providing guidance to us and to other bond counsel that recreational facilities could include things like practice fields or field houses. Field houses in particular have been kind of a challenge. I've learned that field houses means many different things to many districts. There's kind of not a uniform definition of what constitutes a field house, but I can give you an example. For one of my clients, wanted to construct a field house that had locker room facilities. It had a wrestling mats for the wrestling team to practice. It had a cheer practice facility and storage, and it even had coaches' offices. So that was a field house project that this particular school district wanted to do. Sounds like a school building to me, and I've been doing this for 15 years, and before this particular bill, I would have told you that's absolutely a traditional school building. The Attorney General's office took the position that that's a recreational facility. So a project like that type of field house would have to be carved out under a separate proposition. We've seen a lot of pushback on that, and I think there are, potentially some movement away from having such a stringent definition on recreational facilities, but that's currently where we stand. The other categories, performing arts facility has to be a separate proposition. Any teacherages, which is housing for teachers, has to be a separate proposition. We actually, some rural districts are probably familiar with those type of projects. We've done that for some of our rural school districts, but more suburban and urban districts are probably thinking, what, housing for teachers? But we've actually done some of those. So that would be a separate proposition. And then any acquisition or update of technology. So technology equipment has to be a separate proposition. The big caveat there is any technology equipment used for school security purposes can go into that general main school building proposition, and so can any technology that's integral to the construction of a facility, of a school facility. And again, that's verbatim from the law. So we've had a lot of questions about that as well. Well, what is integral to the construction of a facility? But the AG's office has told us that things like, Ethernet wiring that runs through the building or smart thermostats, things like that would be considered integral to the construction of a facility. HB3, everybody remember HB3, of course, from a couple of legislative sessions ago, led to notably the compression of the M&O tax rate. Well, in HB3, this monumental school finance bill that passed 2 legislative sessions ago, it contained a provision that says the following language must be included in all bond propositions, and it's in quotes and it's capitalized, which means we have to have it capitalized on the bond proposition. And it reads, "This is a property tax increase." So the typical bond proposition that you'll read, you'll go to the ballot booth and you read the ballot. It says, do you authorize blank ISD to issue bonds for the construction, renovation, and acquisition of school buildings? And that's where our typical language would end. But now, immediately following that, in all capital letters, this is a property tax increase. That's been a challenge, particularly for school districts that, with the assistance of their financial advisors, have carefully crafted debt service schedules, and over the years have strategically put their pro forma debt service schedules in a way that you could keep your property tax rate level. And that's a big communication piece that a lot of school districts use to educate their voters that, yes, we're doing a lot of large projects here, but we have done the work. We've been fiscally conservative for many years, and we've thought about this. This is part of a long-range debt schedule, and we have calculated this to not include a property tax rate increase. You tell that to the voters, and then when they go to the booth to vote, they see this last sentence in all capital letters. So that's led to some confusion, I think, and it's definitely a challenge for a lot of our clients on that communication piece. To the point that those two, particularly the HB3 provision, we've seen. This is the San Antonio Express News in Bexar County. This was in 2021, so a year after the law went into effect. all of the school bond elections in Bear County failed, every single one of them. And you can see from this headline that the ballot language was blamed for the bond failures in 3 Bear County school districts. The Express News also pretty explicitly came out with an editorial more recently. This was in April of 2022, so right before the May 2020 elections, stating that the students losing as tax language lies to voters. So there's a lot of pushback on that. But I see a question.
Well, and maybe you're going to get to it, but can't, and so on the ballot, can't the district say, this is the language that's required by the law, but this is the fact? This,
Yes.
you know, anything to that effect, or how could they work around that? Because as soon as you brought that up, I thought, well, that's a lie in some cases. I mean,
Yep.
in some
In
places.
some instances, right. Yeah, and that's, this editorial actually, it contrasted 2 school districts in Bear County. One was Northside and one was Harlandale ISD. And it said Northside was projecting no tax rate increase, but Harlandale was. And they were clear with the voters that they were projecting a significant INS tax increase. But to your question, unfortunately, the answer is no. On the ballot language, there's very specific laws related to what can appear on the actual ballot. And it used to be, we were required to say that, yes, we had to levy a tax in payment thereof. That was included in our standard ballot language. But with respect to the ballot, because it was placed in quotes in the election code, or in this instance, the education code, chapter 45 again, you have to include that verbatim, and the Attorney General's office, through an all bond counsel letter, which is written guidance to the bond community, said that language cannot be modified. Having said that, can you put out education pieces, explaining that we're required by law to state this is a property tax increase. However, here is how we view this. We are projecting a flat rate. This is what goes into our projections. You absolutely can do that, and school districts are doing that. So I've already showed you this slide that I skipped forward to, but we're definitely seeing a decline in the amount of elections that are passing. HB 477, this required districts and other governmental entities to put together a voter information document. This does not appear in the ballot, but it has to be placed in a prominent location at each polling location. And some of our clients, they have a joint election with a pretty large county, even though they may be a smaller school district. If they're in joint election with the county, they have to provide this voter information document. They have to provide enough copies to the county so that they can post it prominently at each polling location. And the information that it includes is the proposition language, and also various calculations that need to be run to inform the voters of different scenarios. So they want, the total principal amount. Well, what's the estimated total interest on those debt obligations? What's the combined principal and interest to pay those bonds that are being proposed? And then as of the date the election is called, so that February 13th date, I pulled this from an ordinance or an order that we put together, but this would be as of the date that your election is called. Well, how much debt is outstanding, and what's the total principal amount? What's the total remaining interest on all of your outstanding debt? And then what would be the combined outstanding debt if this bond election were passed? So again, this needs to go on at a prominent location at all your polling locations. I might be the only one who actually asks for it to see it, because I'm the one who drafts them, and I want to review them, and I get kind of quizzical looks whenever I go up to the people working at the polling location, say, can I see the voter information document? And they kind of give me a look, but they are posted. It's supposed to be posted prominently. Where I've seen them mostly is at the front desk. They'll have a copy of it there, and they can hand it to you. But it has to be there. It has to be on the district's website. Has to be posted physically in three places in three public places, and also where you post your notice for bond election. For board meetings. Let's see here. Also, just some more. You have to post your sample ballots. Another one is the weighted average maturity of the bonds cannot exceed the weighted average economic life of the improvements of the personal property financed. And this was already a federal tax law, but it's now also part of the state law. Also part of HB 440, unspent proceeds. If you're going to repurpose what the funds are going to be used for, let's say you went out for a bond election for a new high school and you have $2 million left after the construction of the high school, you typically can have the discretion to use those leftover proceeds to, one, pay down your debt, or two, explore another school building project. Well, now with HB 440, if you're going to go into, let's say, if you want to build a performing arts center with that extra 2 million, you'd have to have a public meeting and it had to be a separate board vote. And that's actually a little less stringent on school districts. For cities and counties, they have to go to another election before they could use those leftover proceeds for another purpose. So that's also new. And I just wanted to bring to your attention, this was on Tuesday, the Senate Education Committee had a hearing about, particularly about bond elections. And actually the month prior, or either March or April, they also had one. And all of this is to say that I feel that this is definitely on the radar of the legislature, certainly, and also at the top levels of state government. You'll see the Texas Attorney General's office, the governor's office, the comptroller's office. And on that note, actually, I don't know how many of you have already heard of or seen the anti-boycott provisions related to you can't boycott gun manufacturers, you can't boycott energy companies, can't boycott Israel. Those anti-boycott provisions do affect any contract over $100,000. So when you're selling these bonds in the open market, your underwriter gets a substantial fee for selling that. Your professionals do too. But the banks that underwrite bonds are kind of the target of these anti-boycott provisions. So if you're selling anywhere, just conservatively speaking, around $20 million of bonds, it's likely that the underwriter may or may not be approaching that $100,000 threshold and the fee that they get. So because of that, with the new provisions in law, we have to seek verification from those banks that they don't boycott gun manufacturers and they don't boycott energy companies. So the older law is the anti-boycott provision of Israel. And we handled that fairly straightforwardly and easily in the bond purchase agreement, which is the contract between the bond underwriter and the district. We simply asked them to certify to us in the contract that their company doesn't boycott Israel. They signed on the dotted line and we were done. With the anti-boycott provisions of gun manufacturers and energy companies, again, going back to that heightened scrutiny that we are seeing from the legislature and the highest levels of state government on bond issuances, we are actually seeing the comptroller has recently compiled a list of banks that it believes may be boycotting energy companies. And on that list of various banks included some pretty large bond underwriters that are responsible for a substantial portion of the bonds being underwritten in the state of Texas. The comptroller's office put together this list. I'm gonna check on my time here. Yeah, the comptroller put together a list of companies that it believes may be boycotting energy companies. And on that list were banks that had these ESG funds, these energy, social, and governance, I think I'm getting that right, funds that are pretty popular right now. It's kind of a newer investment trend where people want to invest monies in green type projects or projects that are socially aware or that relate to governance issues. The comptroller's office is saying that may be boycotting energy companies. So he's asked these banks to respond in writing how that isn't boycotting energy companies. So currently we have some banks that are I would say maybe in a limbo state that have been identified by the comptroller as potentially boycotting energy companies. So be mindful, and that applies to any contract over $100,000. So anytime you're looking at a contract valued at over $100,000, be mindful of those anti-boycott provisions. Just very quickly, I'm sure you all are aware, if you're planning to call a bond election, it's a lot of planning ahead of time. Starting off with the calling of the bond election, that has to be 78 days before election date. So in May elections, you're looking around February 18th. For November elections, you're looking around August 22nd. So when you call the election, you've already gone through discussions of what your facility needs are. You've kind of priced, what you think the propositions are going to cost. You've gone through the exercise of now segregating projects into different propositions. So all that to be saying that, a lot of times we'll see these bond elections being planned out 18 months prior to the actual election date. And we've seen them, a lot less than that too. But this is definitely some substantial planning. There are a whole host of election law requirements related to notices and specific documents that need to be prepared and posted in various locations and physically posted, published in newspapers, posted on the website, given to particular governmental entities. Like you have to give a notice of election to your county clerk, and they had to post it on their website. So lots of requirements. Definitely encourage you to work with your professionals in this area. Your bond counsel will certainly help you with all the legal requirements, financial advisor to help you find out what you can afford. Your architects also play a role in giving you a good estimate as to how much money you need. And wanted to touch very briefly on the subject of political advertising, and particularly the state law prohibition of using public funds. I'm sure you all are pretty aware of that. Can't use public funds to advocate for or against a bond election. And it gets tricky sometimes. This is one of our big projects. When we have clients calling bond elections, we ask to review all of their election material, all of the educational pieces. And we've seen some clients get pretty sophisticated these days. Now we're seeing social media posts that they put out, and we're seeing drone footage of particular plots of land and 3D renderings. And we asked to review all of that because you can unfortunately sometimes fall into a trap of thinking that what you're saying is factual, but it actually goes into the realm of advocacy. A lot of the, well, here are a couple of examples. Like, good schools are the foundation of a good community. That's actually from an ethics committee enforcement action where that particular phrase was used, and they deemed it to be advocacy, or every child deserves a good education. Things like that can be deemed to be advocating for an election. You also can't list, who supports. The mayor of San Antonio supports the bond. Nope, that's impermissible. Or put children first, things like that. So takeaway on that point is just to make sure your bond counsel or other legal counsel is reviewing the information. Typically, there's not an extra fee associated with that. I know for us, we do not charge to review those materials. And there's even as recently as just this last election cycle, we saw the Governor Abbott tweet about a principal at Northside ISD in Bexar County who asked her staff to, it was a principal or a counselor, I can't recall, but asked her staff to go out and vote. We need your support. And the governor tweeted out that he's spoken with the education commissioner, and that if the posts are verified, then it's likely a crime. And these violations are indeed crimes. I believe they're Class A misdemeanors. We typically don't see criminal enforcement of these types of violations. We usually see monetary fines, but they are indeed a crime. So something to keep in mind. So I wanted to pause there before I go into the federal security laws category. Any questions so far? Very good. We'll proceed. So the next category that I wanted to discuss with this group is compliance with federal security laws. So again, oftentimes when we pass bond elections and we go sell the bonds, you have the option that you could do what's called a private placement and sell directly to a bank. Or what we more typically see with bond election, general obligation bonds, is you sell those bonds on the open market. You engage an underwriter, either through a negotiated deals, you engage the underwriter ahead of time, or a competitive deal, you actually the underwriters bid on the bonds, and then that's when the relationship is formed once you award the bid. But either way, with either competitive or negotiated sale, because you are enjoying the benefit of the open market, which presumably is providing the district with a better interest rate, because you are enjoying that benefit, you are subject to the federal securities laws. Now, municipal bonds are generally exempt from the registration requirements of the SEC. So unlike corporate bonds or stocks or other security offerings that are subject to a whole host of requirements, school districts, cities, counties, when they're issuing their municipal bonds, are largely exempt from all of those requirements. However, there are two key components that are still applicable to public municipal bond issuers like public school districts. One is the anti-fraud provisions are still applicable to school districts. So what's anti-fraud? In a nutshell, we're looking for, as the name suggests, no fraud and no deceit. And additionally, no untrue statements of a material fact or an omission of a material fact. So that's really important there. And this is applicable to when we put together offering documents, that there are no omissions of a material fact and no untrue statements. The second component of federal security laws that are still applicable to school districts is Rule 15C 2-12. And what Rule 15C 2-12, that's a really important rule that your financial advisors, bond underwriters are particularly sensitive to. And it's an important rule because we've seen an uptick in enforcement activity from the SEC related to these. But what Rule 15C 2-12 does, it's actually a requirement on the bond underwriter, but you get looped in because they require the bond underwriters to enter into a contract with you that will ensure a production of an offering document. That's the preliminary official statements and official statements that you work on. And also, the underwriters are required to enter into a contract with you to contractually obligate you to have continuing disclosure And I wanted to explore both of those topics in a little bit more detail. So again, that offering document, this is comparable to a prospectus for stocks. When you're looking at a particular stock or a mutual fund or an investment vehicle, you look at a prospectus. This is the municipal bond equivalent. You'll probably hear the terms preliminary official statement or a reoffering memorandum. And again, you can kind of see by that table of contents the variety of information that we provide to the open market, to the potential investors. You give information about the district, who's on your board of trustees, what's the plan of financing here, what are the bonds going to be used for, and then we give some information about the permanent school fund guarantee, which is of utmost importance to the potential bond investors. And fortunately, that is produced by the Texas Education Agency. So fortunately for that, we use their language. It's routinely updated. We do need to ensure that it's the most up-to-date information, but that comes from TEA. And then we give a whole host of statistical information on the district, your tax valuations, debt history, tax rate levy histories, information about your largest taxpayers, overlapping debt of other governmental entities. So a lot of financial statistical information is provided to these investors as part of the offering document. So again, we go back to that anti-fraud provision, right? The anti-fraud provision says no untrue statements of fact or omissions of a material fact. Well, the untrue statement of fact is pretty straightforward. I mean, you review, and as chief financial officers or finance officials, you'll generally be tasked with reviewing this document. It's pretty easy to spot a lie if something's wrong, but what becomes more difficult is a material omission. So what is a material omission? We typically advise our clients, and this has been in some enforcement actions and in case law, that you need to provide anything that a prudent investor would want to know. So you put yourself in the shoes of the investor. If I want to buy blank ISD bonds, what do I want to know about the district? If you know that there's a projected budget shortfall that's coming down the road that nobody's talked about yet, but it's going to be substantial, it's going to be difficult, it's not captured in your audit, well, there's no untrue statement about that because we don't talk about it, but that could be a material omission. And remember, we'll get to it later, but you can be held personally liable for any violation of the anti-fraud provisions. So going back to Rule 15C2-12, again, the first component is you've got to produce a prospectus, the preliminary official statement. You have to produce an offering document. The second component of that is you have to enter into a continuing disclosure agreement. And what the continuing disclosure agreement calls for is annual reports. So on an annual basis, you'll submit your audit typically, and also those various tables that we went over, those tables need to be produced on an annual basis as well. And you'll also have to produce event notices. So these are triggered by particular events. And I've listed all 16 of those events. The first 14 events are things that your bond professionals, your financial advisors, and your bond counsels are typically going to be involved with. So if you have a principal and interest payment delinquency, you've probably already called your lawyers and you probably already called your financial advisors, and they're keenly aware of that. Same things with bond calls. If you're refunding bonds or if you want to defease bonds, your FA and bond counsel are involved, and we will help you put together those event notices. Items 15 and 16 are the most recent changes to the continuing disclosure undertaking requirements, and that is the incurrence of a financial obligation if material. So you have to report the incurrence of a financial obligation. Well, sometimes your FA or your bond counsel isn't involved in the incurrence of a financial obligation. So a major takeaway that I would share with you all is that if your bond counsel or financial advisor is not involved in a particular financial obligation, just run it by them anyways. I heard Romualdo when I walked in late here, say that's probably a good idea anyways, just to kind of pick the brain of your financial advisor in terms of whether or not we're getting a good deal. But also, if you do end up going through with that deal, even if your FA and bond counsel isn't involved, you need to let them know, because we may need to file an material event notice on that financial obligation. And the same thing goes on event number 16. If you have any defaults, events of acceleration, termination event, modification, or any similar event related to those financial obligations that reflect financial difficulties, then you also need to file a material event notice. And again, that can be done through the assistance of your financial advisor and bond counsel. Where are those event notices filed? Those are filed through the MSRB, which is the Municipal Securities Rulemaking Board, through their EMMA system. That's available online. I encourage you to take a look at that system if you haven't already. It has some pretty interesting information. You can see how your bonds are being traded, how often they're traded, if they're being held on to, and also that's where potential investors and current bondholders go to see these event notices. So let me see here. I think we're doing pretty good on time. I want to confirm, Romualdo, we have till 12 or?
12:10?
12:10, perfect, okay. So COVID-19 has had an interesting effect on these security law requirements. The former SEC chair, Jay Clayton, and also Rebecca Olson, who's at the Office of the Municipal Securities, they issued a public statement to encourage municipal bond issuers like school districts to provide additional voluntary information regarding the impact of COVID-19 on your operations and financial condition. And they did this with corporate bonds as well. And typically when the SEC urges or recommends an action, everybody jumps and does it, but we actually have not seen universal adoption of this of the recommendation to file these voluntary filings about how COVID-19 has impacted districts. We have seen this for some what would be quote unquote riskier credits like retirement homes, hospitals, airports, student housing. We have seen some filings related to COVID-19, but not really with the Texas ISDs. And part of that might be because these are general obligation bonds backed by an unlimited tax pledge that's additionally guaranteed by the PSF. But we haven't really seen that. But just to note, the SEC does recommend that we keep investors up to date on the impact of COVID-19. What we have seen to that effect is a near universal adoption of disclosure language in that offering document. We do have a section devoted to the impact of COVID-19. So not necessarily an event filing where we do a voluntary filing of the impact of COVID-19, but when we go out to sell the bonds, we do make sure that we have a provision related to how COVID-19 has impacted the district. And part of the process, the underwriters, again, with the Securities and Exchange Commission rules, they have an obligation to conduct due diligence on the district and kick the tires a bit about your financings. This will typically be done through a due diligence conference call, which many of you have probably participated in. And they'll ask a whole host of questions. And invariably, we also are seeing specific questions related to COVID-19, particularly, how has it affected your budget performance? How are you budgeting in light of COVID-19? How's it affecting enrollment? Any funding concerns? How's it affected your operation? And we used to see when TEA was having their instruction models, permitting virtual learning, we would see questions about that, but that's no longer as much of an issue. So before I open it up to questions, I did want to conclude on the liability with these SEC rules. So again, the anti-fraud provision, no deceit, no fraud. Those offering documents, which are vitally important to the market, no untrue statement of facts, no material omissions. So how could a violation of that? So again, let's go back to that example of, that there's going to be some budget challenges. It's not out in the public necessarily, or maybe it has even been in a board meeting. You've discussed it, but it's not captured in your audit, and it's not captured in the fairly standard language that we put together for bond offerings. There's a potential material omission there. So let's assume for the moment that that was a material omission, and you knew about it and you didn't do anything. What could be the liability? Well, you could have an investor action for damages for reckless or intentional action. So if you intentionally did not want to include that information, an investor who buys the bonds, and then a year later, when you do indeed face financial difficulties, declare financial exigency, your ability to make payment on the bonds is drawn into question, those individual bondholders could seek an action against the district, and again, you personally. You could have what's more typical is an SEC enforcement action. And again, the SEC has an entire division devoted to municipal bonds, to bonds like the ones that you issue. And we have seen an uptick in enforcement action by that relatively newly created division. So they can seek an enforcement action against you, and they can impose monetary fines. They can pose injunctions. They can say you are prohibited from working on a municipal bond deal for however X many years, or for the rest of your career. They can get that through an enforcement action. And if you're a CFO of a school district, it's going to be kind of hard to find a job if you are prohibited from participating in a bond offering. So liability covers all statements connected to the purchase and sale of a security, including statements that are reasonably expected to reach investors. So it's the most clearest example of information that's going to reach the investors is that preliminary official statement, those offering documents that the underwriters literally give to the potential investors. So that clearly is going to reach investors, but so could public statements or information on your website that could be deemed to potentially reach investors. And as I've tried to emphasize, it's not just the district that gets that has this liability, it's personal liability as well. And you may think, well, gosh, I've never heard of that happening. There's no way it could happen to me. I just briefly wanted to share with you, this is from March 16th, of an example of a CFO in the Houston area who was indeed found to have violated the anti-fraud provisions and was assessed a $30,000 penalty and was barred from participating in any future municipal security offerings. That was back in March, and that related to a omission. This district, and it was a smaller issue. It wasn't a huge, hundreds of $1 million issue. It was a smaller issue. And these bonds were backed by the permanent school fund guarantee. So if I'm an investor we've got the backing of the state. There's a really slim to none to zero chance that they're going to miss their payment. The state guarantees the payment of the bonds. Typically, when we see all that, you find comfort in that, and we should. But this is a great example that even with PSF-backed bonds, even if it's a small issuance, that the SEC is looking at these things, and they do random audits as well. And they discover what they felt was a material omission. In this case, the district ended up going through some budgetary problems. They had to do, I believe they declared financial exigency, which led to substantial layoffs. And the audit had not captured that information, and it wasn't disclosed anywhere in the offering document. So the CFO was assessed $30,000 penalty, barred from future municipal security offerings, was fired by the district. Superintendent resigned in connection with all of this. So it's substantial. So I just want, when you're going through that bond process and your financial advisor or bond counsel hands you that offering document, which is, a pretty substantial document, make sure you're looking through it and make sure that it captures anything that a reasonable investor would want to know. And that's a takeaway I want for you guys to have. Again, when you're reviewing that document, what would a reasonable investor want to know? Put yourself in their shoes. If you're wanting to spend your hard-earned money, your retirement money, to buy these bonds, what would you want to know about that district? So I wrapped up a little bit early. I think we were a little early here, but I addressed the uptick in enforcement actions. And since we have a little bit of time, I will address this as well. One way to ensure that you don't have any of those enforcement actions, or that you're disclosing what you need to do, is through the adoption of a disclosure policy. And this is something that we've actually seen the SEC encourage. And they've referenced disclosure policies in practically every enforcement action against an issuer. They've either cited a poor disclosure policy as a cause of the violation, or they have imposed the adoption of a disclosure policy as a settlement term, or they've also seen that the post-violation adoption of a policy as a factor in reducing the punishment. So I'm part of an association. It's called the National Association of Bond Lawyers. They put out a really, really helpful guidance on this matter. And they've laid out a two-step process for drafting a disclosure policy. Step one would be to determine whether or not a policy exists. And the closer the policy is to your existing practice, the more likely it is to be followed. So we always encourage that. So the first step is to take a look at what you're currently doing. What's the current process? It's probably just your financial advisor telling you to read something, you read it, and you provide any comments, and that's the end of it. And that's okay too. That if you have someone with district-wide knowledge reviewing the offering document, that is good. That could be part of the policy. Step two would be to see what kind of enhancements you could make. Well, how can we make the disclosure better? Well, maybe I don't know everything at the district. I have a pretty good sense if I'm the CFO or in the finance department, but maybe I should get, somebody else involved, a procurement officer, just go straight to the superintendent. Maybe a board president would be important in some communities. And also to ensure that district personnel are adequately trained and informed of what the SEC requirements are with these anti-fraud provisions. So with that, I'll conclude there and ask if there are any questions.
Anyone questions? Did you mention that they also let go the superintendent for that school district?
Yep, so they also let go of the superintendent. So it wasn't just the CFO, but the superintendents as well. That there, we've always said that, there is this division in the SEC that focuses exclusively on municipal bonds, and we've seen the uptick in activity. But we've always said that, but now we have an example that hits pretty close to home. So it's absolutely important to ensure that we're having the best information out there to those potential bondholders.
So I just want to go back real quick to the state, and I'm going to try and tactfully say, to the state being okay to lie on the ballot versus the federal saying, if there's anything that looks like a lie, you can't do it. So what do you do with that with a client that literally didn't have to raise tax rate because their values were going up, but the ballot has to say that. But on the federal side, you can't be lying. So what, I'm just
It's-
wondering.
Yeah, so it's definitely, a challenge. I think that with respect to the education material, we've seen substantial efforts being made to explain why the district feels that there wouldn't be a tax increase. And, that it has, we've seen, town hall meetings, pamphlets, information on websites trying to explain that piece. I will say the Senate Education Committee met on Tuesday and they discussed precisely this issue, and the bill's author was on the committee, and it seems to me that they are cognizant of this disconnect. I think you'll hear the author of the bill explain that, there is still a tax increase, perhaps not a tax rate increase, but a tax increase that would be required to make payment on the bonds. But, that is distinguishable from a tax rate increase, and is also apart from the property assessed valuations, which districts have nothing to do with. When your assessed valuation goes up, your taxes go up, of course. But I think, in that discussion that occurred on Tuesday, I think there was some acknowledgement of a potential disconnect, and there was, I think an effort there to address that. I think that there was an emphasis there on ensuring that voters have all the technical tax information, and they want to find a way to present that to the voters. So I guess the answer there is stay tuned, and let's see what the legislature does to address that. But it seems to be an item that is on their radar and that they're looking at.
Any further questions? Connie? Anyone else?
I'm just curious, how many people have called a bond election since 2020, or starting in 2020, May 2020 to today? Yeah, so all of these changes are going to be new to you then. So if you haven't called an election since May of 2020, that's when the laws first kicked in after the 2019 legislative session. So all of these will be brand new and applicable to you. Very good. I think it's time for lunch.
Okay, thank you, Humberto. Let's give Humberto a big round of applause, even though they wanted to throw tomatoes earlier. Remember, they're the messengers. Don't kill the messenger, right? Okay, so we're ready for lunch. They're ready for us as well. If you can just exit through any of these doors and just go, like if you're gonna go to the cafe and make your way out, eat at your own risk. That's all I'm gonna say. They're super delicious. And so when you come back, pick up your chips and soda, and you're welcome to come back to the room, or you can eat in our cafe. We're gonna start back at 12:40. I do apologize for having the agenda all over the place, but we were accommodating for presenters. So Josh is gonna be presenting at 2 based upon his request. We're also gonna have an energy update. What I'm hearing is that with the freeze that we had last year, that energy prices are up the roof, and some districts may be experiencing big increases in their energy. hopefully you do have a contract in place, or if you're gonna go out, that's something to consider. So enjoy your lunch and we'll see you back at 12:40. Thank you.
running this place for a while. Okay, so let me get it out. One thing we're just gonna put it on there, right? The presentation? Yes. The last place I went, I left my USB, and then they had to mail it to me.
We're just gonna download it there.
Region One Finance Council. And are you Christina? Yes.
¿No les gustó, verdad? I want to eat. Sí, ya la vi, ya la vi. Well, no, it's not her. Déjame comentar.
was up here somewhere, so, yeah, it's in my little folder. But, so today's, today's presentation is just a quick recap and then Gilbert wants me to go through each one. Turn that into that's the teaching material. I was like, oh, yeah, I'm okay with that. I'm okay with that. I said, but you also need, the farm, like North American, and then the farm is always being updated and stuff. So he was okay with that, but he wants the stuff. Okay. And then that's good. I just would like to have an opportunity to like, okay, let's powwow, how are we gonna do this? And I know I'm just there to help him, but that way I can be right, yeah, prepared to, yeah. I mean, whatever he wants to do or however y'all. So what I pulled for, and I know I'm copywriting stuff here, but I have the TDA, I downloaded, and I just focused on the procurement one, so the writing and supporting the procedures, so that was one that came up quite often. Just what's reasonable, allocable, and necessary. The maintaining compliance, that was with the emergency and basic procurement, and then about the cooperative procurement. So you think that's good? And I'm just gonna go through and I have all my notes from last month, so. Yes. Just kind of to highlight some of the points that. Yeah, I think so. It's gonna start, I think. It'll tie into up here. So I'll be down, I'll go away, and then you'll come back and. Right. I think it's something for us to do, like, learn what you have. Let's, like, and your procurement person. What are your local policies and your local policies? Todo. Let's just sit down, let's do a workshop where we actually do a hands-on, let's go through, let's make sure everything's there. We have the checks and around. Yeah, exactly. So we just all. Yes, they have oil. But are they gonna wanna make the time to do it? We have meetings, we have trainings. Cooking. Yeah, and see, that's what we, at least we put on our parts. Right. We identified that these were findings for us. And we have this special workshop too. We did 2 sessions, and then the thing about we could do this to make it more convenient. Like, what if we did something in the Laredo and like in the service in there and say, okay, so let's get Zapata, Laredo United, Red, Jim Hog. Hey, we're right here in your backyard, so you can, you can set up the free and you can do it in the back. I mean, that would be like a group too. Right. you know. But it will kind of break up the group too into smaller. So like over here, we can put some Brownsville, which by default is just a huge district, so they're always under the microscope. Yeah, yeah. Because anything they do is gonna. Yeah, it's so huge and so that would be, I mean, and we can kind of hit Sanford and then. That's our whole bunch of educating, making sure that everything is okay during the experience. Yeah, yeah. It was a big, like, you know, well, I think I'm gonna be. Oh, sorry. I know, didn't realize it. I mean, I literally like just got the thing, ate the thing back home. I told someone I didn't pick up the burger and take it to the back. I'd rather eat that burger. And I really like, no, I get the. Let's look at the, some dates and we can just do, we'll take the show on the road. Good afternoon, everybody. Whoa, mic's a little bit, I'm gonna put the mic down here. Welcome back to the afternoon session of Finance Advisory Council. I am your presenter for the next 15, 20 minutes. I hope you enjoyed your meal, and I know that the burger is amazing. It's like Mexican version of a hamburger. So my topic today is results of how we did this last season in child nutrition for the administrative review, procurement review, finance review. So it was, it was a pretty intense season. I do have to go through the acknowledgement statement and everything that I present or I talk to you about. So this administrative review and procurement, my update is related to the 21-22 school year. I'm not going to overshare. I'm not going to mention names of school districts or anything like that, but I do have one school district that volunteered their findings with me, that they were okay with me screenshotting and placing up here on the PowerPoint. The Texas Department of Agriculture combined these administrative reviews into one big review, and I call it the trifecta of reviews. Because in the past, we used to have administrative review and finance in one portion, and then separately, possibly in a different year, they would come back and do procurement review. Well, this procurement review went from a jot form, it went from an Excel spreadsheet to a jot form to all kinds of different formats until they finally got it semi-right, and they're housing this inside of Texas UMPS, which is the data management software that we have. So for this school year, the 21-22 was the first year that we did all three reviews, and it was crazy. It was a lot. And the reason it was a lot is because we were coming back from COVID. We were trying to recover, going back to traditional service. And there was a lot of flexibilities and waivers that were filled out. So, we had to navigate this whole new way of doing things. The list for the 2022-2023 school year is on the screen. We have Brooks County, Harlingen, Idea, La Joya, La Sara, Rio Hondo, San Perlita, Santa Maria, Santa Rosa, Sherryland United, Valley View, Webb, and Weslaco on the review cycle for next year. What that means is the schools on this list, that means that your finance and procurement is going to be based on this fiscal year that you're about to close, okay? We provide training and technical assistance. We bring in all the directors. We prepare you for this review cycle. However, once the year closes, there's not a whole lot you can do to your finance to make it
compliant if something happened. And there's not a whole lot you can do also with your procurement if the year has already closed out. So having said that, knowing that if your district is on that list for next school year, what you can expect to receive is an announcement letter. So I just took a screenshot of what the process looks like. You get an announcement letter, you get an email, you get a lot of documents attached to it. Your superintendent gets the email with a copy to the child nutrition director and also a copy to the service center. There will be times where if the TDA monitor is in training, they might omit the service center. So you need to be on the lookout. If that happens, you need to forward a copy over to us if that happens. What to expect for the procurement review? There, you receive a list of items that are related. And let me do a quick side note before the carbs start hitting and the eyelids start to get a little bit heavy. The reason that I'm talking about procurement review is because there is a financial link to this. If something is not done correctly, TDA is recalling or calling some of these contracts unallowable expenses, and they will ask for local funds to cover on the federal side if something was not procured correctly. So I'm kind of sounding the alarm that you need to be aware that if something goes off on these reviews, that you will need to be looking for funds on the local side. So the procurement review documents, they require a written code of conduct, well, this is the general side. Written code of conduct, documented procurement procedures, and then on the micro purchases, purchase order issued, receipts, invoices. On small purchase, the solicitation document, the bid quotes, the responses, the evaluation or response for award, purchase orders and receipts and invoices. For the formal procurement, the solicitation document, bidders offer responses, evaluation or response for contract award, and the executed contract. These are the items that will be required of the district to upload into the system. For food service management company, which is sometimes they call it the base year, they will want to look at the solicitation documents, the offer responses, the evaluation documents and scoring sheets. And these are not written in hand and they are not in pencil. This is an official document that needs to be reviewed of how you evaluated these vendors. The notification to vendors of rejected bids, invoices in the minimum of 3 food service management company invoices, USDA food credits, and reconciliation of discounts, rebates, and credits. A recon needs to occur because USDA commodities is a pretty big award. So if you have a food service management company, they're going to want to see how the USDA foods were managed and how they were credited back to the school district. Every school district that had a food service management company received a finding in this area because reconciliation was not occurring on the USDA food side. Let's see. So how did we do in our 21-22 results, ARPR, FR? Let me tell you how we did. I have this giant infection in this eye that I have not been able to kick for 2 weeks. I apply medicine every single day. I check it, I monitor it. It's crying and crying. And I keep calling my doctor and he says, well, you need to work on your stress. Like, well, so it's getting a little annoying, I guess, to say the least. The administrative review included AMI Kids, Rio Grande, EdCal Chelsea, Edinburgh, Hidalgo, La Villa, Los Fresnos, Lifeford, Mercedes Mission, Monte Alto PSJ, Progreso, Rio Grande, Roma, and San Benito. The administrative review for CACFP, because the previous districts that I mentioned were those trifecta ones that received all those 3 reviews. And then the administrative review for CACFP were Harlingen, McAllen, Mission, San Benito, Santa Rosa, Sherryland, and Weslaco. Only 3 findings were in this group. There was only 3 findings out of all of these districts in the area of CACFP, with 5 commendations, 5 technical assistants, and there were 2 districts that had 0 findings in this group right here, which these are the folks that were running the supper and the at-risk snack. And so I'm really happy about that because it went really well and it was seamless. And there was actually commendations on the side versus the National School Lunch Program there were minimal, like maybe one commendation out of the whole group. So I was happy about that. There were 15 districts on the ARPR-FR. One contracting entity dropped out of the program, so they were not able to complete their monitoring review, which is AMI Kids, and AMI Kids is a residential care institution. And so they had very few kids. It did not behoove them to continue with the program. So by exiting the program, they did not receive an administrative review. There were 36 findings in the administrative review side. So out of 15 districts, that's pretty average. And if I could talk a little bit about what those findings were on the administrative review, which are related to meal counting and claiming, menu planning, production record, things like that. These findings do not have any funds attached to them. They are not considered a fiscal action against the district. But if I could use the example of today where you received a ticket and you went outside and picked up a hamburger, came back and ate, and then somebody collects these tickets, the majority of the findings in this area were related to ticket handling and how the counting was conducted for the students. Remember that we were under COVID feeding. We were feeding outside. We were feeding in buses. We were counting using these little papers, and a lot of the documents that were uploaded were not from a point of sale system. They were actually manual paperwork. And there were some that went in where teachers were crossing and counting kids, and they were using gel pens of all the things to use. It was a green pen or a pink pen. So that is not scanning correctly. Those of you that come from the audit world know that if you did not see it, then it did not occur. So hence the finding, because it was just not there. And some schools were off like 1 count, 2 counts, but why did I get a finding? Your count is off. You know, you were off by a couple of numbers. On the procurement review findings, there was a total of 70. This is probably an all-time high. We really, I mean, it was quite a bit. However, of those findings, so we did have 3 districts that had 0 findings in the administrative review. So congratulations to them, and they did really, really well. It was Edinburgh, Mercedes. I shouldn't start mentioning because I don't know who the third one is. And I mean, they did great, great work. However, on the procurement review side, there was not, every district received some form of finding, something. And the finding ranged from 2 findings all the way to 10. And the reason there was a 10 is because if the monitor reviewed one contract, there could have been 10 different elements wrong with that contract. Therefore, you find yourself in that jam where now you have 10 findings. Statewide, the average finding on the administrative review side is anywhere between 3 to 5. Region 1 historically always ends up in about 3 and under, with a high number of districts obtaining the 0 findings. So people work really hard, they do things right, they do really, really well. And so to have a 2 to 10 finding on the procurement side, then we need to do some work in that area. The district that decided to share some of the information so that I could share it with you as a learning opportunity, they provided me the procurement table. So just to give you an example of how it is entered in the system, this particular district was participating in 3 different co-ops. They had a total of 58 vendors under the micro purchase, 2 were selected. They had 10 vendors under the small purchase, and 3 of those vendors were selected. And they had 22 formal contracts, of which 4 vendors were selected. Okay. This is just an example, so you can see from the little bubbles where it's got the X, but the check mark means that that vendor in this purchasing threshold was selected. In this case, it was Dependable Air Company, Fire Ranger Fire Protection, and JR Inc. Of these 3 vendors, 2 were procured at the local level, and the other one belonged to the South Texas Cooperative. So guess which vendors were the ones that got the finding? It would have been the 2 local folks. On the formal side, the ones that were selected was a Canon copier, Copy Graphics, and let's see, the Grande Garbage. And that got a little bit weird because you would think that trash collection is part sometimes of a municipality and therefore you do not need to contract out that service. But in this case, there is trash collection going on in the municipality, but the schools that are on the outside, that is actually contracted out. And there was a lot of things that went wrong with that contract. The district received 3 findings in procurement review. And the number 1 finding, and in this case, it seemed like almost every district in the cycle received the same finding, which was the procurement procedures did not address the following required elements for food and nutrition program, which was the Buy American provision, a cost analysis, and contract management. So those 3 things were missing out of those elements. Policies and procedures, for the most part, were also missing what happens to an employee that breaks the rules, the code of conduct, and ethic violations. So a lot of districts would upload what happens to a teacher if she takes a HEB card and buys supplies without approval. And that's not, or they were uploading the code of conduct for a teacher that's supposed to behave professionally in the classroom. It's not related to procurement. So, you know, there was some thorough looking through these documents that needed to happen. And then I said, did this go through our standard procurement process? Question mark, question mark. So just adding a little cartoon for levity. But this seemed to be the recurring theme where the policies and procedures was missing or had not been updated. If you're on the review cycle for next year, the monitor is going to ask you for policy procedure manual that is dated for this school year. They want to see what was in place because they're going to check all your purchases against that policy manual, not your 22-23 school year manual. Finding number 2 for the volunteer district was the fire ranger fire protection. There was no source or quote or documentation for this particular vendor, which is not complying with the small procurement threshold. There was no supporting documentation for the small piece, and the amount that was deemed unallowable was $11,196. For dependable air, this vendor had a name change throughout the year. So there was 2 purchases, one entered in small, one entered in micro. And at the end, the monitor made a mistake and put one of the purchases instead of all of the purchases for this vendor. So that was still up in the air on whether they're going to get a ding for unallowable of $3,000 or $30,000. So this dependable air was also a AC service, and it was not procured correctly. There was no supporting documentation for the small purchase, or procedure or anything was conducted at the district. Number 3, which is on the formal side, which was the Grande Garbage, that contract was for a total of $56,000. So that right now, as it stands, the monitor has documents inside of Texas UMPS that says local funds need to be transferred to CMP and the amount of this unallowable expense as it was not procured correctly. There was also the only document or piece of information inside of the file was that they had a 3-year contract. Right. So earlier you heard a lot about contracts and the length of contracts. So the document was specific to saying you have a 36-month contract with us. So what we see is that a lot of districts follow local and state, but when it comes to the federal side, we need to make sure that we're paying close attention to how CNP runs and the requirements for the program, which are federal. Canon Financial Services, this and Copy Graphics, both of these were for services rendered to the district, but the contract had run out and the district continued to do business with the vendor. There was some transition going on. There was, COVID happened, and so it expired and we just didn't have time and that, but now that we're in recovery mode, moving forward, then what does that look like? The CAD corrective action document, and this I grabbed from this year's training information. TDA is of the thinking that they're going to go into a 3rd CAD mode. So the corrective action document, you get a first CAD where The CE answers corrective action document, right? You're gonna answer the dings that you got. The reviewer reviews the CAD, and if it's acceptable, it's closed. If it is not acceptable, then you go into a second CAD. If the second CAD is not approvable, then you go on a hold. If the second CAD is acceptable, the reviewer will close. But if the second CAD is not acceptable, the C's claims for reimbursement will go on hold, and a follow-up review will be scheduled with your reviewer. We have not had this happen to any district in probably about 15 years or so. But TDA is now coming back with a stronger team of reviewers and enforcing one CAD, second CAD, and then the hold. Okay. Technical assistance and training, as you can see from my pictures, my humble pictures up here, we provide 2 sessions in administrative review preparation. We also provide a makeup session in the summer, should somebody miss that presentation. We also come to your district 3 times during the 10 to 12 week of your administrative review. So we are there for support. We are there for, you know, to try to solve this mystery of the review, because we know that directors are so overwhelmed with all of the day-to-day activities that this just adds a lot of challenge. As you can see from my picture, they sit the same way you do, right? So 3, 4 columns in the front are empty. Everybody's sitting in the way back. Common questions. What procurement threshold, what procurement method did you use? Right? So this is me being at a school district. This is me being on the phone with a TDA reviewer, monitor, and asking a director, what procurement method did you use? And you see my little reindeer, it's like little eyes, crickets. Okay, what are your thresholds? That's another one. What, Carmen? What? You need to know your thresholds, and they are tied to your policy and procedure. Your monitor is going to get you on the fact that you have thresholds that are developed at your district, but yet you're probably, in some cases, not following them. And then the last one, did you conduct a cost price analysis? That was also a big eye opener. Well, I didn't know I was supposed to do that. And who said? You know, I got comments like, well, it's because my procurement office, you know, they're very busy, so a lot of it ends up on my desk, and so there's a lot of connections that need to be made. At a last FNPAC, which is a Food and Nutrition Program Advisory Council, we have a meeting just like here. I shared with them, well, this is what Region 1 has. Region 1 created a table. It's simple. It's got the thresholds and what happens next in each one. There were so many procedure manuals that I saw that these amounts were embedded in there somewhere, but they were not clean. And I'm not saying that, you know, try to build on something that is a little bit, well, I guess I am saying that. Try to build on something that is a little bit cleaner and more detailed so that the monitor can review it and just move on to something else. So this, if you could outline some form of a table with thresholds and include it in your manual, that would work so much better than to have to dig through. Other things that I heard from procedure manuals was that, well, we follow, all these programs follow this one, but then migrant follows this other one, and federal programs follows this other one. So, you know, you're kind of like all over the place. In using the CNPSTC awarded vendors, there was a lot of confusion at the district level as to what, you know, I would get a lot of what I used the co-op. I should be okay because I used the co-op. I was like, well, what contract did you use that belongs to the co-op? So we had to decipher a lot of that. And a lot of districts were using a catalog bid. And so that was, catalog bids were created as a catch-all to bring in product. You know, maybe you saw, director saw this pizza or saw this fantastic menu item, brought it in. But once you brought it in, you're no longer in micro, or possibly you're already surpassed the small purchase threshold when it's time to bid it. So my advice to school districts was try to move some of those purchases from a catalog over to a line item bid, and also run vendor reports. You need to run a vendor report and see where you stand. It is very easy to jump from one threshold to the other, especially because some of the districts that think they're small, they really aren't. You know, you're a big buying force in procurement. Moving from catalog to line item requires forecasting, planning, and also providing those quantities to the co-op. So sometimes we get directors that, well, I don't have time, and the co-op keeps asking us for a forecast, and we don't have time for that. But we went from planning a menu 3 months ahead of time to 6 months ahead of time to a year in advance. And that mindset is what needs to happen to make sure that you are forecasting and planning correctly and also conducting your cost analysis. The hot topic of the year was equipment repair. For whatever reason, during the procurement review, when you spin that wheel, that Russian roulette to see what vendor was going to be selected, a lot of the equipment repair vendors were selected for sampling, and those were not correctly procured. We had one district spend over $100,000 in equipment repair, and they used the same vendor. It was not a contracted vendor. It was not a co-op vendor. It was just somebody that was nearby. He was the only one that's been willing to come. And when I asked more questions, well, it's because we've always done it that way. These types of services, you need to make them competitive, or else you're stuck with paying out of local back to transfer into CNP. Just quick reminders that I'm at the end of my presentation. A quick reminder that application packets renewals for child nutrition program for 22-23 is June 30th. I have 5 districts that have already submitted. 2 of those have already been approved, which is great job. Thank you for that. But you need to do us a favor of going to your district and really pushing for that director to submit this application. The reason for that is because we are coming out of USDA flexibilities, and the application is very sensitive. Texas UMPS was not intended to house the craziness that happened with COVID feeding. So a lot of work needs to go into that. I also included the other deadlines that we have in our department. We are in charge of providing training to child nutrition staff. So our workshop is June 8th through the 9th. That is a huge endeavor. We're expecting about maybe 600 people. We didn't hit the 900 that we normally get pre-COVID, but I understand that there are some districts that, some of the staff they're busy doing something, or they have limited staff, so we have a little bit lower participation. The rest of the dates are just our travel dates, and not to say, don't call me, I'm not available. It's just to say, we are not around during the summer. So if your director has a problem with their application packet, it is most likely that we will not be able to answer their question or be there to assist them right away. Like, we would need probably a 2-3 day lead time to assist. Any questions? That's all I have. I hope I didn't scare you too much. Yes. The mic is coming. I do want to make a special note that there was one district that got a $1.6 million finding, and that sat inside of the website for a while, and while the powers that be resolved it, and it ended up, they kind of forgave the debt, but they had to rebid that entire contract from scratch. Yes, ma'am.
If a district has self-certified for 50,000, because there was a time where TDA had said that basically we still had to stay at the 10,000 micro level, no matter what. Does that now apply to where if the district is self-certified to 50, we can pick it up even for CNP?
Yes. Yeah, they will accept it. Just make sure that you have all of your documentation on the self-certification of increasing that threshold, and that it's included in your procedure manual, and that you have the evidence and I understand the TEA is not really providing an approval. They're just wanting to collect this information from you.
Right.
So whatever backup documentation, you'll need to have it and show to the TDA monitor.
And how about, we always ask this question, but we seem to be getting, I don't know if maybe they're not understanding us. Let's say we're trying to buy supplies. So we're not going to use a contract for longer than a year, but the contract, let's say we're using a co-op where the contract is 3 years. It's more than 1 year with options to renew. And you know how TDA doesn't let you use that. But if we're not using it for longer than that, we're still not allowed to use that.
So the TDA updated the ARM last August because the prior language contained, you could only do a contract for 1 year with an option to renew up to 3. So that has been changed with the 1 and 4. So you have a 1 year and with an option to renew up to 4 years. And then after that, you need to start the process all over again.
But can we use let's say a contract is longer than a year, but we're not using it for, let's say we're just buying supplies, a one-time purchase of supply on a contract that is longer than a year, we're not allowed to use that contract, right? Let's say, I don't know, for instance, Office Depot on an Omnia co-op and that contract that Office Depot has through Omnia is a 4-year contract. We're not allowed through CNP to purchase from that particular contract since it's longer than a year.
Not if it's longer than a year.
Okay.
Yeah, not if it, remember the example I gave you about the garbage pickup? That was a 36-month contract and that was deemed, that was a $56,000 repayment. And so that they wanted to see that that was a 1 year and then, you know, the option to renew the subsequent years. What was that?
Even if you're not using it for longer than a year.
They're going to base it on what the language
What
is
the
inside
language
of the
says?
contract and not
Okay.
necessarily what the activity is going on the outside part.
Okay. all right.
So, you know, they're checking policy procedure, they're checking the language of the contract, they're checking contract management. Yeah, that would not.
All right.
that would
Thank you.
So there was a lot of, Lori has a presentation about MegaCon later on this afternoon, so hopefully you stay for that. There was a lot of talk and presentations in Austin at MegaCon. And it was stated that there was going to be some smart sheet that was going to collect information on those districts that had self-certified. I just didn't keep it on my radar because sometimes some of these things are said and it takes a good while for it to get rolled out. Yeah, but we can follow up on that. Any other questions, comments, concerns? Everybody's gonna do great.
Carmen, have they already released the list for 2023?
Yeah, let me move it back. It was the very first slide. Right there.
Sorry, I was,
Okay, so we're May, and I know that you have like just a couple of months to finish out. So if you're on the list, you know that this is your finance and procurement review year. And we train food service directors, we tell them, make sure that that year of review, you need to behave yourself. Don't do any creative things. Don't think out of the box. Just keep it straight. So, all right, here to help. I am available through email or you call our office. We will gladly come out and meet with you if you have any further questions. Thank you.
thank you, Carmen. Next on the agenda, we have an energy update, and today we have Annette Van Braun from Van Braun and Associates visiting us to share, I hope, some not as very good news, but maybe a recommendation on what options we may have after the weather freeze or the freezing storm we had in 2020. How is that impacting us in general? I guess also from a personal perspective, like we may see charges in our personal bills as well.
Does she have a clicker? How does this work? Oh, here it is. Okay. And do I need to hold a microphone or, hello? Oh, this baby? Okay, can y'all hear me? Yes? No, let me. Well, it's so good to be back in the Valley, and this room is so amazing. I haven't been to Region 1 since y'all built this room. I guess COVID happened, and I haven't been down here all that much. So it's so excited to see a lot of faces that I recognize. And you haven't heard me talk about energy in a long time, but I'm still doing the energy thing. And energy right now is a big, important topic, both for all of us personally as we fill up our tanks and as we try to heat and cool our homes, as well as it's a very large budget item for all of you. And trying to plan and manage for that is a challenge that all my districts and all my public sector entities are trying to manage at the moment. So I'm going to talk a lot about it, and I'm going to actually talk about it in the context of creating an energy master plan, because we can no longer, we're no longer going to assume that we're going to have very, very low energy cost days. We're having extreme prices, and even if they don't stay at this level, we don't know when they might come back again. And so we need to start rethinking and making energy planning a big part of what we do. And I don't mean it in a way of, so it's just, there's buying electricity, but also in the way that you use electricity and coming up with standards to do that. I am going to talk about the February freeze because there are some outcomes that impact you. That's at the very end of the presentation. I really want to talk about kind of all the things that you could be doing as a district. And I do believe it starts with the people in this room to help support initiatives that your facilities people, your construction people, your bond people are all working on to be sure that it's all working in concert to support a long-term management of energy costs. And guess what? For those of you, maybe your districts don't say they want you to be green, maybe your constituents aren't saying they want you to be green, but using less is a very green strategy. You don't have to put a solar panel, you don't have to do anything else. Using less is the greenest strategy you can come up with. We're not dependent on China for batteries or for glass or putting a windmill up. Using less is there is nothing greener. So I'm going to talk about all that today. It's your meeting as well, so I don't mind if I use a term you're not familiar with or that you would like me to expand on a little bit. Please feel free to stop me. Well, so a little bit about me. I represent the Texas Public Energy Alliance. We're a co-op that's only available to public sector entities, and we're all in one. We not only help buy electricity, but help you manage the electricity costs. We have 8 suppliers that are part of our co-op. So a lot of co-ops have one supplier, or they have multiple suppliers, but it's up to you to figure out which one's the best one and run the we run the procurement for you. And we also save time, and we've negotiated contracts with all the suppliers. So we really work to make sure that you're focused on your business, and we take care of the hard part. And then it's supported by V. N. Brett & Associates, which I've been doing this. We celebrated our 20th year in November. So I've been working in energy since I was 19 years old, and producer, pipeline. I worked for a retail supplier and then been doing this for this company for 20 years. And I've represented over 50 school districts in Texas, as well as charter schools. But the biggest thing, our biggest differentiator, is that we really work to be your advocates. And so that's why I'm here today, is to help y'all, because I really want to advocate for school districts to end up saving money on energy and putting that money in the classroom where it should be. Current members of our co-op in the Valley, we've got lots of school districts as well as Cameron County. We've got some of the largest school districts in Texas: Houston ISD, Dallas ISD, Arlington ISD, etc. We have some universities as well. One of the largest pools in Texas. So I want to talk about Energy Master Plan. Why would you have one? First of all, to lower your costs, right? So reducing consumption, lowering your demand. To meet your sustainability goals, to the extent that you have some. I don't have a lot of districts who have sustainability goals, but that is starting to become more and more important. But people say we want to be green, but we don't want to pay more to be green, right? And so there are ways to do that. Also, to improve your learning environments. We want to be sure that your learning environments are comfortable places, but that you're not wasting energy in places, keeping some people maybe really too cold or really too hot. And we also want to be sure that there's not strain on the equipment in your facilities, right? So then you're having to replace that equipment, which is also taking money out of the classroom. So let's talk a little bit about plans. I'm going to get a little philosophical for you. An hour of planning can save you 10 hours of doing, right? Dale Carnegie said that. If a plan doesn't work, change the plan, not the goal. Failing to plan is planning to fail. And always plan ahead. It wasn't raining when Noah built the ark, right? Plan ahead. And this one's my favorite. A goal without a plan is just a wish, right? Oh, we want to be the lowest, we want to be the best school district in the valley, right? Well, how are you going to get there? You got to have a plan to get there. We want to have the highest achieving students. Well, you have to plan to get there. A goal without a plan is just a wish. So with that in mind, what types of districts benefit most from an energy master plan? First of all, growing districts. Why? Because if you're growing, you're building new facilities, and you want to learn from your facilities that are performing well and use that when you plan for your next facilities. Declining enrollment facilities or districts. Why? Because you may need to be looking to consolidate, right? To consolidate some of your campuses or to use your energy in a different way. And so you want to find out where your energy costs are lowest and where you're being most efficient on your space heating and cooling. Your aging facilities, same thing. You want to, if you're going to be replacing facilities, you want to be sure that those new facilities are the most energy efficient, and you want to have a plan. If you have higher energy use, you got to have a plan to figure out how you're going to lower that. And sometimes that could involve money. Your budget constrained districts are the ones who really need to have a plan, because you need to find every way possible to reduce energy and you reduce your costs. And then of course, those are sustainability goals. So who should be involved in generating your master plan? First of all, the board and superintendent. My districts that have the most success with their energy cost management are ones where it starts from the top, right? They can tell you how to define your success. And that's with any of your initiatives, right? If your board and your superintendent tells you this is where we want to be, right? They will help tell you when you're successful and measure your success. The CFO business office. You can provide funding for initiatives, and you can test and validate all the investment, any investment and the payback. So if certain areas are saying, you know, we need to do this, and we're gonna make this high school perform like this high school after the year or after whatever initiative takes place, you can validate whether that really happened. Academic leadership. Any of these plans should always support learning, right? And when I'm going to talk a little bit about demand response and turning things down. Well, your principals should know you're going to be turning down on a few days in the summer because we're trying to save tens or hundreds of thousands of dollars. But they should have ownership to the plan and know why that's happening. Next is your construction and budget office. Now, this is where a lot of things fail. And I don't know how many of you have experienced this, and it happens, you know, every district I go to, just about, is we all have plans on our ongoing facilities, and we say we want to do this, right? We want to have 1 meter per district, one meter per campus. We want to have these operating hours. We want to have this sort of thing set up. And then those somehow don't make it into the bid specs because it's usually a PM or some outside party that isn't familiar with your operating procedures, whatever initiatives you've put in place, whatever control systems you prefer, things of that sort. And so these two things never meet until when the project is done, right? Then facilities gets this turned over to them, and they're not set up to meet the plan and the initiative. So really involving your construction office, your bond office, and if it's an external party, including them in knowing what that energy master plan is and how to be sure that whatever they're doing is in support of the plan. And then lastly, your facilities and operations. These are the people who are boots on the ground, right? They have to implement the initiatives. They're the ones who also see the waste. Listen to them. They have ideas. Sometimes they don't feel empowered. Let's be sure that we include them in the process as well. So what are some of the building blocks? First of all, identifying your largest uses. Those are usually your HVAC equipment, your stadium lights, technology server rooms, and food service. Identify any places where you can modify your behavior, right? So change the operating hours. I can't tell you how many campuses I go to in the middle of the night, say 9 o'clock at night on a Saturday, and it's like an icebox in there because, well, we are going to have a band something, on Sunday, or we had something and it was on all weekend. That is waste. If it were your pocketbooks, you would not leave the air conditioning on at your house at 68 degrees all weekend long when you're at the island, right? You wouldn't, not at these prices. Things have to change. So modifying operating hours can start with, you're gonna tell your staff, we only will have air conditioning from this time to this time on Saturday, and that's it. If you're gonna work on Saturday, these are the hours. Make sure that it's all the way off, and if somebody needs to use something, then they have to request to keep it on instead of the other way around. Standardizing your setback temperatures. All your campuses, it's a temperature, no matter what. And I talk to facilities guys all the time. I say, oh, if you could set it at 68, would you still get hot calls? And they're like, yep, we would still get hot calls. So come up with your standard setback temperatures that are reasonable for a learning environment, but that manage that electricity consumption. Also, utilize alternative equipment. We have campuses, many campuses that are really smart about energy, and that instead of running the whole chiller when the principal and administration are in on the weekends or whatever, they've got a small DX system just in the administrative office so that they can just turn on that air conditioning instead of cooling or running the entire chiller system. So thinking about using alternative equipment is also a great idea. Setting goals. Set year one targets, test different strategies, and come up with an impact statement. An impact statement means we would like to achieve X% reduction, X use per student, something that people can all point to so that when you have an initiative, you go, does this support our goal? Does this support our impact statement? Does this help us get to that goal? By 2030, we want to use 14 kilowatt hours per student, per square foot in our campuses. So what are some cost reduction components? Demand cost reduction. And I know there's some people in this room who are with districts that have been with me or are with me now. 4CP, we're about to start 4CP time. 4 coincident peak, June, July, August, September is the 4 summer months. If you can turn down on the peak days in ERCOT, you guys know when you get those, you hear the ERCOT asking people to turn down, right? Those peak days, if you can turn down that hour, that 15 minutes actually in June, highest June, July, August, and September, you can save $60,000 per megawatt that you reduce in those 15 minutes. Huge amounts of money. Said other ways, those 15 minutes can cost you $60,000 a megawatt. That's not the consumption piece, that's in demand charges. Those are in AEP charges. Power factor. Power factor is a method. There are some meters that are very inefficient. There are certain HVAC equipment that's very inefficient and it uses power inefficiently. With the installation of capacitors and power factor correction equipment, you can lower that, and you haven't affected your classrooms at all by doing this sort of thing. Meter combination. And I want to say that I look for ways that we can do things to reduce your costs without disrupting the learning environments. There are campuses here all over the state where there are 20 meters in an elementary school. Each one of those meters is paying a monthly meter cost, a customer charge, demand charges, all sorts of charges that if they were combined would go away. But people think, well, that's just the cost of electricity. Yeah, it is, but you can do it smarter and with costs that are much lower. You can lower your costs without using less electricity, without using more electricity. without using less electricity. You're using the same amount, you're just using it all on one meter instead of 20 different meters. We can also be sure that you're on the correct rate schedule, and then of course, changing the way you use. When I say use modification, some of the strategies that some campuses use is instead of turning everything on at 5 o'clock in the morning to pre-cool before the kids get in the building, they cycle on. They turn one wing on and let that cool first. So start 30 minutes for that one, and then another part of the building, and then another part of the building, so that you're not ramping it up like this, setting up a big peak demand, but most of the time you're down here. So they cycle on, right? And to try to manage that peak demand, things like that. So procurement costs, so that's one side. This is all AEP charges. Procurement costs, selecting when to buy. And I'm going to talk a little bit more about that. That's one of the most important things. Trading off between buying long-term or short-term. Ensuring that you maximize competition. So ensuring that we have eight suppliers. And when I say competition, I mean at the retail level. There are some cooperatives out there that have one retail supplier, and they claim they're getting lots of wholesale bids, but every retail supplier gets lots of wholesale bids. It's the retail piece that's the big differentiator between prices. So making sure you have maximum competition should be a primary goal. And then minimize price reopeners or anything that could impact your price. It all has to start with data, right? All of the people in this room, I see you with your laptops, you deal with data all day long. Well, Entergy, we are now enjoying a time that we can get data very easily. 10 years ago, it was not quite as easy to get data. We now can get 15-minute interval data for virtually every one of your campuses. We couldn't do that before. We used to be able to get it for high schools only, your large meters. We now, with Smart Meter Texas, know exactly what you've used every 15 minutes at every campus. Huge amounts of information to start making better decisions about energy. It's a great thing. You know, it was expensive. Texas decided to do it, but now it puts a lot more in our hands about how you use energy and how to make decisions on how you could be using it better. I think that districts should decide on a measurement. When I said about doing goals, a measurement that's easily understood. There's this EUIs, there's this dollar per BTU, there's the that none of us can visualize what that means. What does $10 a BTU mean to anybody? How do you communicate that to your parents or to your teachers? Nobody can visualize that, whether that's a good or bad. So I believe in coming up with a measurement that's easily understood by everybody. So one could be dollars spent per student or per square foot. Dollars per student, you get your revenue per student. So if you can communicate your energy costs per student per campus, that's a great way that people can get on board and you can measure that. Dollars, everybody knows how to measure dollars. Kilowatt hours used per student or per square foot also goes a long way in helping in getting everybody on board to a measurement that's easily understood. I also like to start with this or use this as well, this cartoon where he says to everyone, all our appliances come with a free special energy saving device, the on-off switch. There's nothing that has a greater payback than turning things off. It's greener, it costs the least, it's the easiest thing to do. So ensuring that your controls people are empowered to turn things off is a #1 way to get your costs down. We also look at benchmarking, and let's see if this little light works. Yes, no, yes. So what this here is, I call this the bubble chart. And this is a campus, this is a district that has lots and lots of campuses, but we measure use per student here and use per square foot here. And my campuses that are in the red zone are ones that are high use per student and high use per square foot. These are ones that need to work on things. And then my green zone are the ones that are low use per student, use per square foot. These are my performers that we want to emulate and figure out what are these campuses doing and how can we replicate that behavior with these campuses. So we do that. The other thing I want to tell you that the red and the black on the outside, do you notice that the bubbles have different colors on the outline? Well, the red outline is one type of control system, and the the black outline is a different type of control system. If this district is building a new campus, which should they be putting in red? And I'm not going to tell you what the brand is, just because I'm not here to advertise or put anyone down. But would you be putting in more reds or more blacks? More reds, right? So this control system seems to provide the best results, right? These are better controlled than these up here, which means that they're able to turn off at night and manage that consumption really, really well. The other thing we do here is look at these control systems. We take that information and we go, and again, I blanked them out because I don't want to put anyone down publicly. This is for the customer's benefit. But we take use per square foot. This is 16, 13, 20, 16. And these are the different control systems, right? And this is how much load that district has with control system 1, 2, 3, 4, et cetera, et cetera. So this one, our second highest, they're only using 13 kilowatt hours per square foot per year at the ones using this type of control system. Whereas the ones using this control system are using a significantly higher amount on all of these, almost all of these are, particularly this one. We calculated, actually it's $1.3 million for this campus, this school district, if they were all at 13 kilowatt hours per square foot. So what are they doing? They're looking to move these campuses to, we're doing an economic calculation on switching the control systems that these are using to this type, or asking that this controls company provide the level of service that this one's doing so that we can control it better to get that down. This is for an example of 4CP. This district is saving $300,000 a year in demand charges just by lowering on those 4CP days. Here, they get an alert from me to turn down. You can see that they're using this, and then they turned down for about an hour, and they were able to save $6,000 in demand charges for 2020 just by turning down that hour. Said another way, that 1 hour cost them $6,000. The other thing we can do is look at different campuses. These two campuses had the same square footage, two different campuses, middle schools, same square footage, same number of students, with give or take less than 1% difference in either of them. This one's electricity bill was $288,000. And this one's electricity bill was $141,000. If you look at this is that whole year's consumption. You can see that this load isn't controlled at all. They're leaving it on all night, on weekends. Like, it's not controlled at all. So their bill, running 24/7, is $288,000. This one, you can see all those gaps. Those are weekends. You can see that they turn down and they're controlling quite a bit. Their bill was half of what this other one was. So $140,000 of value through improved energy usage. Now I'm going to talk about procurement best practices. Those of you who have contracts coming up, and this is a really tough time, and we're going to talk about that. What we did was take the number of days in advance when you need a new contract, a new electricity contract. Each one of these dots represents a contract that we awarded for one of our clients. And so this is the dollar per megawatt hour that they got in their contract price. And we found that the closer you are to your contract expiration, i.e. waiting till the last minute, these clients did not have very many options and tended to be paying more than those who bought well in advance. And well in advance is not a magic bullet. It's well in advance because there was a dip. These are saving considerably more because they bought well in advance. This is 1 year, 2 years, 3 years, 4 years, 5 years. So different than your home. At home, we can only buy a month in advance. A school district can buy years in advance, if the market makes sense, and if you want to blend and work on your budgets and make sure that that budget is managed. So I highly recommend putting that as part of your plan, is to buy well in advance, or at least be prepared to buy well in advance. You can see here, again, the red dots, the blue line represents market prices, right? And they've gone through the stratosphere. The red represents when we entered into contracts for our clients. And this was a dip, and we bought lots and lots of power right in here in these dips. We look for dips and hope to yield the best value. That's part of best practices.
Annette, I stepped out just for a few minutes, but what's the max that you've seen the districts buy in advance? Like, how many years are they up to?
I have bought as much as 8. Well, all of these are school districts, so what's this? 1, 2, 3, 4, 5, 6.
6 years. Thank you.
And some, for example, Dallas ISD bought 2 years in advance, but they bought 10 years worth of power 2 years in advance at $29-ish dollars a megawatt hour. 100% renewable. So I'm going to talk a little bit more about power prices. I'm going to first talk about the cost component. When you're buying power, the biggest piece is the energy, it's the cost to produce. And it really depends on the generation type, the fuel, the cost of it, the fuel, the generator efficiency. So obviously there's no fuel required for the wind to blow or the sun to shine, right? There's no fuel, but there is high capital costs to put them in place. So there's the energy piece, but that's not the only component. When I talk about wholesale prices, I'm only talking about this piece. It is the biggest piece, but it's not the only piece. There's also the load following component. So you don't use the same amount 24 hours a day, 7 days a week, right? You use less on the weekends, you use less at night. So the fact that it's got to follow your load has a cost component to it. Line losses and transmission. There's getting it from the power plants to your facilities or into the AEP system. There are losses, and there's the cost of transporting it and through the grid. There's congestion and ancillary services. So there's all these services that ERCOT requires that cause people that add to the cost, and they have to have these services in order to keep the grid running, mostly running. And they're trying to increase some of those services so that we don't have as many of the problems as we did in February. And then just risk premium and margin. So all those pieces need to be competitively bid. When you ask for a price, you're getting all those pieces. You're just asking for a final price. But just like when you ask for a Big Mac, right? You don't ask for the price of the lettuce and the meat and the bun. You ask for the delivered price. Same thing here. But it's important to know that all these pieces are in there or should be in there. Some suppliers will bid, but they'll leave the congestion part out and flow that through. You do not want to do that in South Texas. The congestion charges in South Texas are typically very volatile, very volatile. I would not want to risk your budgets for that. Some suppliers, to make their price look lower, won't put that in there, but I urge you to make sure that congestion is in your price. So what drives the electricity price that you pay? Of course, the size of your load shape. I have districts that are super efficient, right? They turn off as soon as the kids leave. Their price is higher than people who are not as efficient. Why? Because their load is mostly during peak time. They have very little off-peak time to average with that peak load. So it looks like they're paying more for electricity. They are, but they're just using a whole lot less electricity. But so your load shape can drive what you use. The contract terms, unlimited swing, add delete allowance, supplier protection, your protection, those can all go into those costs. The number of bidders. And right now, I am seeing as much as $11 between the lowest, $11 a megawatt hour, between the lowest and the highest price. Bids are hugely different. So having more and more bidders ensures that you'll have the lowest price person out there bidding on your load. And then the most important is Really where you are buying, when the market's low or when the market's high, really drives. Just like now, you can drive around all the gas stations in Edinburgh to find the lowest price. But regardless, if you find that Costco or whatever, that lowest price, it's still going to be higher than what you were paying 2 years ago, right? Much higher. We can't get that price anymore. So the best we can do for you is drive around and basically do that same thing. Drive around, finding the lowest price under the best terms to meet your needs. And monitor the market and hopefully step in when there's a dip. This is sad. This is sad. So this is what energy prices, look at how stable they were for so long. This is 2020, 2021, and then that daggum freeze happened, okay? And you saw prices go up. This is for, if you need power in 2022, this is what prices have done. I want you to see that the wholesale is on this side, and this scale, I've never had a scale like this on any of my charts before. It's $122, $142. That's the scale of this. 2023 is up there, not nearly as high as 2022, and the rest of these are following suit. They're much lower, as you can see. You can see that 2022 was at 116 last night. If 2023 is 41% lower, 2024 is 29% lower. But to the extent that you don't need power for here, it might be a good idea to start looking at buying power for here so that you don't end up stuck with having to buy $116 power. Okay? I want to show you what it was in 2021. Buying power for 2022 was $37, $26. That's how much it's gone up. 2020, $35. These are things that are going to hit your budget if you're having to step into the market right now. But we have ways to mitigate that, depending on your risk profile. ERCOT prices, wholesale prices, the reason they're up so high is because natural gas prices are so high. And the reason natural gas prices are so high is because there is huge demand for natural gas around not only the US, but around the world, right? China and Europe are desperate for natural gas. You've got the Russian-Ukraine crisis. People don't want to buy from Russia. So guess where they want to buy from? They want to buy our natural gas. Our natural gas was $3. If you're a natural gas producer and you can sell it to China for 20 versus 3 in the United States, you're going to want to send it to China. You're going to want to send it to Europe. Good thing there's some limits because they've got to liquefy it and put it on a ship, and there are limits to how much of that can be done. But this is what's driving that, combined with an extremely prolonged winter this year, which created huge demands on natural gas and drew down storage levels. I also want to talk about what's changing in ERCOT. If you look up here, this is 2013. This was the generation mix. 40% was natural gas, 32% was coal, 11% was nuclear, and about 10% was wind. Today, we have about the same. We actually have more as a percentage natural gas. We're decreasing the amount of coal, and that's going down fast. But we have a lot more wind. But if you look down here, the term dispatchable and non-dispatchable, I want y'all to remember that term. Dispatchable means they can say, turn it up. Dispatch, we can dispatch that power plant. Natural gas plants are dispatchable. They can say, turn that one on. Wind is not dispatchable. There is no call to God to start blowing the air to get wind on. So wind is fantastic from air perspective, fantastic from a cost perspective. On the days when the wind's blowing, it can represent 33% of our load in Texas, right? It can serve 33% of our load. However, And I use this example. Do you guys remember when they used to say, if you want a Jaguar, you buy two, one for the shop and one so you can drive? What happens when the wind isn't blowing? Do we have one available in the shop to turn on? We have to have natural gas facilities, and it's that's causing huge uncertainty in the market and huge risk premiums in the market that we're all going to have to figure out, and ERCOT's figuring this out. We want clean air, we want cheap, we want all of those things. It's better for the environment, it's cheap, it's renewable, all of that. But we've got to come up with a way that we're not freezing people out or burning people up. These are challenges that are in the marketplace, and until that settles out, we're going to see price volatility. Natural gas storage. So what this green line shows is that, and you can see 0 here, we are below the 5-year average here. And anytime we're below a 5-year average, we're in a storage deficit, you'll see natural gas prices go up. So this is what we're seeing happen. If we see that storage can get full by the end of, when people say, when might it come down? I don't know, but one time that'll for sure come down is if natural gas storage is able to get back and get full, and people have some confidence in that. And so that's one piece. And here's my Asian and European prices. So here we are in the US, in the $4 or $5 or we were, and this is what it is in Europe and Asia. So there's huge demand for our cheap natural gas in Europe and Asia. The question we all need to decide is, I don't know if y'all remember back before 2010, the 10-year average of natural gas prices from 2001 to 2011 was $6 an MMBTU. And then the 10-year average was half of that from 2011 to 2021. It was $3 an MMBTU. So the question is, are we in a blip? Is this a short-term blip? Or are we creating a new normal? This was a normal for 10 years. This was our normal for 10 years. Are we back up to a new normal? And I think that's got to shake itself out. I think we're too early to tell. So what could cause prices to go up? And this is very important for those of you who are needing to buy power. And actually, those of you who are locked up, this is still important. This energy master plan I talked about, this is the time to start doing those things to right size your consumption. Because if you have to, you'll eventually have to step in and buy some of this power at that more expensive time. So all of this, even if you say, I don't have to worry about this, I'm locked up, you still do need to worry about this because it's still coming for everybody. So what are going to cause prices to go up? Continued colder than normal temperatures. And I'm going to tell you right now, there was snow, lots of it on the ground in Colorado just last week. There was snow in the Midwest. When does it end? But guess what? They had a heat wave. They had emergency heat in Boston last week. Same week. So continued colder than normal temperatures, a hot summer due to the drought. And if you look at the drought maps, especially in Texas, the eastern half is 35. The eastern half is fine, plenty of moisture. And actually the valley, for the first time ever, actually is not in drought conditions. I mean, I can't remember the last time the valley wasn't in drought conditions. You're doing great down here. The western part of Texas is in extreme drought conditions. The western part of the US, Colorado, California, who depends on hydro, right? Washington State depends on hydro to generate electricity, is in extreme drought conditions. That means they're going to need natural gas to replace the hydro that they don't have. Not only that, because it's drought, it's going to get hotter, so they're going to have greater demand. So it's not good. Sluggish growth in natural gas production due to infrastructure and capital hesitancy. There's a huge push for people to say, we don't want you investing in oil and gas companies because it's not good for the environment. So banks are being told don't invest, companies are being told not to invest, pension funds are being told we don't want you investing in oil and gas because it's not good for the environment. The oil and gas producers are going, I don't know if I want to spend the billions of dollars it takes to produce more, to drill for more and to run those operations. So there's this hesitancy that has got to shake itself out. And so the growth that you would normally see with these high prices, we are not seeing. We normally see lots of drilling activity. We're not seeing that. So that is causing prices to stay up. And until prices need to get to a level where they go, okay, we're out, we're going to start drilling again. But they're not there yet. They haven't changed. Increase in natural gas exports, if we keep sending more and more to Europe and Asia, that's going to be bullish. That's greater demand on our natural gas. Continued geopolitical risk with Russia and Ukraine, et cetera, et cetera. And then increases in fees and tariffs imposed by the PUC and your utility. And we are seeing that more and more. It used to be for 4CP demand, your demand charges were $2 a megawatt. They're now almost $7 a megawatt. This is a 5-year change. So your AEP charges on many of your bills are higher than your commodity charges. That's just unheard of. So increases in tariffs. So what could cause it? Connect, that's all the bad news. Okay, that's the bad news. The good news is mild summer temperatures, expansion of natural gas drilling activity, more pipeline completions, more renewable energy, and they're putting in renewables as fast as they possibly can in Texas. I had a client whose actual operations are in Iowa. They're a manufacturing company, but they have a global green initiative. They have to reduce their carbon footprint. And they're not putting solar at their plant in Iowa because the sun doesn't shine as much, and they don't get as great a bang for their buck there. They're investing in solar in Texas. And I'm like, how does that make sense? But as far as they're concerned, they're helping, they're reducing their carbon footprint, not right there in Iowa, but they're doing that. So I think lots of companies around the US are investing in renewable assets in Texas. So that should help us because Texas is a more favorable market. So that should help us. And that might take a year or two. The recession will decrease demand. And if the recession does happen, people will be using less, manufacturers will not be manufacturing as much, et cetera, et cetera. One nugget of good news. This one's for all of you budget folks, and write this down, put it in your calendars. One of the things that happened recently is the legislature voted for gross receipts tax to be eliminated for school districts only starting January 1, 2024. Gross receipts tax is 2% of your total bill. So starting in 2024 for school districts, you should no longer be charged gross receipts tax. So I would begin to search for, put a tickler in your calendar to remind you that after that you no longer be charged. Okay, now I'll be back to remind y'all when it gets closer, but if you'll have me back. Some product options, everybody has bought fixed price. There are product options like heat rate. You could buy real time if you want to take risk. Some of the benefits of fixed price are budget certainty. You have complete upside protection. Once you're locked, you're locked. If prices go up, it doesn't matter. It's an easy to audit invoice. There's more competition. Some of the risks are if you lock up today. If you lock up today, and some of you want to lock up for a long time because you don't want to buy 1 year at that really, really high price, then you're locking up at the high for a very, very long time. And if it comes down, you're still locked up. So just like you're not going to participate in the upside, you're not going to participate in the downside either. A heat rate product is a product that's tied to natural gas. You would have full participation in downward movement until you lock natural gas. I don't know if any of y'all remember doing heat rate back in the day. There's a district here that just did a heat rate product. PSJ just did a heat rate product because they needed some. There is no upside protection if you're on a heat rate. You move with the natural gas market. It's a little more difficult to audit than fixed price because you could have a different price for every single month of the entire contract based on when you lock gas. It requires continuous decision-making to lock gas, and there isn't budget certainty until the months are triggered. The way it works is you take a gas price, whatever gas price, your electricity price equals a gas price times a heat rate plus a retail adder. And the reason we look at doing this is because natural gas prices right now are really, really high, but historically they've been in the $2 range. So if we think natural gas prices will go down to their steady state, might want to move with natural gas, but you need a contract right now. You may want to move with natural gas. And so lock up your contract long-term, but then not lock up gas until it reaches back to the levels that you want. This is what natural gas prices are doing. They're very, very high in the short term, but then they drop considerably in the out years. So these are the things that we're trying to do. We'll lock 1 month of this and a couple of months of this and average them together to ease the pain a little bit. So for example, a fixed price, maybe a customer gets a $52, who would be lucky, $52 a megawatt hour for 84 months, or they're in a heat rate product where the multiplier is 12. So gas price times the multiplier of 12 plus $2. And so we compare, you could do a $52 fixed price. And let's say you're at 35 right now and 52 is a big hit on your budget. One option would be to look at a heat rate product. And if you think over time, over the 84 months, you could lock up gas at an average of 3, which is still above what the last 5-year average is, you could actually end up at 38. Or maybe gas prices, you can only do $4 over the life of the contract. Well, you're still a little bit better than heat rate, or you are at risk until you lock gas. If over the life of the 84 months, gas prices average $5, then yeah, you would be paying more than a fixed price option. These are the types of things that we work through. So my strategy here, our procurement strategy, buy now or later. If you need a contract in summer of 2022, you really have very little time to execute. I would say develop a realistic price target based on historical movements. Closely watch the storage announcement, and storage comes out every Thursday at 9:30. That's what I'm doing, so 9:30 in the morning. Any announcements of a significant weather event could cause a disruption to move the market up, and it will take a long time for it to recover. Or you could buy heat rate if you understand. I would also recommend buying on a significant dip. If your contract ends at the end of this year, look at today's pricing, whatever your current contract is, current contract versus today's pricing. You still have some supply demand balance risk, but there's some opportunity, I think, in the fall to see where we are. If savings exist today, set a really reasonable strike price and look to lock before the end of the winter. If savings is more than $5 away, then set a strike just below your current rate and look to lock before the end of November. If your contract ends in 23 or 24, again, look at your current contract versus what you could buy today for a 23 or 24 start. You have some breathing room. Again, if you have some savings now, I'd recommend you set a very reasonable strike price and lock it in. If it's more than $5 away, then set a strike price just below your current rate and give it a little bit of time. Okay. Also, very important, and this is for all of you right now, especially as you start moving portables around this summer. You want to add that load to your existing meters wherever possible, because if you add a new meter, you're going to add it at the current contract price, current market price, if you've used up all your add delete allowance. If you add it to your existing meter, the supplier doesn't see that. They don't see that. So as you're planning all your summer movements, it's very important that you watch your add delete. And, especially if you're locked up at $30, $35, you don't want to go buy $150 power for that portable. Try to look for, start looking for large scale efficiency improvements. And when you're buying, make sure all of those changes are in that contract so that you're not adding and deleting it later. If you know you're going to be putting behind the meter solar or anything else, make sure that goes into your contract procurement. Again, so you're not either overbuying power or underbuying power. Oh, I have some right here. Thank you. Look to install upgraded building automation systems and align these consumption changes with your contract duration. If you know you're going to be adding a new high school in 3 years, make sure you buy for it in that new contract. And then participate in demand response. I'm going to hear some more about demand response. I think I'm running out of time. I'm probably way. Am I okay on time? Actually, I don't think I'm at an hour yet. I'm good, right? I think I started at 1:20, so I'm still good. There are ERCOT-based demand response programs. These are ways to put money in your pockets at the district. It does involve turning down. The ERCOT-based programs, I find very hard for my districts to be able to participate in, mostly because you get a 30-minute notification to turn down, and most of you are pretty busy doing other things than to be able to turn down that quickly. There's also some with the utility. Those are summer only. They also have a 30-minute notification. But there are some suppliers out there that are developing products that are working great with my customers. There is one supplier out there that has a day before notification, and they pay $25,000 a megawatt. This is, you're probably already turning down for 4CP, but they pay $25,000 a megawatt to be available to turn down. And when they ask you to turn down, then they pay you again. You need to they do want you to turn down for 2 hours, but they tell you the day before, so you can plan for that. So those are really great programs. I would definitely explore putting some of those in place, especially if you end up having to buy high price power, that these can help kind of lessen the sting. Other concepts. A lot of your suppliers are probably telling you that they're invoking change in law in your contracts. You may have had a $40 per hour, megawatt hour contract, and they're saying, because of the February freeze, we had to get new ancillaries, and we're going to pass those costs along to you. We're invoking change. You're saying, well, I had fixed price. Please be sure that you have someone validate that what they're doing is within the scope of your contract. Okay. There are some suppliers that aren't doing it at all. So be sure that those are all in the contract. When you buy new power, make sure all the meters are on that contract. Someone make sure they're all on there. We had a district up in the north part. Somehow one of their high school meters wasn't on there, and they just had to go buy it. Not good. Also on your natural gas, a new concept that none of us have ever had to worry about, but watch for notices called force majeure notices that tell you if you keep they want you to stop using natural gas at commercial facilities, or else you're going to be paying market. So if you see something called force majeure, please be sure to follow the instructions. And if you don't know what to do, my phone number and email address are at the very end. Please feel free to reach out and ask me what to do. Districts were getting over $1 million bills for not following the force majeure requirements. Verify what you're being told. I know that some districts and public entities were told that ancillary charges from URI were passed through to everyone for ancillary costs, basically nodal. That's not the case. None of our clients were passed through nodal congestion during your URI or ORDC charges. So verify that they can do that in your contract. And again, if you need help, I'm happy to help. So what are some of the possible obstacles to success? No collective ownership. Everybody needs to be on board. I went through all the participants. Initiatives that are too aggressive or undefined. No clearly defined steps. If you try measuring too many things, just have one goal. Focus on that one goal. If it's use per student, dollars per student, use per square foot, one goal, and let's get everybody on board with what that means. Use the same vocabulary. Everybody call it the same thing. Whatever that is. Integration. No integration between departments. That I cannot stress that enough. And too little connection between those that create the plan and those that have to implement it. And how many of those get told, we made this plan and you've got to implement it? And that's really, really hard to do. If everybody who has to implement the plan is part of making the plan, you're going to have a lot more success and then trying to do too many things. So recommendations, I also recommend that your people and your staff get training. It is worthwhile. And even if it's a training they've been to before, we all learn by repetition. We may hear something one way, and then you learn a little bit and you try some things, and then you hear it, you go back again and you hear it a different way, you learn a little bit more. Same thing about when you watch a movie, you watch it one time, you don't notice some things, you watch it the second time, you notice a little bit more. I do really believe in training. TEMA, Texas Energy Managers Association, has fantastic training opportunities. They just started a South Texas chapter. I believe Jacob Martinez is the president of the South Texas chapter, but I really recommend your staff get involved with that. See if you can have the energy savings, have an energy savings dedicated budget and put some of that savings back into the program to where whatever they save, they can put back in to start another initiative to keep saving. Communicate your successes. We don't do a very good job of that because we're so busy putting out another fire that we don't turn around and go, hey, look what we did. Communicate your successes, especially so all those people that helped you with that success are motivated to help you again. Standard controls requirements, and then independent verification. And then the last part was had to do with what's happened in February. There were a lot of folks that made mistakes, and I have a whole nother talk about all of this. The cost impacts, if you were on fixed price, you shouldn't have had a huge impact, but the PUC has implemented some changes. You're gonna see some costs that are new ancillary charges, so things they should not have known about. And then also there's a securitization fee that all of us are going to have to pay, including residential. Brazos Electric up in the northern part of the state went bankrupt. They owed billions. They owed billions to ERCOT, and they didn't pay. So guess who has to pay? All of us. The state is financing that over 30 years, and it's going to be called a securitization charge. And all of us will see that in our bills at some point. I'm hoping they roll it out to where it's fair and equitable to everyone, but I'm watching it very, very closely. One of the things that falls in y'all's lap, I cannot stress enough how important it is to pay your electricity bills on time. These suppliers are getting very sensitive to the margin they put in and the price they give you. They look at your payment history. They do not want to be remember, they buy the power, they deliver it to you, then they wait 30, then they bill you, and then they wait 30 days for you to pay. That's a long time of a float. If on top of that you're late, that's a huge cost to them, especially at these prices. So I cannot stress enough to be sure you pay your electricity bills on time. Because when you go to renew, some suppliers who might otherwise be a really good supplier, have really low prices, will put a premium on top, a credit premium. So I really, really stress that. I also think that REPs are going to start adding some limitations to the contracts. They're not necessarily going to do unlimited swing. They might say 20 to 25% swing, which should be plenty when they look at it as the district as a whole, but look for new things that they used to do, they may not do anymore. Also, I don't know if all of y'all are familiar with this House Bill 1525. Yes? So it's a one-time reimbursement only for school districts for costs increases as a result of Storm Uri. It expires September 1st, 2023. And I know there's probably a legislative person who's talking soon. I don't know. Yes, you're gonna talk? Are you gonna talk about this one? Nope. Is it first in, first out? Or is it everybody gets in and then they divvy it up? Okay. So from what I read of this, and he's a regulatory expert, I'm not necessarily, it just says costs incurred as a result. So if you used more energy because of that, I say that's cost incurred. If you got any flow throughs of charges that you didn't normally have because of Uri, and now they're adding these new securitization charges, they're adding these new ancillary charges, track those and submit them as part of this. Okay, it's only for school districts, but as he said, there's only $35 million. And that's all I have. Thank you so much for being a great audience. There's my contact information if you'd like to reach me. And otherwise, Ramalda and Lori have all my contact information. So you've been a great audience. Thank you so much.
One quick note on the reimbursement program as well. Just as there's that smart sheet that we're all familiar with for the American Rescue Plan, TEA does have a whole separate document that's on their website that goes through a gazillion questions on kind of the topics she mentioned on what counts, what can be reimbursed under that program and what can't be. All the electrical stuff that she mentioned is allowable. The only things that really aren't are some salary expenses. So like if you paid your staff, your teaching staff to during that week when you were shut down, that wouldn't be something that could be reimbursed. But if you paid maintenance staff overtime to go fix a burst pipe or something, that could be reimbursed under the program.
Next on the agenda, we have Josh. We have a 2-minute break, grab some cookies to help us get through the rest of the afternoon. Sorry, we're out of schedule, but I'm sure the last presenters will get us caught up. So 2-minute break.
Is it this one here? Oh, no, that's Steinberg.
Can we access email on this computer?
Oh, to me. Yeah,
To you,
you can
okay.
send it to me. L.A. Ramos, R-A-M-O-S. I have water here for you, and then there's something for the start. It's trying to distract them from cooperating.
I know y'all are ready to go, but Romalda's not here, so we'll give the slacker a little bit of time to get back to her desk, if that's okay with y'all. Just teasing. No, just teasing. Did you want us to go ahead and get started? Were we good? Okay. All right, so I'm going to keep the update relatively short and sweet today. We haven't had a whole lot of stuff going on in terms of strictly school finance updates, but we do have some legislative topics. This was a busy week up at the Capitol. And so I'll kind of go through some of the latest and greatest discussions, kind of things that they're considering and what we may see come next legislative session. So the Senate Finance Committee had a meeting earlier on in the week, and really they're primarily focused on how the state can drive further dollars into property tax relief. Yeah, yes. More, yes, that's our response as well. And you guys have heard me for months now ramble on about how costly House Bill 3 tax compression is and how much money that's eating up in the state budget. And then we just added Prop 1 and Prop 2, May 7th, both of those were approved. So the state is very interested in property tax relief. Obviously, the appraisals are going up sort of at a record rate across the state. And so that's driving a lot of that focus on additional property tax relief. I should also mention that the state has been sitting on $3 billion in American Rescue Plan funding that they are trying to use for property tax relief, but federal law prohibits them from using that money for tax cuts. That is the subject of ongoing litigation. And so that's why they didn't appropriate it directly to property tax relief last session. They're just waiting to see if the courts essentially overrule the federal statute on that. So, that's $3 billion they could have used to help schools out during this time, but they've been sitting on it again, waiting for the courts to give them the green light to use it for property tax cuts. So on top of all that, the Senate Finance Committee wants to use state budget surpluses to further drive down tax compression. And they adopted a new spending limit last session to go along with the other two they already had. And so between those three spending limits, that would set a certain threshold. Surpluses above that would be used to essentially buy down that state compression rate. Okay, so next year it's going to be 89.41, something around there. The way this would work is if the state had a surplus, they would just use that and dedicate that to further reducing the tier 1 compressed rate for everybody. So that's the kind of discussions that are going on in Senate Finance. They also talked about the fact that they gave resident homestead exemption, right? It went up from 25,000 to 40,000. And of course, that upset all of their donors and constituents that are business owners, right? And they didn't get a tax cut, right? And so they're kicking around ideas on how to next session give something to those property tax owners, or those property owners. And so that was a subject of a lot of discussion as well. Let's see, and then when it comes time to pay for all of this, the only real substantive idea that they had was to broaden the sales tax base. Okay, so there's a number of services, legal services, many professional services that aren't subject to sales taxes. And this has been kicked around a while up at the legislature, but bringing those services, making them subject to sales tax could boost state revenues, and they could use that to sort of pay for this sort of obsession with property tax relief. They also talked about renewing the 313 agreements. I know a number of districts in Region 1 have been approached with 313 applications. It's been really just wild out there in the 313 world because this program is set to expire. And really the deadline current deadline is this summer for applications to be submitted to the controller's office. And so there's kind of a frenzy out there to get in under this deadline. But the senators at this meeting were talking about sort of what comes next, or if anything does come next. There's a sort of new version of the 313 program that gets cobbled together next session. The Special Ed Funding Commission also met earlier this week, and you guys have heard me talk about sort of the issues that they've identified, that that the special education revenues that you're getting from state and federal government are not keeping pace with the costs needed to deliver an adequate special education program. And so they have identified that issue. We had a commission that was created by House Bill 3 that was filled with actual practitioners, special ed directors, and advocates who actually knew special ed. This Special Ed Funding Commission is just elected officials, so we'll see kind of how much progress they're able to make. But they have identified some, I think, good recommendations that came from that earlier commission's report. And so I'm hopeful that some changes could be made next session. I think if I had to pick one sort of area in school finance where there's some momentum behind the reforms, I would probably pick special ed. I think that we could see some improvement in that area. So despite my optimism there, I want to point out some of the things that they actually discussed at this meeting. Okay, so we all know about Senate Bill 1716. There was some concern that this may sort of open up the door for a voucher-like system with special education. What that does is it's a fund that parents of special ed students can apply for and use that money to pay for their whatever special ed services they want to use. Okay, it doesn't have to be within the school. It can be some private therapist or whatever else they want to use. Okay, so that's Senate Bill 1716 that was passed last session. They appropriated, I think, $30 million for that. It's already the special ed parents have already applied, and there's a waiting list for that program now. What they talked about at this meeting was they looked to Florida, which has it's not quite a voucher. It's a tax credit scholarship, a tax credit funded scholarship program, but essentially a voucher that allows special ed parents to draw down from an education savings account and use those scholarships to pay for tuition for their special ed student or other services. And so the commission heard testimony on this, and really it's sort of a hop, skip, and a jump from Senate Bill 1716, which we already have here in Texas, except that this would be funded through tax credits. Okay, and so that's, again, this, and really I think what they're considering is really ramping up the scale of what they have with Senate Bill 1716 to be something that's on par with what they have in Florida. And so that's the kind of things that they're looking at and considering there with special ed. So that's not, the most productive thing, I think, when we're thinking about what public schools needs are, obviously. However, they are talking about switching the special ed funding structure, right? As I think I've mentioned to this group a number of times, instead of being funded based on just the instructional setting, which is the model that we have in Texas now, all those weights and everything for special ed are tied to the instructional setting of the student. The one idea that they're proposing that I think would actually be helpful is switching to a special ed funding arrangement that would be tied to the intensity of services that are provided to the student. Okay, so the example I give on this is you may have two students that are both in the same instructional setting, right? Two resource room students, but one of them may require an aide that follows them around during the course of the school day and provides assistance to that student. Very different, and the other resource room student may not require that, right? And so that's the same instructional setting under the current system. You're getting the same funding from the state for that student, but the cost of providing those services are drastically different. So this new idea that was sort of initially proposed by that House Bill 3 Special Ed Funding Commission report would be to switch from a system that only looks at the instructional setting to one that looks at the actual services that you provide the student. Okay, and so that could help close that gap between what you receive in revenues for special ed, what you receive in revenues for special education from the state and federal government to the expenditures you have to make to run your special ed program. Then the Senate Education Committee held their first meeting, their first interim meeting. They talked about a number of different issues. They started looking at COVID's impact on teacher retention, and Commissioner Morath had some comments and some materials prepared for that. Essentially just reiterating kind of what we all know, that the working conditions are stressful and that teacher pay has, but you know, he sort of countered that with pointing out that teacher pay has increased in part to House Bill 3 and to other proposals with teacher incentive allotment and that kind of thing. But it's still, the challenge remains just with high record levels of turnover, and they didn't quite settle on any recommendations or anything at this meeting, more just outlined the scope of the problem. They also talked about just the difficulties in developing the local optional homestead, the local designation system that's required for the teacher incentive allotment, and how the pandemic has disrupted that, and how how they can sort of streamline that process for school districts. So they are looking at that. The commissioner shared some updates with regards to reading academies, how there's kind of again, streamlining that requirement, making it a little bit easier for teachers to test out, or just to give them time to advance through that academy. So they share that update with senators. They also reviewed sort of the changes with House Bill 4545 and also the removal of high stakes testing requirement. And I think talked about just the burden that all that accelerated instruction is having on school districts, and sort of revisited some of the pieces of legislation that were considered during the special sessions to maybe wind back some of those requirements when it comes to accelerated instruction, maybe make it only for certain subjects or that kind of thing. So I would expect that revisiting the accelerated instruction requirements under House Bill 4545 will probably be something that comes back during the legislative session. And then they also talked about the impact of the various changes to the bond proposition language, the statutory requirements there. So we all know House Bill 3 requires you to put that all caps phrase on every bond proposition. Also, Senate Bill 30 requires you to break up your propositions by facility type, right? Now your stadiums have to be their own proposition. Your auditoriums have to be their own proposition. Technology has to be its own proposition. And really, the discussion during the committee hearing was mostly around how those two pieces of legislation have led to really sort of marked declines in the bond passage rates since the implementation of those two bills. And so I'm not sure how much progress public school advocates will be able to make on that issue, but it is something that is sort of subject to a lot of conversation in Austin. The House Public Education Committee also met on that same day. They started an hour later and they were actually interrupted. They ended the meeting early once news of Uvalde hit. And so they didn't make it all the way through their agenda, but they did talk about a number of items listed here. They started the day with sort of SEL, mental health topics, and just looked at data on the number of students experiencing hopelessness, despondency, and other challenges, and sort of what the state could do to help districts respond to that. No real recommendations again were discussed, but there's at least we're trying to start to wrap their arms around the issue a little bit. Again, the commissioner talked about the teacher incentive allotment and how just how the state could streamline that application process and the development of those local designation systems. Again, they had a kind of similar set of topics as they did over on the Senate side: accelerated instruction, removal of those high stakes testing requirements. They did talk about how the A through F rating system was coming back for the 23-24 school year. And then, as I mentioned, they ended early once the news broke on Uvalde. One thing about Uvalde that I wanted to just touch on real quick is a number of districts have called us at Moat Casey asking, sort of curious about what impacts changes to their school calendar could have on funding. So I think a number of folks got calls from folks in the Bexar County area and folks in Region 1 were at least considering either ending their school year earlier than they were originally anticipating, or maybe delaying a week or something along those lines. Generally speaking, at this point in the school year, if you hit your 75,600 minutes, that's going to get you your full funding. Okay, and so if you already hit that number of operational minutes at this point in the school year, then there's essentially no funding implications for ending the school year earlier. In fact, I would imagine because of this, you may have some parents and some families that decide to keep their kid home from school, right? For the rest of the school year. And so you can kind of think of, that's going to result in a lower attendance rate. And so if you do decide to end the school year early, you could potentially be helping your ADA at the end of the school year by not having those low attendance days on the books. So something to consider. Again, the main takeaway is as long as you're already hitting that 75,600 minutes, your board kind of has full control over the length of that school calendar. Okay, any questions about that? Is anyone considering, do you guys know if any of your superintendents or your board are considering making changes, last minute changes to the school calendar? No? I know at least a couple of y'all are, because you called me and asked me. Okay. I'm gonna next switch gears to property values. We talked a little bit about this last time, but I've gotten some questions on, where can I specifically find this information that you're asking for to be able to do all of these property value projections. And so I'm gonna just go through that again, and this time I brought some examples, so hopefully it'll be a little bit clearer. But just to recap, property values are used for in a number of different areas when it comes to determining your state aid, your local tax collections. And the key thing to note here is that Slightly different flavors of your property value are used in each of these contexts, okay? So when it comes time to determine your tax compression, right, that survey you fill out each summer, you submit to TEA, they work their magic, and then they send your tier 1 rate back to you, right? And then you can go and adopt your tax rate based on that. That version of your property value is the grand total net taxable value, okay? When it comes time to calculate your tax collections, that's a slightly different version of your property value. You'll generally, and I think you guys usually have a pretty good handle on this, but you'll start with your what's called your freeze adjusted value, right? That's grand total net taxable minus all of those frozen values, okay? You apply your M&O tax rate to that, and then you add in a portion of your frozen collections to that to determine your total M&O collections. And then make some assumptions with your collection rate and all that, delinquent taxes. But again, a slightly different version of your property value is used for tax collection. Then when it comes time to determine your state aid, there's yet another version of your property values that's used that you'll need to plug in to the various templates that are out there. Okay, what the value that's used to determine your state aid is the state certified property value, right, that the controller generates. And the controller for the most part, they recognize a lot of the same exemptions that you'll see on your local property value report, except for a couple main differences, okay? If you have a local optional homestead exemption, that is not recognized for purposes of calculating your T2, okay? So you'll need to make an adjustment there, okay? And about a third of districts across the state have a local optional homestead exemption. So if that applies to you, you'll need to make sure that if you're trying to translate your April estimates that you got from your CAD, take that information and translate it to your T values, you'll need to make sure that you're adjusting for the local optional homestead exemption. The other major adjustment you'll need to make is for frozen values, okay? So we talked about grand total net taxable values and freeze adjusted values. Generally speaking, your T2 is going to come in somewhere between that because the controller recognizes a portion of the values, a portion of those frozen values, okay? So again, net taxable is with 100% of the frozen values included. Freeze adjusted is with 0% of the frozen values included, okay? The T2 is going to be 60 to 70%. It's going to be somewhere between those two numbers usually. And so we're going to kind of walk through how you can calculate what your frozen value deduction on the property value survey, the property value study is going to be. So tons of fun ahead. Get ready. Okay, so I'm going to go through some of this in a little bit more detail. Okay, so again, to determine tax compression, this is a screenshot of the TEA's local property value survey. Okay, this is that form that's going to open up in mid-July as you access it through Teal. And what's being asked for here is the July 25th certified district taxable value. Okay, and specifically, you need to get the grand total net taxable number from your CAD report that you get in July, okay? Plug that in on this form. And you grab that. I know this is kind of hard to see, but I know the counties here use the same kind of report. And so you can see here, this is specifically, I don't think my little laser is working, but the two things you want to look for, make sure that it says grand total at the top of that page, okay? So that says grand total, so we're on the right page. If it says ARB, ARB approved or under review, you don't want those pages. Keep on scrolling, okay? You want the grand total page on your July report, okay? Then you go down and grab the net taxable number right there on that report, okay? You don't want freeze adjusted, okay? You don't want assessed value. You want to get the grant from the grand total page, the net taxable figure. That's what goes into that local property value survey. And that is what's used to determine how much tax compression you get for your tier 1 portion of your M&O rate. Okay, you'll also, if you have a local optional homestead exemption, you can see on this screenshot that there's a field for entering that information as well. And you have to do it both for the current year and for the prior year. So to find if you have a local optional homestead exemption, you'll need to skip down one page from this sort of recap, skip down one page to the exemption breakdown. You'll see a little table here, the row that says HS homestead, and then find the column that says local. And if you have something there, you have a figure there, that means you have a local optional homestead exemption. Or it means your CAD messed up. Okay, so you need to figure out which one. Okay, but it probably means you have a local optional homestead exemption. This district does. You can see their value loss for that local optional homestead exemption is 98.5 million. Okay, so they would put 98.5 million back on this screen for the local optional homestead exemption value loss for the current year. Okay, so that's where you would grab that bit of information. Okay, so that's it for the tax compression. That you can see this survey is pretty short. There's not a whole lot to it. You really just need your grand total net taxable, your local optional homestead exemption. If you have a 313 that's expiring, then give me a call because you're going to need some help getting that data. That's not something that your CAD is generally going to provide. So this is, again, if you have a 313 agreement that is ending so the last year, the limitation would be tax year 21, so it's now expired for 22. Then give us a call at MoKC and we can help you with that. Since that's not going to apply to almost anyone here, I'm going to move on to how you can use this information that's on your CAD report to then calculate a T2 value for your template. Okay, so generally speaking, this is the formula here. You start with that net taxable number, that same number we used for compression purposes. You're going to subtract out a specifically calculated frozen value loss amount, okay? And then if you have that local optional homestead exemption, you're going to add that back in. Because remember, for purposes of T2, the state doesn't care if you have a local optional homestead exemption, okay? They're not going to take that off the rolls for you. They're going to essentially fund you as if you didn't have that local optional homestead exemption, okay? So you get that those optional homestead exemptions kind of hurt you when it comes time to calculate state aid. So you can kind of see just generally how that calculation works. A couple notes here that you'll want to keep a couple things in mind. One, those April estimates are estimates and they are before your taxpayers have had the chance to protest, okay? And so that April estimate is usually the high watermark of your property values, right? And then protests start eating into that, okay? So you'll want to keep that in mind. Sometimes your CADs will provide sort of historical trends on what the how much value protests have taken off the rolls over the years. And you may want to make some adjustments and sort of reduce those April estimates down to where you think they may end up being in July. Of course, sometimes they don't go down, sometimes they go up. So you'll want to talk to your CAD and see if sort of get their sense of it and see where they think those values may be heading when it comes time to certify in July. The other thing to mention, I know Hidalgo adjusted for Prop 2, okay? I don't think Cameron did. And I know the smaller CADs they have not adjusted for that. You may have gotten an update from your CAD now that Prop 2 is passed with sort of an updated number to sort of reflect the increase in that homestead exemption. But if you haven't gotten that update, go ask your CAD to say, hey, is this the right number to use now that Prop 2 has passed? Okay, so make sure that you're squared away on that. When it comes time to calculating the frozen loss, this is how the controller does it, okay? And all of this information can be found on a different report that your CADs can provide, okay? It's called the freeze total report, and it looks very similar to the grand total report that we were looking at, okay? The key difference is at the very top, it'll say freeze totals, okay? And it's from the same system that those grand total recaps were generated from, okay? So if you have some extra time on your hands and you really want to get a good estimate of your frozen deduction to calculate a really solid T2, ask your CADs for this freeze total report, and you'll have all the pieces you need to calculate the frozen deduction that the controller will make and sort of follow the same steps as the controller will do on the property value study, okay? And so here's how that works. You'll need a couple elements. The numbers in bold are ones that are pulled directly from that freeze total report. So you'll need the frozen taxable values. That's line 1 here on this slide. You'll obviously need your tax rate. That's line 3. That should be pretty easy to find. You'll need the frozen levy. That's line 5. That's in that same frozen table. And then if you have local exemptions for disabled homeowners or over 65 homeowners, you'll need to grab those as well. And that's lines 8, 9, and 10. Okay. And so all of those can be found in this frozen table down at the bottom. Okay. You got the tax rate, you got frozen taxable for this district, it's 211.7 million. You got your actual tax, that's the amount that your frozen and disabled home, or your over 65 and disabled homeowners will actually pay. That's the 1.6 million for this district. And so that's where you can grab that information. This would just be on that first page. Make sure you're on the grand total series of reports again. And then if you have local exemptions for over 65 or disabled homeowners, again, you'll need to skip down a page, find that local column on the freeze total report, okay? And you can see this district has a local optional homestead for the frozen homeowners. They have given them $35 million value exemption, okay? They've given they have an optional over 65 additional exemption of 8.6 million, and then 325,000 for, I think it's the spouse of someone over 65. I believe that's what it represents. But at any rate, you'll grab those 3 values and you'll plug them in 8, 9, and 10. Okay, and so this is important, okay, because if you have one of these exemptions and you don't plug this in, you're going to get the wrong number for line 7. Okay, line 7 is what the controller is going to take off your value. And essentially, if you go back here, line 7 is what that frozen value loss is going to be. Okay, so you get your net taxable minus your frozen value loss. That's the line 7 on that calculation I had up there earlier. Okay, so that's how you're going to get your T2. If you miscalculate your frozen value loss, then you're going to get an incorrectly stated T2, okay? And I'm going to show you the impact of this, okay? So this one is done correctly. I have properly added back my local exemptions on this slide, okay? And I get frozen value loss of 106 million, okay? If I don't do this correctly and I keep zeros here, then I'm only going to get a value loss of 62 million, okay? And so I'm going to be off if I don't add back those local exemptions, okay? So just again, make sure that if you're trying to get a really good T2 estimate and you're trying to replicate what the controller does to calculate your T2, that you go to your CAD and ask for this freeze total report, okay? And check it for any local exemptions that you offer to over 65 and disabled homeowners, okay? A couple other topics I just wanted to mention real quick. I have some notes here. And this is a question I think that came up on TASBO Connect regarding who is eligible or who can calculate, who within your district can do all of these no new revenue rate calculations, all of these, all the various stuff that you need for tax rate adoption, all the truth in taxation stuff. The requirement is that your board designate an individual to be responsible for that. There's no training requirement for this individual. It just needs to be a board designee to be in charge of the truth in taxation calculation. So that's the controller worksheet. That's so that no new revenue rate worksheet. All of those things that kind of are included in the process to adopt your tax rate. Generally speaking, this is the CFO. I've seen sometimes it's the superintendent. I have heard of districts designating someone outside of the district to do this. Even for the districts that we're doing this calculation for them, we still advise to list the CFO because we don't want to get in trouble. No, I'm just messing with you. It's just because we want someone within the district to be listed on it. That's just general best practice. But we'll do all the calculations and support y'all during that process. But generally speaking, I don't think it has to be someone in the district, but that's what we recommend. The other thing I want to mention with tax rate adoption is who all in here is a July 1 district? I think I've lectured y'all a lot on what you need to do for your notice, right? I'm going to say it one more time, so apologies, but and the reason I'm doing this is because every year we get a call from someone who put the wrong rate on their notice and then accidentally adopted it, and then a year down the line, TEA reaches out and slaps you on the wrist, okay? And so we want to avoid that. The first step to avoiding that is making sure that we're doing the right thing for the notice, okay? So for your notice, and actually I'm just going to bring it up here real quick if I can. Give me 1 minute to go download that form real quick. This is how much of a nerd I am. I know the number, I know the form number for that. Okay, so here is that notice that you have to publish in the paper. If you're a July 1, remember this has to be in the paper 10 days before your budget adoption meeting. You're not going to adopt your tax rate at this meeting, but you are going to adopt your budget at the June meeting. Okay, and it has to be in the paper 10 days before, so that's coming up. And so you fill out, a lot of this stuff is pretty straightforward, right? When the day and time that the meeting is at. The thing you put here, okay, the M&O rate that you put on this form is likely not going to be the rate you adopt, okay? You're going to, when you're building this M&O rate, and again, I'm only talking to July 1s right now, when you're building this rate, you're gonna take the lesser of two numbers, okay? You're gonna take the state compressed rate for next year, which is 89.41. We know that number now. Or you're going to take your tier 1 compressed rate from last year, your MCR from last year. Okay. The lesser of either of those two, that's your starting point for your tax rate. Okay. Then you add on whatever tier 2 pennies you're going to adopt next year. Okay. So if you're planning on going out for a TRE or just keeping your tier 2 pennies the same, you're gonna plug that in and then add those together, and that's your your proposed M&O rate for purposes of this form. What you don't want to build your M&O rate based on is, excuse me, is any sort of MCR or tier 1 rate you get out of the Region 13 template or any other template you use, okay? Because those templates are going to use your property value growth to actually calculate the tax compression, right, as required under House Bill 3. You don't want to do that for this form because you don't have your July certified yet, right? You don't actually know what your property values are. You won't get that until the end of August, okay? So you want to be conservative for purposes of this form, okay? Because you can always adopt lower than what you put here, okay? If you're going to adopt higher than what you put here, then you got to republish and go through this whole dance again a second time, okay? So to be conservative here, we take sort of what we know today, okay? We know your tier 1 rate cannot go up, right? So if you are already down below the state compressed rate, then you're just going to use that number. Let's say you're compressed down to 88 cents for tier 1, okay? For the 21-22 school year. You're going to take that 88 cents, add in your tier 2 pennies. That's going to be your proposed rate for purposes of this form. However, if you're at 91.34, let's say you've been consistently growing less than the state, then you know you're going to be compressed down at least to 89.41 because that's what the state compression is pushing you down to, okay? Nobody is going to be above 89.41 next year. That's the cap, okay? So you know you're going to go from, if you're above 89.41, you know you're going to at least go down to 89.41, okay? So that is the building block for your M&O rate if you're in that situation, okay? So, and then of course you just add back your tier 2 pennies that you're planning to adopt. Okay. Now that was a lot. I didn't have a lot of slides to support that. So if you guys have questions, or if you want to just shout out your situation that you're in, the July ones, I'm happy to take a minute to answer those questions now. Oh, everyone's good. You guys understand all the tax compression. Okay. All right. And again, this is not the rate that you'll ultimately adopt, okay? You're just doing a projection of your tax rate because, and you're being conservative about it so that you don't have to republish and go through this again. Once you put this in and you get your July certifieds, that M&O rate that you ultimately adopt in September may be lower than what's on this form, okay? That's okay. You don't need to go republish. You can just adopt the rate at that board meeting in September, okay? So just make sure, again, that you're building your M&O rate correctly right now for purposes of this notice, and then down the line, once the dust settles and you get those July certifieds, then you'll know what your true M&O rate needs to be. I had one other note that I wanted to share with y'all, and then I'll wrap up. Oh, the last thing I want to mention is just, and I think Region 1's doing a good job of alerting your school meal, your nutrition folks on this topic, but just know that those school meal waivers that we enjoyed during the pandemic, those are expiring, and so all of those flexibilities are going away. There is a bill in Congress to extend those. But it probably won't apply for next school year, but we'll see kind of how quickly that's able to move. But just know, and hopefully you guys are having those conversations at your district on how you need to adjust to those new rules and those sort of the unwinding of some of those flexibilities. Okay, so start having those conversations now because it's most likely going to be different next school year. Okay. And with that, that's all I have, unless anybody has any questions or you need a shoulder to cry on or whatever else. I'm happy to help.
Josh, can you share with them about the reception?
Oh, yeah, yes, thank you, Marla. I totally forgot about that. Yeah, so we decided, I know Region 1 made the announcement to postpone their superintendent academy just due to sort of extenuating circumstances here. And so we sort of followed suit and decided to also take a rain check on our reception that was going to be tonight. We will still have it, and we'll let you know. It's probably going to be a back to school type. That's kind of the time frame we're looking at. But just know, for those of you who are planning on joining us this evening, we're going to have to postpone that. Okay, and we'll make an announcement later on this summer whenever we get a date rescheduled for that. So. Sorry about that, but we're looking forward to seeing y'all whenever we do get that back on the calendar.
From anyone? And I forgot to share with you, Josh and Annette, we do have several Zoomers participating also because they were asked to stay behind for graduation and then some of the things that are going on, unfortunately, in the region. So just so you know that we have about 30 individuals in Zoom.
Have any questions from folks in Zoom land? Do we have a way to check that?
I don't think we do. Oscar is managing and the staff is managing the Zoom session. Anyone else? Okay, thank you, Josh.
All right, thanks, y'all.
All right. I know it's getting later in the day, but thank you for hanging in there. I appreciate it. Oh, thank you. All right, America and I are gonna flip flop a little bit. She's gonna do her presentation first, next on the agenda. Let's see here. So I have providing a ACTA and cooperative update, America Ratana. She is one of our purchasing cooperative specialists. She was able to attend the American Commodity Distribution Association annual conference. It's a national conference, and so she was able to bring back some tidbits of information to share. And so I'll go ahead and turn it over to you, America. Thank you. Let me get you.
Yeah, this one's fine. Mine will be short and sweet. That's why, so I'll go ahead and go over a little bit of the ACTA information that we brought back. I'll go over the available contracts and RFPs, some contract extensions that we're going through right now, and then some of our new requests for proposals that we'll be doing. So a little bit of what ACTA is, again, like Lori said, it stands for American Commodity Distribution Association. We had the privilege, Christina and I, to attend last month. It was hosted from April 24th through the 27th. There were 682 attendees and 1,760 ACTA members. So the benefit of attending that conference, well, for us at least, they are an organization that support the USDA food programs, all the different kinds. So their mission is to strengthen the impact of domestic foods, domestic US foods programs. And since we provide that service to our cooperative members, the commodity processing, so that's a big program that we do offer, and a great majority of our cooperative members do participate in that. A lot of the attendees, a lot of the stakeholders are industry, so a lot of the manufacturers, processors, they're the distributors, the schools, state agencies, and so on. And basically, what the sessions consist of is they share the different either struggles, improvements, so we kind of share amongst each other. That's kind of what a lot of the sessions are about. And we were very happy to see that we did have Texas representation. We did have McAllen ISD. They were both in attendance, as well as one of our presenters for one of the sessions. So some of the key points that we felt that we needed to kind of bring back and share with you guys, only because not only did we see that from the manufacturers, we kind of heard that from the distributors, and we also not only heard it on one session, it was kind of like repeated throughout the different sessions, I guess, because that's kind of one of the things that, or certain things that have been, you know, a little hardship on everybody. But one of the things was, so the vendors, when they are responding to the bid opportunities and the quotes, they are being more thorough with the terms and conditions that we are including. Sometimes I guess they feel they're a little bit too restrictive. So they are reviewing those thoroughly. They're also most likely providing deviations, which is fine. I mean, we do have that option for them to provide on there when they respond to our request for proposals. But that was just something that they did mention and pointed out, that that's kind of what they're facing. We're also seeing, and they did also mention that there are less vendor responses. So just to give you an example, and not to share too much, only because I know we just had a couple bids that opened on Wednesday. But on one of our contracts which is the discounted warehouse, is now called the manufacturer direct ship, we normally would have 40 to 60 awarded vendors under that contract. As far as the responses, we got about half. So that kind of just shows you how, you know, they're not as, they're just thinking thoroughly whether they can probably fulfill the needs. So that was one thing that was also shared. And of course, unfortunately, expecting to see more price increases throughout 2020. And I actually, you know, it was probably even further out than that. We're gonna probably continue to see that. Unfortunately, we tend to be getting just, you know, price changes every other week or so, just from the different, you know, word of vendors that we have, unfortunately. What they did also emphasize during the sessions was that how critical it is when the end users are providing their forecast, their, you know, what products they're anticipating, to not deviate from that, because like they're already seeing a lot of like labor shortages, production issues. So when they're provided with information on a certain product, then you know, the schools change their mind and they're wanting a different one, it is kind of hard for them to try to have that production. So those are kind of some of the items that did you know, they point out, you know, we wanted to point out and stuff. And then these were just a couple of pictures that we shared, and not very professional, we're just with our cell phone, but the picture on the right, that was one of the general sessions. And then the picture on the left, that was Ms. Alex Molina from McAllen. That was her presentation that she shared at the conference. And she did procuring during pandemic and beyond. And she did an excellent job. So this is just the list of all the available requests for proposals that we have on our website on the ROPC, the Region 1 Purchasing Cooperative. And then this is a list of the extensions that I have been working on. So I pretty much, as of right now, at least that's kind of how the situation is. I'm kind of overseeing the ROPC cooperative. Ms. Cristina Carrizales does the child nutrition, the South Texas cooperative. So all the items highlighted in yellow are the ones that we went ahead and took to the May board meeting already. Those extensions do go into effect on August 1st anyway, but since we have so many going on, I'm like, let me go ahead and send some out right now. So, and then the other two, which is our janitorial supplies and our office and classroom furniture, those will most likely go to the janitorial, probably to our August, but the other one I'm going to try to take to our June board meeting as well. And then we do have some new RFPs that are out and available for the vendors to provide a response right now. So for the, well, these are the ROPC, we have the facility product services and rentals. We also have two for the fire suppression vent hood. We have for the installation, training, parts and repairs, as well as for the maintenance, inspection, and cleaning. And all those three are due June 10th. And then we're also going to be having, I'll be working on the general merchandise one and the professional consultant services, which the current ones are going to expire in August. And then these are the list of the request for proposals for the South Texas Cooperative. And the link is there too. And then these are the list of the extensions that Christina has been working on. Again, the ones in the yellow, those were already taken to our June board meeting. So those have technically been, they have been approved. And then the remaining, I think a great majority of them, because I was looking through when they expire, she most likely will have to take them to the June as well. So, and then these are the ones that are available for the South Texas Cooperative. The ones, the first two at the top, the ones with the blue, those we just had opened Wednesday. So they went ahead and, well, I say open, we went ahead and closed them. I know it's a little, so we did get the responses back for those. And then we do have, along with the ones for the ROPC, we have the dairy and juice and the school nutrition program, food safety, sanitation programs. And that one's also due on June 10th. And then the upcoming ones that are going to be under the South Texas Cooperative is going to be the removal of grease for traps and the wireless temperature monitoring systems. And we did kind of want to remind, if you guys have any vendors that may be interested or may fall into any of these categories that you may want to work with, or maybe you're already working with, and you want to share that, send us their contact information. We can go ahead and provide them how to get set up in the system, how to, we have resources on our webpage. That way they'll have that opportunity to respond. That way they can, have that option to become an awarded vendor under these contracts. And then this is where we list, this is the page where we list all of our available bid opportunities. We do have, I know we're gonna go ahead and get ready to remove the ones that just opened on Wednesday. But we do have all those other ones listed there. And then we also include at the bottom the upcoming ones. So the ones that we're gonna be soon working on as well. And then this is our vendor registration page. This is pretty much whenever any vendors reach out to us, this is that they're interested in how to do business with any of our cooperatives, how to become an awarded vendor. This is what we send that information out to them. This is on our webpage, so any of you guys, if you guys are ever, you guys receive a request from any vendors, or like I said, you guys are, wanting to have them, that possibility of becoming an awarded vendor on any of our contracts, you can always just shoot them that link and, and they can go ahead and get that started. And then this was probably touched on the last month's presentation as well, but I kind of did want to include it on here as well again, because when the vendors register and create a vendor profile, it generates a vendor number, which is included on the left-hand side of the screen, which is a 000 something. Sometimes we'll get calls that vendors say, oh, well, or they'll tell the schools, well, I'm already registered and this is my vendor number. Well, that's one part. That's basically the first part of, the possibility, you have to go through that bidding process. Once you go through a bidding process, we go through our evaluation. It gets, taken to the board for a recommendation for approval for award. Then it generates that RFP number. So the one included on the right-hand side. That's the critical number that they're wanting, and that probably you guys are needing in order for you guys to confirm that they are indeed an awarded vendor. So those are kind of what the difference in the two. And then of course, last but not least, forecast, just reminding everybody, anytime we do a new contract, we always request for forecast. It's very critical. Sometimes if we don't have any forecast, then we're just assuming that the districts are not interested in doing that contract anymore. So, there isn't, and that is part of our RFP process. We need to include that information on when we put out those requests for proposals, so that the vendors know what they are getting into how much they're, looking into producing or whatnot, depending obviously on the request for proposals. So, but yeah, and then I guess since we will be having upcoming ones, just kind of be on the lookout and try to send us back that information if in fact your district will be utilizing those contracts. So, okay, and I think that's it for me. Thank you.
No, because they just have it in PDF. It was from the conference. All right, thank you, America. So next, I'm going to go over some of the presentations I brought back from the TDA MegaCon conference. Yeah, okay. So there are a few presentations I brought back. I'll start with writing supporting procurement procedures. I thought this was important because, as Carmen touched on earlier, that seemed to be kind of a common finding in a lot of the procurement reviews. So go ahead and get started with that. So first, just to kind of start off, they want to ensure that you have those written procurement procedures to ensure the program's integrity. So the written procedures demonstrate compliance and transparency in the procurement processes and promote full and open competition. So in here, they also identified what TDA, the Texas Department of Agriculture, felt effective procurement systems contained, which was the written procedures, that you identify how you select the appropriate process. So the procurement methods should be described in the written procedure. So make sure you have those spelled out, like what is your micro purchase, your small purchase, your formal purchase methods, and thresholds. Also, develop and publicize the solicitation. What procedures do you follow to do that? So make sure that they include that even for your small or the formal purchases. And then how you receive and evaluate the offers. So what evaluation criteria is used? Of course, they always want to see price as the highest scoring factor. So always make sure you have that on there. And then the award contract. So is the lowest responsive and responsible vendor awarded? If not, you're going to need to ensure you have justification for why not. And then that contract management piece. They want to also make sure that in your procurement procedures, you identify how you're managing the contract, how you're checking and verifying to ensure that all parties are honoring the terms, the conditions, the pricing. So in developing your written procurement procedures, you want to explain what steps should occur for a compliant procurement process. So this should include the cost price analysis, capital expenditure requests, how you obtain quotes and how you publish your solicitations, how you evaluate those responses, and then how you monitor for compliance. So the written procurement procedures should have the processes, so define all procurement processes from beginning to end. Also identify the people, identify who is responsible for specific activities. You want to make sure that it's clear. So avoid any confusion or disorganized procedures. And then, of course, compliance. So, and that's used to demonstrate adherence to USDA rules. And we all know that there are a few extra rules and regulations when it comes to USDA. So really one of the things that they recommended was that your child nutrition programs have, even though you may at your district have your procurement procedures, that you have some specifically for the child nutrition program. It seems like that was the districts who had that in place typically did not have the findings during their procurement reviews like the other districts. So your procurement procedures also need to make sure it includes a written code of conduct. And again, like Carmen touched on earlier, this is not the code of conduct for the teachers. They want to see code of conduct specific for child nutrition staff and district staff. So procurement, whoever's involved in the procurement. So staff that is engaged in contract awards, the method of procurement, the cost price analysis, required regulatory clauses, conflict of interest, and any statements regarding violations. They also want to see if that's violated, that code of conduct, what are the consequences for that? They want that to be spelled out in there too. So with the cost price analysis, this is the first step in the procurement process and must be described in the written procedures and documentation of the analysis and should be retained as part of the procurement process. So this is a sample statement that TDA provided in their presentation. It says a cost price analysis will be conducted for every procurement action in excess of the simplified acquisition threshold. And then it has a little insert title there, right? So you want to identify who will be a position who will use the current market pricing, historical data, velocity reports, and or any additional forecasting tools as appropriate in determining an estimated cost for the item of service. So this is something we do with every procurement that we conduct for our cooperatives and even for our internal RFPs as well. So the first thing we're going to do is conduct, we call it an independent cost determination. So we take those forecasts, we take what we anticipate we're going to purchase, how much we think that's going to cost, and then we come up with a total contract, an estimate for the total contract value. And then we determine, that should tell us, well, in most cases, yes, we're going to have to do a formal procurement method because of the cost, right? It's over that simplified threshold. So then next, once you have that, you can select your procurement method. You know, if it's under the 10,000, are you able to deem it a micro purchase? If it's over, also your local policies and procedures. So your district might have a lower threshold, right? Or a higher threshold if your district has self-certified. Maybe your micro is at 50. Maybe y'all have increased it and got that approved. So it really just depends on what your local policy stipulates. Remember, the most restrictive is always going to rule. So between your local, the state, and the federal requirements and thresholds. So your written procedure should explain this decision-making process. You want to make sure that you do that, including the acquisition threshold. So identify those thresholds for a formal or informal procurement process. Your capital expenditure request. I don't know why I can't say that word today. Also, how you what you do in the event of an emergency or a sole source purchase. So the processes for that. Also, any cooperative purchases that you make through purchasing cooperatives. And if you're part of a food service management company, then that process needs to be included as well. So the procurement methods they've identified is the micro, the informal, right? Important with this micro is equitable distribution, and Carmen also touched on that earlier. So you can't just under the micro purchase use the same vendor multiple times. You have to make sure that you equitably distribute that to different vendors. So not just using the same repair vendor over and over again. Also take into consideration the aggregation. So over time, is this going to exceed the formal procurement threshold? So you're going to need to track that. So you definitely track it and just make sure that you're not using the same vendor all the time. Okay. Small is a small procurement process. That's also an informal process. You want to get 3 quotes if possible. Notice they put minimum of 2. So the more quotes you can get, the better. Remember, they're all about full and open competition. So if you have 10 vendors that could potentially supply the good or service, send it to the 10 vendors, see what you get back. But you do need at least 2 responses back. And then of course, lowest price is going to rule unless you have some really good reasons why it shouldn't. And you'll need to make sure that that is justifiable. And then we have our formal procurement process, which includes like a request for proposal process or an invitation for bid. Again, lowest price, and you want to make sure that you are awarding to responsive and responsible vendors. And then lastly, we have our non-competitive procurements. Those include emergency, sole source procurements, and TDA approval is needed on those. So keep that in mind also. So if you have a non-competitive procurement where maybe you did a full solicitation, an RFP solicitation, you publicized it, you put it in the electronic state business daily, your papers, you had it out for 30 days for adequate responses, and you still only get 1 response, you're gonna have to submit that to TDA for approval so they can review that. And they might come back and ask a few questions because they want to make sure that you did your due diligence. And as America touched on earlier, right now the market is just, we're seeing a lot of vendors being very cautious in responding to bids right now. They're leery of not being able to meet the expectations and fulfill the requirements. So they're a little gun shy these days. For capital expenditure requests. So that's approval to spend funds only, must follow procurement regulations to spend federal funds. So those do need to be submitted to TDA for approval prior to spending the funds. Cooperative purchases, the CE, that's a school district, is responsible for ensuring that the cooperative uses compliant procedures. So you want to make sure that when you're using a purchasing cooperative, did they get all the certification documents? Did they do their due diligence? So get those required documents from them as your part of your backup too. And then food service management companies. I'm just going to skip over that. So we don't have too many here, but we do have a couple. Your solicitations and contracts. So all contracts and solicitations must include regulatory and legislative provisions. TDA has what they call the ARM, the Administrative Reference Manual. And That is section 17 houses the procurement requirements in there. So you definitely want to take a look at that. Anytime you're doing a procurement solicitation of any kind, you want to make sure that you're following all the rules and the regulations and that you have addressed all of those in the solicitation. Buy American required for food. So there is a specific provision. It's called the Buy American provision. It is required anytime you're procuring food of any kind for the child nutrition programs. It is not required for non-food. So I just to make that clear, this particular one is just related to food, and it does require the vendor to sign a certification. And they will ask for that during the procurement reviews. And also just to touch really quick on the Buy American provision, TVA also has a checklist, a form. So anytime the child nutrition program is purchasing food items that are not manufactured and produced in the US, they have this checklist that they should complete and keep on file for their review. And that's for every time they purchase that product. Right, Carmen? Yeah, I know. They don't like that, but that's what they require. So some common items that you might see your school districts using that are not produced in the US might be jalapenos from Mexico and mandarin oranges from Thailand. Those are very common ones that we see. And a lot of that has to do with the lack of domestic availability. So your micro purchase, it's less than 10. Again, some districts may self-certify at a higher threshold up to 50. You do need to make sure that you have that documentation on file because they will ask for it. Under your micro purchases, make sure you have equitable distribution. So if you have similar vendors offering the same reasonably priced product, should be used equally. So you've got to spread the love a little bit. And then aggregated purchases. So just make sure you keep kind of a tally of those purchases so you can check the aggregation total. So our small purchases are defined as those under $50,000. So you are going to need a minimum of 3 quotes. Verbal or written quotes are acceptable. I always say get it in writing. That way you have that backup documentation. So even if it's an email or something like that. Identical solicitation. So vendors must bid on product with the exact same specifications. So in other words, what they mean by that is you want to make sure you're giving all of the vendors you're soliciting quotes from the same information. So the same specification for the item that you're looking for. Okay. And then lowest price. Price must be the primary determining factor in your purchase decision. There we go. Okay, sorry about that. So your formal procurements over $50,000. You want to make sure that all vendors have a level playing field. So that all vendors are given the same information, that no one has been given extra information that the others didn't get. So all vendors are provided the same specifications and all offers will be evaluated as indicated in the request for proposal or invitation for bid. You have to ensure that that full and open competition is supported. So make sure that you're sending it out to all the vendors and they're all getting the same information. And then the contract management piece of that. So you want to make sure that you document and monitor to make sure that all parties are adhering to the terms of the contract. So once you award that contract, just make sure you have that continuous monitoring. Make sure that those invoices are being checked, and if it's a fixed price contract, which through our co-op, they are, you want to make sure that the vendor is honoring that price. So you're going to need someone to be checking that pricing on the invoices. And if there's a discrepancy, it needs to be corrected before you pay it. So develop and publish. So you want to follow your written procedures, encourage full and open competition. Make sure with your formal procurement process that you're giving the vendors enough time to respond. Even when you're doing some price quotes, if you're doing a small procurement process and you're just soliciting price quotes, depending on the number of items or the size or scope, you might need to give them a little more time. As an example, like with our food bid, because it's thousands of items, we give the vendors about 6 weeks to respond to that bid because it's so large. Do we have to? No, but we do it. Why? Because we want to ensure that we get as many vendors to respond as we can and that we're giving them enough time to respond due to the number of the items. So take that into consideration too. If it's a really complex or large bid or a request for quote, you might need to give them a little more time to respond. For your formal procurements, you need to make sure that you're publishing in the paper, right? Every 2 weeks. And the goal is, of course, to get as many offers as possible. We also use the electronic state business daily through the Texas State Comptroller's website. It's free, so who doesn't like free, right? So we always make sure we publish there too, just to try to make sure that we get the word out to as many vendors as we can. Of course, we also post it on our website and through our electronic procurement system. So under the request for proposal or invitation for bid, the specs, you want to make sure that you take those technical requirements and kind of build a item specification for that. So you want to specify size, quality, ingredients. One big thing, never use a brand name with your child nutrition program stuff, with your federals. If you use like Tyson item number 39, 35, make sure you always put that or equivalent or equal. And that way you give those other vendors, if there's Pilgrims or Rich Chicks or whatever other vendors out there that can also supply that chicken nugget, you're giving them that opportunity to do that. USDA and TDA feel that when you add that brand name, and if you're that specific and you only accept that one, that you are being too restrictive and prohibiting that open and free competition, so be very careful. You want to also define your purchase conditions, so the contract length, all of that would be in your terms and conditions, right? The contract length, the delivery schedule, the type of pricing, is it fixed or is it on an escalator, de-escalator? Any return of incentives such as discounts or rebates and credits, are they coming back directly to the district? Also include, of course, all the regulatory language that you need in there. And remember that cost plus percentage pricing is not allowed through your TDA contracts, your child nutrition program contracts. So preference points. So you know Texas Education Code 44.031, we have the required, if we do a request for proposal, we have the required evaluation criteria we're supposed to use, right? Well, with TDA, under that one section for historically underutilized businesses, unless you actually have a plan where you're supposed to promote and support those businesses, then they recommend you don't add any additional points for that. Okay. We definitely want to get it out to those historically underutilized businesses, women, minority-owned businesses, and all of that. But unless you have a specific plan in place that states that you need to get more of those types of vendors, then don't give it any extra points. Also, under geographic preference, we're not allowed to give any additional points under that, so just leave it at 0. The other thing, which I'm surprised they didn't specify in here, is past relationship. That's a big one that they look at and they're big on. They don't want to see you giving preference to vendors for your past relationship with them. They also feel that that is very restrictive of free and open competition, because then you're giving this vendor that you've done business with extra points versus all these other vendors who could possibly provide the same service. Yes, ma'am. For past relationship, no points. So once you have published your request for proposal or invitation for bid, you've opened them up, now it's time for you to receive and evaluate those, right? So make sure that you also have defined that process in your procurement procedures. So how are you going to open the bids? How are you going to score and evaluate based on the established criteria? Also, quality check. So evaluators should work independently to tabulate scoring. Scoring discrepancies should be researched for accuracy. Something to keep in mind when you're evaluating those RFPs. You also want to make sure that you're documenting the process. So offerers should be evaluating using a published rubric. So that should be the evaluation criteria you published in the RFP with the weights. And everyone should use the same scoring rubric. Price must be the highest scoring factor. So for instance, if you have all the scoring, maybe you put price at 40 points, right? As long as that's the higher points as the rest of the evaluation criteria. And important, you want to make sure that the vendors are responsive and responsible. So any vendors you identify through that evaluation process that don't meet your evaluation criteria, you don't want to award them, right? So then you come to the award and manage piece of your procurement procedures. So you want to make sure that your written procedures document how the RFP defines that process also. So how you do the award notice, how you provide any rejection notice to the vendors, the contract acceptance as it go to your board, and then the contract management piece of that begins. So you also, we'll get into what they want to see there. So then you come to the part where you're going to execute and monitor the contract. So that's the next piece, and those procurement procedures. Are you going to award or reject the offer in accordance with the RFP? And then you have that contract management piece. So you want to use documented monitoring to evaluate contract compliance. Audit for pricing, that's where we want to check those invoices to make sure that they're giving you the right pricing. And if you have any rebates or credits coming back to you, that those are also on there. And then, of course, retain all the documentation. So contract binders can be useful for organizing active contracts and reviewing performance. And for renewal or bids. I know even for us, when they review our cooperatives, they want to see how we have, we are tracking vendor performance. So that's why we do those surveys every year to the co-op members to solicit feedback for the vendor performance. So we have that documentation. And it helps us make a decision too, if we're going to rebid, maybe the vendor performance hasn't been good. Y'all aren't happy with them. So then that prompts us to, you know what, we're gonna rebid this and not renew. Or maybe everyone's super happy with the performance. So then, you know, that prompts us to renew that RFP. And then when it comes to the records retention, also make sure you keep all of that together, whether it's a paper binder or a digital binder. I think most people are going digital these days, right? But make sure you keep all of that, your cost price analysis, your RFP or IFB or quotes, the award notice, the signed contracts, the invoices, the monitoring documentation, the contract management piece of it, any communication logs, any renewal or terminations. And all of that is what they're going to be asking for when you do your procurement review process for the contracts that they audit. So records retention, just real quick. 5 years for public schools and charter schools, 3 years for private schools, nonprofit orgs, and RCCIs. Longer retention requirements for lawsuits, disputes, investigations, or reviews. So keep that in mind. Make sure you retain those documents. And that's all I have for you guys on the procurement process piece of it. I talked with Carmen earlier today, and I told, you know, as we were kind of going through and preparing for the presentations today, we kind of talked about the biggest kind of hiccup in the procurement reviews has been those procurement procedures. And that's where the biggest number of findings we're seeing. So we talked about maybe having, setting up over the summertime, some special workshops. Maybe we can do like a couple of them, like one here, one in the Laredo area to capture those schools, and then another one in the Brownsville area to capture those schools, but where we just sit down and go through your procurement procedures, make sure all of those points are touched on in there. Maybe I feel it would be great if we could have a representative from like your child nutrition program director and then your purchasing people also. And that way we make sure that we're hitting everybody and you're ready for your review. So look for that to come, right? So, all right, well, that's all I have for y'all. I appreciate it. I know it's been a long day, I'm sure, but a great lunch.
Any questions from the group before we wrap up? No, I know I should give you a prize, right? Sorry, we ran out of food and snacks, but thank you so much for holding tight. I know that it's very difficult times right now, and it's very sensitive with everything that is going on, but we do appreciate that you were able to get away from the office and join us today. It was a super packed agenda, and so we'll reconsider for next time. I'm brain exhausted right now as well, but thank you so much for coming. We didn't get to announce some of the retirements earlier. I understand Cindy Richards from McAllen is retiring after a couple of years in the school district. She was actually the one that hired me back in 2000 in McAllen ISD. So a lot of my knowledge on accounting I give credit to her and Elena Flores that used to work there in McAllen. And so I know that she's retiring. We had already announced some people from La Jolla in a previous meeting. but I don't know who else may be retiring, but I guess we'll find out in August when we come back to the meetings. Also, I didn't have a chance to announce earlier that the newest addition to the finance team within Region 1 is Angela de la Cruz. Do you mind standing? And she's coming to us from Cherryland ISD. She's been on the job today, 7 days, so she's already getting to see a lot of the things that go on. So more than likely, she'll be reaching out to you because we do have some school districts that are still sending us checks, and we would love for you to send us an ACH. Please, please. So she'll be making contact with you in the future. But thank you so much for coming today. Have a safe weekend. Have a safe Memorial Day weekend. If you're not working, enjoy yourself. Take care, and we'll see you soon. Thank you so much for coming.